Okay, so this is the World Bank Academy, and we are basically going to be looking at our course outline. So the course outline has 7 parts, and the number one part is the basic one, which gives you an introduction to the financial market and gives you the more like the primary knowledge you need to have about the financial market. So we have the basic two, which is a step further from the basic one, the intermediate, the technical analysis, the strategy part, and the risk management, of course. So let's just go through our course outline one by one. So we'll talk about what is forex. You need to know what forex is all about. Talk about the types of financial markets, because there is not just one financial market. Forex market is not the only financial market. We have a host of many others. So we have the market participants. You need to know who you are up against in the financial market. That's in the forex market. You need to know the history of money. Our major commodity in the financial market is money. So you need to know how money started. So we have the characteristics of the currencies traded in the financial market. Not all particular currencies have the same way they behave. So they all have different ways in which they behave. So you have to know what makes each of them stand out, basically. So we also have we'll talk more about how currency pairs work. Talk about the reading an FX quote and taking a sell, which is a down, or a buy, which is an up decision. So whenever you say sell, you are trying to speculate that the market is going to be going down. Whenever you use a buy option, you're trying to speculate that the market is going up. So what sell and buy really means, forex terminologies. Before you become a medical doctor, you need to know the technical terms of that particular field. So before you become a forex trader, you need to know the forex terminologies. You need to know the mindset. You have to have the right mindset of a successful forex trader. So I tell people forex is more about psychology than it is about strategy. So you need to have the right mindset. All right, before you become a successful trader, you need to have the right mindset, and most importantly, the right expectation. And not every time a trade is going to go in your favor. So when the trade doesn't go your way, what are you supposed to do? So we have the characteristics of a successful forex trader. There must be certain things that we see in someone who is successful trading forex that makes him successful. So we're going to be identifying those things. All right. So we're going to be talking about the characteristics of an unsuccessful trader. There's a basic reason why someone who is unsuccessful in the forex market isn't. So we're going to be looking at what is making the person unsuccessful. Is it because he's greedy? Is it because of he has the wrong expectation? We're going to be looking at that. So we talk about trading plan. Just like before you start a business, you need to have a business plan, right? So before you go into trading, you need to have a plan. There is a popular quote that states that anyone who fails to plan plans to fail. Okay, so before you get into trading, you need to know exactly what you are supposed to be doing. All right, so we have opening a broker's account. I'm going to walk you through the process of opening a broker's account and with our recommended broker. All right, because there are so many brokers there that are scam. So we'll recommend a particular broker for you, and then we'll walk you through the process of opening an account with that broker. So we have our basic two. We'll talk about the types of traders. We'll talk about fundamentals, that's the news events, and we'll talk about what moves the market. You need to know what causes our graph to go up or go down. You need to know law of demand and supply, because forex is a business, and what affects a business is basically demand and supply. All right, so you need to know the law of demand and supply of currencies. How does it affect the forex market? How does it move the forex market? So intermediate class, we'll talk about the 3 types of market. We'll talk about a trend. What is a trend? Talk about the types of trend. There are basically 3 types of trend. So when we'll get to the technical analysis part, that's when you use the knowledge of your intermediate. It's going to be very, very useful, especially when we want to talk about price action, which is the act of naked trading. So price action goes alongside with candlesticks. You need to be able to identify the different candlesticks patterns that we have. Talk about support and resistance, which is basically demand and supply. these are zones in the chart where basically the market gets to and reacts in a particular way. So when we talk about price action, we're talking about how does the market react to these particular zones. We talk about trend lines, which are a form of support and resistance. We talk about our main strategy, the strategy rules, the rules for drawing a trend line, our entry, our exact entry. Though this forms part of the trading plan, the strategy is based on a trading plan. So the exact rule we use for entering a particular trade, the stop loss placement, the risks for a particular trade, and how do we calculate the risks and all of that. So in our risk management now, forex is a business, and all business has some level of risks. So how do you manage your risks in forex is what determines if you are going to be a successful trader for as long as possible. So your risk management is really of maximum importance when it comes to trading. How do you manage your risks? Do you just want to die today, or do you want to live to die another day, or fight another day rather? So that is basically when we talk about risk management. So we talk about using MetaTrader. You need to understand how we use our platform, and you need to understand this platform called TradingView, because that's what we are going to be doing our analysis most of the time. So we'll talk about taking signals, because I'll be sending you signals, so you need to know how to properly take those signals. Alright, so okay, so let's talk about what is forex. Okay, forex is a type of financial market. Alright, it's a class of financial market which basically comprise of the exchange of currencies from one form to another. What I mean by that is that in the forex market, we are basically exchanging a particular financial asset of a particular economy into another financial asset with the aim of making profit from price volatility. When I say price volatility, I'm simply saying that price movement, price changes, that's the changes that occurs in the value of a given financial asset given a period of time. So forex is the market for this exchange. All right, from the name we can determine what forex actually means. Forex, that's foreign exchange. Forex is the acronym for foreign exchange. All right, so it basically denotes, or it basically is talking about the market for the exchange of financial asset of various economy. So how do you basically make money from the financial market? That's the forex market. You basically make money by buying a particular financial asset when the value of that financial asset is low, and speculating that the price is going to go up in value, so that you can sell at a later date for a higher price for the financial asset that you bought. Okay, so that's what basically the forex market is all about. It was founded in 1970. All right, the financial market as we know it was founded in 1970, and before that, in 1944, the forex market was the very first time the forex market, the idea of the forex market was invented to stabilize the economy of the world after Second World War. So that was the purpose of the forex market, to stabilize the economy of the world when it was formed. But the forex market as we know it today, that spot trading, was founded in 1970. Okay, so let's move forward. We can describe the forex market this way, as a scale. How do I mean? We can look at the forex market as a scale that balances two economy. All right, one economy has more value, the other has lesser value, right? So the economy with more value obviously will go up in the scale. That means it has lesser weight. It is quality, it's not quantity. Okay, and the economy with less value will obviously go down. All right, so you can look at the financial market as a scale that balances economy, just as it was used as an instrument to balance the economy of the world after the World War in 1944. So the forex market can be looked at as a scale that balances two economies. So no two economy given a period of time can be going in the same direction. One must obviously be doing better than one, even though the two economies are stable economy and they are doing good. All right, but one has to be doing better than another, because the forex market is more like a struggle, it's more like a fight, it's more like a contention. All right, so one must be doing better. No two people can fight at the same strength. That if you want to measure two people fighting, they cannot be fighting and giving themselves exactly the same points. One must either be better, because we'll surely at the end of the day we must have a winner and we'll have a loser. So the forex market is more like a zero-sum game. It must be a zero-sum game. When they say zero-sum game, it means there must be someone who is a winner, there must be someone who is a loser. There's someone benefiting from a transaction, there's someone that is not benefiting from a particular transaction. Another way we can see the forex market is in the condition that two people are fighting. For example, two people are fighting, okay, and then you as a trader, let's say we have Peter and Paul, okay, we have Peter and Paul. We are speculating on who among those two people is going to win the battle at the end of the fight. So what we basically do is that we invite a middleman, which happens to be a broker. All right, the brokers are the middleman, and the two people are fighting. So the broker now say, who do you say is going to win? Peter. Peter says, okay, I think it's A that is going to win. He says, okay, give me your money. All right. So he tells B, who do you think is going to win? B says, I think it's he tells Paul, who do you think is going to win? Paul says, I think it's B, because I feel what I've seen, I think B is going to win the battle. So he tells, okay, B, give me your money. So at the end of the day, there must be a winner, there must be a loser. So once the winner has been found, the money now is given to the person that speculated before the winner emerged. All right, the money is given to the person that speculated that this was going to be the winner. So it's a zero-sum game. There must obviously be a winner, there must obviously be a loser. So that's what that's how we can relate the forex market. So now the characteristics of the forex market. What makes it the forex market? What are the major characteristics that makes the forex market the forex market? Number one, the forex market among other financial markets is the largest in the world. How is it the largest in the world? It's because it does over $4 trillion a day. The stocks market does less than, I think, 10 billion in a day, but the forex market does over $4 trillion in a day. So it's the largest financial market in the whole wide world. So the forex market has no physical location, whereas the stock market and other forms of market has a physical exchange. So we have the New York Stock Exchange, we have the Nigerian Stock Exchange, they have a physical exchange where they are being traded. But the forex market has no physical exchange. It can be done anywhere in the world. Alright, yet it is regulated. So the forex market operates 24 hours. When people are not trading in Nigeria because of time difference, someone in America is trading. When we are awake here in Nigeria, people in America are sleeping. So the people here in Nigeria are trading. When people are not trading here in Nigeria, people are not trading in America, someone obviously in China will be trading. So it's a 24 hours market. Anytime you open your computer, so far as it is between Monday to Friday, the market is open for you to trade. And the volatility, another characteristic of the forex market is that it has volatility. All right, it has volatility, and that's what makes people that trade the forex market profitable. When I mean volatility, it means it has good movement. It has good movement. Okay, so another thing that makes the forex market the best market among, that's for us, for me, what makes forex market the best market is that it is liquid. That means it has volume. There's no time that you place a buy order and someone is not there to sell. Whenever you click, you place a buy. All right, so it is liquid in the sense that it has high liquidity, in the sense that if you are selling, someone is there to buy. If you are buying, someone is there to sell. So at any time you are placing the trade, there is liquidity in the market to accept your order. So it's not like the stocks market that sometimes you place the trade, you take some time before the trade opens. All right, so the forex market is very, very liquid. So let's give an instant, for example. Let's give an instant of a tourist traveling from America to Nigeria in 2015, and he has with him $1,000. Okay, you know what basically happened 2015 in Nigeria? So when he gets to Nigeria, he exchanged the $1,000 he had at an exchange rate of $1 equals to 150 naira. That will mean that he now has 150,000 naira, because 1,000 times 150 is equals to 150,000 naira. So he now has 150,000 naira. Let's say that he doesn't use that money. So this is the question now: what is his profit or loss if by chance he didn't spend the 150,000 naira he exchanged, and is to change it back to dollars at a later date in 2015, where 1 naira, you see the price has changed. Okay, the previous price in which he bought was at $1 equals to 150. Okay, now $1 is equals to 300 naira. So it will now be 150,000 naira he has. You want to change it back to dollars, equals to that divided by 300 is equals to 500. All right, so he is now with $500. Meanwhile, initially in 2015, he had brought $1,000 to Nigeria. So he has lost some money. Why? Because he saved his money in a financial asset that does not grow in value. All right, so in the forex market, that's why naira is not in the forex market, because the Nigerian economy is not as strong and as stable to flow in the financial market that's in the forex market. Our economy is not yet very stable flow. So but however, let's say somebody had this scenario had happened, the man has lost 50% of the money he initially started because he saved his money in a financial asset that does not grow in value. So how will he have averted this loss? How would the tourists have avoided this loss? He had the information about the impending lose of value, which is recession that hit the Nigerian economy. What was he supposed to do? So the idea there is that he will have stored up his value in a superior currency. He will have stored up in his value in a superior currency, which happens to be the United States dollars. So if he didn't exchange the $1,000 he had in 2015, he left it in dollars, it will mean that at a later date in 2018, when he changed the money to naira, for example, he will be with 50% profit. Why? Because the value of the United States dollars has added, all right, over the Nigerian naira. So whenever one is going up, obviously another one is going down. All right, whenever one is going up, another one is going down. So you see, if he had exchanged it in 2015, he would have made 50% gain than if he had exchanged it in 2015. So how you make money in the financial market is by buying value, buy the particular currency that has the potential of growth. All right, you buy that given a period of time. So you don't buy the one that has a potential to decline, because whenever you buy a particular financial asset that has the potential of decline, you are going to lose money. That is basically the way to lose money. But you cannot be sure, you are not God. How do you know that the particular financial asset is going to grow, that's going to add up, or is going to go down? That is why we are teaching you what we are teaching you now, because we are going to teach you the fundamentals. Those are the things you are going to be looking in an economy, because the value, whatever is happening in an economy, is what determines what their financial asset is going to be worth. All right, whatever is happening. So the major indicator to know is whatever is happening in the economy of that particular country, because that's what at the end of the day is going to determine what the financial asset of that particular economy is going to be worth. All right, so now let's talk about the history of money. All right, the history of money. So money started by trade by barter, where we have to exchange a particular commodity for another commodity. All right, so if I have a laptop, for example, and I need a bicycle, and you have a bicycle, we'll just simply exchange the bicycle for the laptop. All right, but the problem with trade by barter was that the value of the goods exchange was not necessarily approximate. So there were clashes, there were issues. I give you this kind of big thing, and then you are giving me so small. Understand? So there was need for us to advance. Okay, so there were time we now advance to the stage where we use cowries, manila, and other forms of what we were looking at that time as money. You know, generally it is humans, that's me and you, that give value to money. Okay, there is no major difference between 5 naira and 10 naira. All right, there's no major difference. They are made of exactly the same material, but we're the ones that say, because we are humans and we are rational beings, we say, okay, 5 naira is different from 10 naira. Why? Because we made the decision to look at them in that way. Okay, so we are the ones at the end of the day who give value to a particular thing. Okay, so money is nothing more than a piece of paper that value has been given to. All right, so we give value to cowries and manila. So we're looking at it as a means for exchange for goods and commodity. Okay, so it was a means for an exchange of goods and commodity. That's obviously the definition of money. So it was not still good, because cowries and manila were something that was very common, and money has to be scarce. For money to have value, it has to be in a way scarce. Okay, so now there was need for us to look for scarce commodities such as gold, precious metals like silver, diamond, and all of that. Those were scarce material, and they were alluring. That means they were good. They were good for us to see. So people now attached a lot of value to gold, precious metals, and silver. So that became money. All right, that became money for the majority of the world. All right, but the only problem with this was that they were too big. They were too large for people to handle. All right, they were too big and large for people to handle. So if I was a rich man now, I'm a billionaire, for example, I will have to be carrying my gold, and the gold would be in maybe in bags. All right, it's too much, and it was not easily transferable. So we cannot transport the amount of gold I have, that's the value I have, from one place to another. It was not easy. So there was need for us to go further than that. That was when we now came to the point where we now have coins. All right, coins. So but coins basically had the same problem, but the advancement there was that the coin, the material used to produce the coin, determined the value of that particular coin. All right, the value for that particular coin. So if it was copper that was used to produce the particular coin, for example, the value would not be as much as a gold coin. All right, so that was a major advancement. Okay, that was a major advancement, but it was not still, the problem of transportation was not still settled, because the coins were not favorable in terms of transportation from one place to another, and they were too heavy, and they were just not the right option. Okay, there were lots of problems. If you had a lot of coins, people will easily know, and they will want to attack you. That's criminals. They may easily, if you say, okay, I'm a rich man, and you are traveling from one place to another with your bag of coins, people will easily know that that's money, because they'll be hearing the sound. And there are various ways why coins was not the best way for us. Okay, so there was need for us to advance from coins to paper money. Okay, but paper money as we know it today started in China. All right, started in China when the emperor of Europe then was like the world power. All right, Europe was like the world power. So when the emperor of Europe went to China, he discovered that the Chinese were advanced, and they started putting value, because at the end of the day it is you and me that determine the value of a particular thing. Okay, so they started attaching value to paper. All right, so he now adopted it, and they were like the world power, so it's widespread around the world. All right, so that was how the invention of paper money, the dollars, the naira, and every other thing that we have today came about. Started in China. So now, but you can agree with me that we have now even graduated from paper money to cashless economy, where the value of a particular product or services is determined by an online system. Okay, you could just type your phone and pay for a particular commodity, and you get the commodity is yours. All right, so we are now going into cashless, or we are now at that stage of cashless economy. All right, where you don't need money to even travel, you don't even need, because of the invention of banks and all of that, you don't really need to, transfer yourself, that's transport your money from one place to another. All you just need to do is to have your money in a particular bank, and then you have a cashless app that you can make transactions for any goods or service. So we have even gotten to the stage of cryptocurrency. The forex market, as I said earlier, is not the only type of financial market that we have. We have a host of many other financial markets. So they consist of the insurance market, the foreign exchange market, the one we deal on, and the commodity market, the bonds market, the stocks market, the money market, the derivative market, the futures market. So the insurance market is a market for insurance policy. Okay, just as how we exchange foreign currencies in the forex market, we exchange insurance policies in the insurance market. So in the foreign exchange market, it's basically a market for financial assets of various economies. So the financial assets of various economies are basically traded in the financial market. All right, so the forex market can be subdivided into two. Okay, we have the spot trading, that's trading at the spot, where currencies are traded at the spot. All right, and then we have the consumer market, where goods and services are paid for. That's goods and services that are exported and imported into a particular economy are basically paid for in the currency of that economy. All right, so those are the two kinds of foreign exchange market that we have. So we have the commodity market, where commodities such as crude oil, gas, natural gas, diamond, silver, and a host of many other commodities are exchanged in this particular market. So we have the bond market. An example of the bond market is treasury bills. A bond market basically includes a bond which is a form of debt that involves the relationship between a debtor and someone who is indebted. All right. So in the bond market, what is being exchanged, that's the basic commodity of the bond market, is debt. All right. So when you invest in treasury bills, what you are basically doing is that you are giving the government loan so that the government will invest into whatever they want to invest with your money and basically gives you return at the end of the day. So the bond market characterized of exchange of debt. All right. What we basically trade in the bond market is debt. If we talk about stocks market, it's a market that where the stocks or the shares of a particular company are being traded. All right. The shares of a particular company are being traded. So if you have shares in Apple, it means that you have a part of Apple. All right, not the entirety of Apple, but you have a part of Apple. So the stocks market is where shares of a particular company is being traded. So we have the money market. The money market is more like the bond market, but the only difference here is that the debts that are involved in the money market have a characteristics of quick expiry, and they also have a characteristics of volatility. What I mean by that is that there's movement in the money market, and then the debt have quicker expiry. Right, so it's a debt between two organizations, which may be a bank and an institution. The bank is giving loan to that institution, and it's expected and that institution will return the loan with interest given the period of that is very, very short. Okay, so it has shorter expiry. So we have the derivative market. The derivative market is a market for derivatives. All right, as the name implies, derivatives. So in the derivative market, the actual product are not being sold or are not being exchanged. Rather, the derivative of that particular product is what is being exchanged in that particular market. All right, even the foreign exchange market has its own derivative part of it. Okay, so we might have dollars now, for example. They say $1, and then we now have a piece of paper. We may say this paper represents $1. So in the derivative market, what we are exchanging is not the physical $1. We are now exchanging a derivative of $1. So whatever basically happens to $1, if it's going up in the derivative market, the value of that paper is going up. All right. If it's going down, the derivative, also the value of that derivative is going down. All right. So it's not a market for the actual commodity, but it's a market for the derivative of that particular commodity. So we have the futures market. The futures market is a market for futures contract. What does that mean? A futures contract is an agreement between two parties to sell a particular product at a given price at a certain period of time. One of the major things that the futures market does is that it clears out uncertainty. How does the futures market clear out uncertainty? Very, very simple. Now I'm a farmer, for example. I want to plant rice. I've not planted the rice yet, but I'm worried that as of the time that I will be harvesting my rice, probably that could probably be rice season. Okay, it could be rice season. So the value of rice may go down because of the supply of rice is enormous. All right, and you know law of demand and supply. When the supply of a particular commodity is in excess, the price goes down. Okay, so I'm worried that I might lose. All right, I might lose what I've invested in the planting of this rice because of supply, and I go into what is called a futures contract with a particular company that buys rice to buy or to sell my product, which is rice that I've not even planted in the first place, at a given price, which is comfortable for me and the company. All right, so it clears out uncertainty. So I don't have to worry that so date when it is time to harvest rice, I'll be worried about the price I'm going to sell the rice at. So it clears out that uncertainty. I now have a fixed price. All right, I'm going to be selling my rice. So it doesn't matter what happens, whether rice is bad, whether this is that or that, doesn't happen. So remember, I said in all of this financial market, it's a zero-sum game. And when I say it's a zero-sum game, one person must be a winner and the other must be a loser. Okay, so how does the rice farmer now is the winner? It's very, very simple. It's a scenario where if he is selling rice at a particular price in the future, and it gets to that time and the real price for rice, all right, that's in the market is lower than expected, obviously the farmer has made more profit, because before that date he had already gone into a futures agreement with a particular company to sell his commodity at a given price. All right, so it's a winner. So how can now the company be the winner? It's when the price of rice in the normal market is more than what they had agreed. Okay, so the company will be happy because they are now buying rice at a cheaper price than they would have bought if they were buying from the normal market. Why? Because they have gone into a futures contract with the farmer. So the futures contract is basically there for the purpose of clearing out uncertainty. So let's move forward. So let's talk about market participants. All right, who are the market participants in the forex market? Who are we up against? I'm basically classified as retail traders. All right, that's me and you. What I'm about to teach you is how to retail trade. All right, that's how to trade as a retail trader, because you're not trading for individuals and institution, you are trading for yourself. Okay, so other market participants are the commercial banks. So basically the banks use your money to trade forex. All right, the commercial banks, the central banks. If you are really somebody that follows the news, you discover that the Central Bank of Nigeria are always talking about their forex funds and all of that. So the central banks of each of these countries, they trade forex. All right, they exchange currencies from one form to another. So the currency they are buying obviously will have more value than the currency that is being sold. All right, because demand is what moves the forex market. So we have large corporations. There are big corporations that are involved in maybe export and import of a particular commodity. So they are participants. They are the ones that can drive the forex market. So they are market participants, because by their demand for a particular country's financial asset, by means of maybe they want to buy a product from that particular country, so the demand country's financial asset can increase the value of the country's financial asset. All right, so large corporations are also market drivers. They are also market participants. So we have investments and hedge fund managers. So how are they participants in the financial market? They are participants because they invest a lot of money. They are the ones that are into direct trade. They manage funds for people. All right, people make investment into hedge funds and investment portfolios. All right, and then they basically trade for them and make money. In countries like America, people may not be educated about how the financial market works. So we have legal people, that's the hedge fund managers, that collect their money and trade for them. Okay, so now we have individuals, which are retail traders, and then forex companies. Okay, so these are the market participants. So these are the people that move the forex market by demand and supply for a particular financial asset. So now let's talk about the characteristics of currencies traded in the financial market. So now the first characteristics, that's the first thing you will notice about the currencies traded in the financial market, is that they are traded in pairs. All right, they are traded in pairs. We cannot have Nigerian naira. How is that trade going on? It has to be Nigerian naira US dollars. It has to be euro US dollar, for example. So the first currency pair, that's if you are saying Nigerian naira versus US dollars, the first one you mention before the other is called the base currency. Like for example, now we have the euro US dollar. So which one is the base currency? Euro, because you want to say euro USD, you first mention euro before USD. So the currency by the left, all right, is the base currency, while the other one is called the quoted currency. So now if we say we are exchanging 1 naira to dollars, all right, the naira there is, that's, we want to see now the exchange rate of $1 is equals to 360. $1 there involves the base currency, while 360 is the quote currency. So if we were to pair those two currencies, we'll have something like USD NGN. All right, because the first one we mentioned was dollars before we went ahead to mention the naira. So the first pair you call, that's the first currency rather you call before the other, is called the base currency, and the other one is called the quote currency. So another characteristic of the currencies traded in the financial market is that it is liquid. It has high liquidity. There's high movement. Liquidity can also be volatility, because volatility actually means movement. All right, but liquidity means there's enough money, there's enough strength to keep this market afloat. Okay, so it is high because the exchange rates are always changing. All right, you will look at a particular currency, like a currency pair like the euro US dollars. You see that if you look at our chart, basically it's always moving. Why is it always moving? Because the currency, that the exchange rates are always changing. They are never stable, because demand and supply are not static. they are never balanced. So therefore the currency, that's the exchange rate, are also not balanced. They are always changing alongside with demand and supply. So let's talk about how a currency pair work. Well, we have already talked about that. We have the base currency, which is the euro, then we have the code currency, which is the dollar. All right, so let's talk about the major currency pairs. So what are major currency pairs? Major currency pairs are pairs that contains the US dollars. All right, so if you hear somebody say I'm trading a major currency, what the person is simply saying is that he's trading a currency that has the US dollar. All right, so we have examples of the major currency pairs we have in forex are the euro US dollars, USD JPY, the GBP USD, USD CAD, USD CHF, and AUD USD and NZD USD. So those are the major currencies. Okay, so we have the minor currency pair, or otherwise called crosses. Okay, so crosses are basically pairs that do not contain the US dollars. All right, so we have example of the crosses that we have in forex are the euro GBP, the euro CHF, the euro CAD, the euro AUD, the euro NZD, the euro JPY, the GBP JPY, the CHF JPY, the CAD JPY, AUD JPY, NZD JPY, GBP CHF, GBP AUD, and GBP CAD. So these are the major crosses that we have, and if you observe, they don't have the United States dollars in them, so they are crosses. Okay, so we have another one which is called exotic currency pairs. So exotic currency pair are made up of one major currency, and then they have an emerging or a seemingly strong economy. All right, when I say seemingly strong, I mean economies that are not yet developed. All right, so they are not stable economy. So examples are that of the euro TRY, that's the euro Turkish lira, and the USD SEK, that's the US dollar Swedish krona, US dollars NOK, US dollars DKK, US dollars ZAR, US dollars HKD, and US dollars SGD. All right, so exotic currency pair are currency pairs that are made up of one stable economy, one major currency pair, and then the other one is an emerging or a seemingly strong but smaller economy. All right, so that are what the exotic currency pairs are. So when we talk about reading an FX code and taking a sell or a down bias, simply means that reading the charts, okay, reading a forex chart and then taking a buy or a sell decision. Basically what we are doing in the forex market is that we are speculating. When I say speculating, we are trying to forecast, just like a weather forecaster is forecasting that rain is going to fall. Rain has not fallen yet, but because of what he sees, he's forecasting that rain is going to fall. All right, or just like somebody who is speculating on a football match, okay, speculating on a football match, the match has not yet happened, but he's simply just saying, okay, based on what I can see, these people is going to win. So it's not gambling, because when we are speculating in the financial market, we have things that we are seeing, probably news event. When it comes to fundamental trader, news event that we have seen that happen in a particular economy that obviously spells doom or glory for a particular economy, but whatever is affecting a particular economy will affect the financial asset of that particular economy. All right, so when we talk about reading an FX code, it simply means looking at where price is, okay, knowing what the price is going to and trying to speculate on what the price is going to do. All right, so that's what reading an FX code is, and you are taking a decision. So let's talk about what buy and sell really means. So we have a currency pair now like euro US dollars, for example. If you click buy, you are speculating that the euro is going to go up. That's the value of the European euro is going to go up given a period of time, all right, against the US dollars. That means it's going to do better than the US dollars given a period of time. So that's why you buy. So remember, the aim of trading forex is to buy low, all right, buy low, sell high. Okay, buy low, sell high. So now I usually tell people something very contradictory, that in the forex market we only buy, we don't sell. All right, what do I mean by that? When you click the sell button, You are simply buying the US dollars. You have a currency pair like Euro US dollars saying on your screen. If we click sell, what we are simply doing is that we are buying the dollars and selling the euro. Alright, so we are exchanging the euro we have to dollars. So we are buying the US dollars with the euro we have. Okay, so when we click buy, we are exchanging the US dollars we have to euro. Alright, so we are speculating that the price, that's the value of the European economy, which happens to the euro, is going to rise in terms of price over the United States dollar. So whenever we click on sell, we are trying to speculate that the United States dollars wants to do better than the euro. So when we click on the sell button, we are taking a decision that we want to sell all the euro we have and convert them to dollar. Since this is the exchange market, we are exchanging all the euro we have and we are exchanging it to dollar. All right, with the hope that the dollar is going to do well. All right, between the base and the quote currency. So that's what that actually means. So let's talk about buy and sell. All right, let's talk about buy and sell in details. I also want to do a simple explanation. Okay, in the forex market we make money from buying and selling. All right, if you click a buy, all right, you are simply buying a particular country's financial asset at a given price, speculating that it's going to, as the value of that particular country's financial asset is going to go up. All right, so it may happen, it may not happen. So if you are working with a good strategy like the one we are going to be teaching you, you are about 70% of the time is going to happen. You're going to make money. Okay, so the aim is to make more money than you. That is to be right more than you are wrong. So that's the aim. Okay, so in the first market you can make money from buying or selling particular financial assets. So how do you make money from buying a particular financial asset? Because when you buy a particular financial asset, you are speculating that the value of that particular financial asset is going to go up. All right, so when you sell a particular financial asset, you are basically speculating that the value of that financial asset is going to go down. All right, so that's why you are exchanging. When you say sell, you are selling that particular financial asset to buy another financial asset. Okay, so when you are buying the particular asset, you are actually selling another financial asset to buy that particular financial asset. So in the forex market we are always buying and selling. Okay, so how do you make money from buying? Let's forget about forex now. Let's go down to as low as someone who is selling bread. Okay, for me as a business person to make profit, all I just simply need to do is to buy at a lower price, okay, and come and sell at a higher price. Okay, so we have cost price and then market price. So I'm making profit from buying and selling. So now how do I make money from selling? How we make money from selling in the forex market is simply by taking a loan. Alright, so when I say taking a loan, how do we take a loan? All we just simply need to do is, now we are talking about bread market here. Okay, we're talking about the bread market. So now you heard by chance, that means you have an information that the value of bread want to reduce. That means the standard price of bread want to reduce, but it has not reduced yet. Okay, what you just simply need to do is to go and borrow more money. Let's say you were using 300 naira to do your business. All right, you were buying bread 100 naira each, and you come and sell at 200. All right, so you are making 100% return on investment every time you buy. Okay, and come and sell. So now you have heard an insider information that the price of bread wants to go down. So they want to reduce the maximum price. The regulatory bodies want to reduce the maximum price of bread to 100 naira static. Nobody should sell bread at 200 naira again. Okay, but they have not done that yet. So what you simply do to make money from selling, is that you simply borrow money from people you know and buy bread at 100 naira. Okay, you buy bread at 100 naira, which was the normal price you usually buy, and then you quickly rush and sell that bread at 200 naira. All right, so that you will not be caught up with the scenario where they have reduced the price of bread. That's the static price now will be 100 naira. Okay, so now you just simply rush, bought the bread, the amount of bread you want to buy, and you make profits. Like you borrowed 1000 naira, for example, and then you sell bread at 200 naira for each of the bread you bought. So you are now ending up with 2,000 naira. Okay, so now when the price of bread reduces, normally you'll be buying bread at maybe 17 naira to sell at 100 naira. You don't make as much profit as you taking that loan to put and then do this business. So that's how you make money from buying and selling. So let's talk about forex terminology. Right? Like, if you want to be a medical doctor, you need to know the technical terms of medicine. If you want to be a lawyer, you need to know the technical terms of law. Alright, so that when you talk, someone is going to identify you as a doctor or a lawyer. Alright, so if you want to become a forex trader, you need to know the technical terms of forex. Alright, you need to know what a pip is, you need to know what lot size is, you need to know what pip value is, you need to know entry, leverage, volatility, quote, bid, ask, spread, currency pairs, exchange rate, equity, used margin, free margin, margin call, entry, position, and other tabs. Alright, so what is a pip? Alright, what is a pip? A pip is a measure of price movement in a certain direction. Alright, we all know that there are two directions in the forex market. It's either the market is going up or it's going down. So a pip, it's more like a measure of how far the market has gone up or how far the market has gone down. So take for example, now we have a tailor, all right, and the tailor is to measure the length of a table. After measuring the length of a table, you could say that the table is 10 meters long. All right, so in forex we use pips to as a unit of measurement for measuring the length at which price has gone, all right, in a particular direction. So if price has moved 10 centimeters long, if we were using a centimeters ruler, in forex it is 10 pips long. All right, so what can be added to that is that a pip is the fourth digit after the decimal point. It is the fourth digit after the decimal point. We have a quote like 1.2550 that we say price move from 1.2550 to 1.2551. That means price moved 1 pip, because a pip is the fourth value after the decimal point. Okay, so there's an exception to that. That's in currency pairs that have the JPY. All right, currency pairs that have the JPY, a pip is the second value after the decimal point. What I mean to say is that if we say 86.51, price moved to 86.52, that means price moved by 1 pip, because there is a 1 pip change, all right, from 86.51 to 86.52. So it's the second value after the decimal point in rare cases where we have the JPY. All right, so when we talk about fractional pip it's the fifth value after the decimal point. It is not usually included in a quote. All right, it's not usually included. Why it's not included? It is just an extra detail. All right, so when we talk about lot size, all right, a lot size is your risk or reward given each pip movement. That means if the market is moving in pips, each of those pips, what are they really worth? It's your lot size that's going to determine the worth of 1 pip. You understand? The worth of 1 pip. Alright, so if we use a lot size of 0.01, for example, that means each pip movement 0.01, each pip movement is going to be worth 1 cent, because 0.01 in the forex market means 1 cent per pip. Alright, and the lot size you decide to use is according to your account size. Alright, because your lot size is what you use as your risk management tool. The smaller your account, the smaller the lot size you use. The bigger your account, the bigger the lot size you use. Okay, let's talk more about that. So we have various types of lot size. We have the lot size of 0.01 to 0.09, which signifies 1 cent to 9 cents, and it is classified under what is called mini lot. All right, so we have the lot size of 0.1 to 0.9, which is $1 to $9, and it is classified under what is called micro lot. All right, we have 1.0, which is $10 per each pip movement, and it is classified under class to infinity, and it is classified under what is called macro lot, big lot. All right, and it's based on your account size. Remember, this lot size you decide to use must be based on your account size. All right, you will not have to use the account size that is not convenient for a macro lot. All right, you don't ever try to use a macro lot on an account size that requires a mini lot. Take for example, now you have an account size of $100, all right, and you are using the required lot size, which is 0.01 cent per pip and to 9 cent per pip, around that amount. So if the price, this is your entry, okay, this is your entry, and then this is your take profit, where you are ready to book profit. That's you are ready to collect profit out of the market. All right, and then this is where the level of your acceptable loss, where you are able to say, okay, the market is not going in my favor. Can I come out at this point of 5 with the loss that I've already acquired? All right, so let's say this was your entry, 3 was your entry, and the market moved up until 1. That was 10 pips. All right, that would mean that if you were using a lot size of 0.01, it will mean 0.0, that's 1 cent times 10, which is equals to $1. All right, so if the market goes against you, that's your risk. Now if it goes against you, it's going to be minus 1 cent per pip. So, and it went against you, let's say for example it goes against you by say 10 pips. That means you're going to times, your loss is going to be 0.01, which is 1 cent times 10. You're going to lose $1. All right, you're going to lose $1. But if it goes in your favor and hits your take profit, you're going to gain 0.01, which is 1 cent per pip times 10, which is $1. That's what lot size is all about. So now let's talk about pip value. What is a pip value? All right, I want to let you understand something. The fact that $1, 0.01 is equals to $1 per pip on the currency pair called Euro US dollar doesn't mean that on another currency pair, such as the USD JPY,
it's going to be worth exactly that same amount. All right, so the pip value shows you how much one pip is actually worth. All right, according to the various currency pairs that we have. All right, so for Euro US dollars, one pip, that's 0.01, may be worth $1. But for USD JPY, 0.01 may be worth 85 cents or 90 something cents. So a pip value just shows you how much one pip is actually worth based on the particular currency pair.
So let's talk about leverage. All right, what we are basically doing when we open a broker's account and trade in the forex market, we are basically doing what is called leverage trading. Leverage is defined as profiting from what you don't own. Say for example you have $500 in your account size and you use a leverage of 200:1. That means for every $1 you have in that your $500 account, it equals to $200. All right, you are increasing your capability to gain more by doing that. That means if you can take a position as though you have $100,000, all right, you can take a position as though you have $100,000. Meanwhile, in real sense, you have $500. Okay, so if you use a leverage of 200:1, it means for every $1 you have in your $500 account size, the broker is magnifying it to $200. All right, so if you can take a position, it gives you the ability, it gives you the opportunity to take a position that is much higher than your account size will have on a normal basic handle. So why you use leverage is basically to magnify your gains using a smaller investment. That this is because of leverage that someone can turn $100 account to maybe a $1,000 account within a very short period of time. But leverage is two ways, in the sense that it can be a good thing and it can be a bad thing. It's depending on how you use the leverage that you have gotten, right, from your broker. It can be a bad thing because it can magnify your loss, because if the market is going in the opposite direction, it's going to be minus that lot size you use per pip. All right, minus that lot size you used per pip. So leverage is a good thing and it can either be a bad thing. It's a good thing in the sense that it can increase your gains, it can lead to greater gains on a very small account size. It can be a bad thing in the sense that it can magnify your losses. Alright, so let's talk about volatility. When we talk about volatility, we are talking about movement. When you say a particular financial asset is very, very volatile, what we are simply saying is that that particular financial asset has a lot of movement. Alright, and volatility is really, really important. For you to know the volatility of a particular financial asset is really, really important, because there are some people, according to the kind of trader that you are, you might want to trade a currency pair that has higher volatility. Alright, according to the kind of trader that you are, you might want to trade a currency pair that has lower volatility. Okay, that's lower movement, it's fairly stable. Alright, you want to trade, maybe you're a scalper, you want to trade the one that has higher volatility, prices are just moving up and down, alright, everywhere. So now let's talk about quotes. Alright, a quote basically consists of two figures. Alright, two figures, and those two figures are the buying price and the selling price. Alright, the selling price is otherwise called the bid. Alright, the buying price is otherwise called the ask price. So what is the ask price? The ask price is the price at which a buyer wants to buy a particular financial asset. Alright, this is the price which a buyer of a particular financial asset wants to pay for a particular financial asset, while the bid price, which is the selling price, is the price at which a seller wants to sell a particular financial asset. Alright, so now the difference between the bid price and the ask price, as the buying price and the selling price, is what is called spread. Alright, and spreads are calculated in pips. Alright, so, and they are also considered as brokers' charges. They are also considered as brokers' charges. Before you begin to profit from a particular trade that has a 2 pip spread, the market has to move at least 2 pips before you now start seeing profit in your trading account. Alright, so let's move further. Currency pairs. I told you that the forex market is not traded as the stock market, in the sense that it is traded individually. Alright, the forex market is rather traded in pairs. Alright, we don't have stocks of Apple, we don't have stocks of maybe Netflix and all of that. In the forex market, we have currency pairs. Right, the US dollars is pairing with the Japanese yen, or the United States dollars is pairing with the Canadian card, or the euro versus the US dollars. Alright, they are traded in pairs. So now the exchange rate simply shows the exact amount that you're going to be having if you exchange a certain amount of a particular country's financial asset into another. Alright, so if I'm exchanging the naira to the dollars, I know that for every 360 naira that I have, I'll have $1. Alright, so the exchange rate just spells out the price at which a particular financial asset can be exchanged for another. So that's what an exchange rate simply means. So let's talk about equity. The equity simply signifies the total amount you have in your trading account. Maybe the total amount you deposited in your trading account. You deposited $100,000. Your equity is $100,000. You deposited $100. Your equity is $100. So now let's talk about used margin. All right, this is the amount of money that you have in your trading account that is kept aside to keep your position open. That's to keep your trading position open. All right, this is the amount of money that is kept aside by who? Your broker, to keep your current trading positions open. All right, let's talk about free margin. Free margin after we have used margin. That's a certain amount of money that's kept aside by the broker to keep your trading position open. The leftover is called free margin. The leftover that you can use to open further trades, to open new trade, is what is called free margin. What are you free to use, all right, in order to open more trades? So let's talk about margin call. All right, when we say margin calls basically happens when your equity drops to a certain level. All right, to a certain percentage. The broker basically sends you a message, an email, or calls you, all right, and tell you that you need to add more equity in order to sustain your trades, in order to sustain the positions that you have open, because the positions has really diminished your balance. and it's now reading negative. So the broker is a call, it's more like a warning call to a trader that is sent by the broker to either add up to his equity in order to sustain the trades that are on the opened trade. So let's talk about position. When I say I took a position, it means you took a trade. There is nothing more, there is nothing less. When I say I took a buy position, it means I took a buy trade. So we have different kinds of position. We have the long position, we have the short position, we have the closing a position. So now what does a long position simply mean? A long position simply means that you bought the base currency and sold the quote currency. What that simply means is that if I have a currency pair called Euro US dollars and I took a long position, it means I actually bought the Euro US dollars. Alright? It means I bought the base currency and sold the quote currency. So let's talk about short position. When they say short, I short the market, I short the Euro US dollars. Alright, it simply means that you sold the base currency and rather bought the quote currency. What that simply means is that you sold, let's say for example you have Euro US dollars and you say I short the Euro US dollars. It means you sold the Euro US dollars. Alright, so when you say close a position, take for example you have an open position which may be a buy position or a sell position, or in other words a long position or a short position, and they say close a position when you are closing a position either with profit or a loss. So when they say you enter the particular position and then you are closing, you are going out of that position. So that's what a closed position actually means. So let's talk about the different other types that we have in the financial market. So we have other types, alright. When we talk about open and order, it's otherwise called market execution. That means you are ordering the broker to open either a buy trade or a sell trade. Alright, so we have different types of orders. Alright, we have the limit order, we have the stop entry order, we have the take profit order, we have the stop loss order. So I'm going to be using representation to further explain what a limit order is, a stop entry order is, a take profit order is, or a stop loss order is. Okay, so a market order or market execution order is an order to buy at the current price at which the market is. Take for example, the market is going up and then I call out a signal to say market execution, buy now. I'm simply saying that you should buy at the price which the market currently is. Or if the market is at 5, alright, you buy at 5. If the market is at 6, you buy at 6. If it's at 4, you buy at 4. So a market order is an order in which it's an order to buy at the current price at which the market is. So we have a limit order. We have two types of limit order. We have a sell limit or a buy limit. Alright, and they fall under what is called pending order. Pending orders are orders that are not yet open. Alright, they are orders that are not yet open, but they are pending. They are waiting for the market to get to those positions so that the orders become open. So we have two basic types of pending order. We have the limit order and the stop entry order. So under the limit order, we have two kinds of limit order. We have a buy limit or a sell limit. So what does the buy limit mean and what does the sell limit mean? So we have, for example, you have entered, a sell limit order is an order to enter a particular trade, all right, at a level or at a price where the market has previously passed. So the market started at 3 and the market has passed 4, all right, at even passed 5, all right. So a sell limit is an order to the broker to sell a particular financial asset if and only if the price returns back to a level it has previously passed. Okay, to a level in which it has previously passed. So the market started at 3, went down and passed 5, all right, and it is now at 6. And you place a limit, a sell limit, which is an order to to the broker to sell a particular financial asset if and only if the price moves back to 5. Right? So that's that. So the same, it's for a buy. It's an order. Let's say the market is going upward, right? Let's say the market is going upward and has passed a certain level. Say it has passed 3. It's an order to buy if and only if the market retraces to 3 or retraces to a level which the market has previously passed. So it's a pending order. It's an order that has not been triggered yet, but it's an order that if the market retraces to a level that it has previously passed, the broker should open a buy or trade for you. All right. So we have stop entry orders. Right, stop entry orders are divided into 2. We have the sell stops and the buy stop. The sell stop is an order to the broker to sell a particular financial asset, all right, when the price gets to that particular level. All right, the price, when you place the order, the price has not gotten to that level yet, but you are ordering that even though I'm not around, when the price gets to, let's say 4 or is it 3, let the broker automatically opens a sell trade. All right, so now we have a buy stop. A buy stop is an order to the broker to buy at a certain level in which the market has not gotten to yet. So it's an order to buy at, let's say 4. The market has not gotten to 4 yet, but whenever the market gets to 4, whether I'm there or I'm not there, the broker should open an order, all right, to the buy side. That's a buy order. So now we have stop loss. Stop loss. Stop loss is the level of your acceptable loss. Right? The level. It is the level at which you want to go out of a trade that is not going in your favor. Let's say this was your entry. I'll signify that by E. And then this is your stop loss, S. And then this is your take profit. Alright? This is your TP, your take profit. Now, after entering here, the market you are entering for a sell position. Right? The sell position means you are forecasting that the market should go down, but rather the market did not go down, it rather went up. Right? So 12 is the limit at which you want to come out with a loss. It's a level of acceptable loss. You say, okay, the market did not go in my favor, I can come out at 12 with a loss. All right, so let's talk about take profit. All right, so let's say this is your entry, this is your stop loss, and then this is your take profit. Now, take profit is where you want to book profit. When I say book profit, it's where you want to collect the profit you have made. You want to balance. You want to now take the profits and add it to your balance. Let's say you had an entry at 13, right, and the market did not go. It went in your favor. It did not go against you. It went in your favor and hit 15. All right, 15 now is your take profit. All right, a level at which you have set, all right, for the price to book profit. That's to collect profit, to bank profit out of the market. All right, so it's your take profit level. So those are the different order types that we have in the financial market. So let's talk about market execution. All right, it is the process of completing an order. When you place an order, it is sent to the broker who decides to fill it or reject that particular order or report it. So once your order is filled, you will receive a confirmation from your broker. All right, you receive a confirmation from your broker. If your order is rejected, you receive a confirmation from your broker that your order was rejected. All right, so it is the process of completing an order. You executed a particular order, either a buy trade or a sell trade. So let's talk about success in forex. Success, not just only in forex, in every business, begins with your mindset. All right, you have to change your mindset. All right, so we have two kinds of mindset that determines either success or failure. We have the growth mindset and we have the fixed mindset. Right? The growth mindset sees failure as an opportunity to grow. All right, it sees failure as a stepping stone. All right, and then the growth mindset also says I can learn to do anything I want. He believes in himself. He has to say I can learn to do any single thing that I want. All right, you see, a growth mindset sees challenges as a way to grow. All right, he doesn't see challenges as a stumbling block. Rather, he sees it as a stepping stone. He sees it as a way to grow. All right, so for you to be successful in the financial market, in the forex market, you need to see challenges as a stepping stone, as a way to grow. All right, my effort and attitude determines my ability. All right, someone that has a growth mindset believes on his effort, the effort he puts in to learn the particular forex trading. All right, so if you don't put an effort, you are not going to see result. So your effort and attitude towards learning this subject matter, which happens to be forex, is going to determine the result you are going to get at the end of the day. All right, so you need an effort. Sorry, you need you need to take action in order to, because I'm not going to be the person that is going to be placing the trades for you. All right, so you need to take action. So before you take those action, you need to backtest a particular strategy. All right, and all of that. So feedback is constructive. Whatever anybody has to say about your progress or about you, it's their business. All right, feedback is constructive. I am inspired by the success of others. Someone that has a growth mindset will not be jealous that somebody is doing better than him or her. All right, so he rather sees the person doing better as an inspiration for him or her to do better. All right, I like to try new things. Someone that has a growth mindset likes to test, likes to try new things, is always searching. All right, is always searching. All right, not for the holy grail, not for something that does not loses, but rather for something better. He's trying to improve. He's very, very creative. Right. So now we have the fixed mindset. The fixed mindset sees failure as a limit of his or her ability. He sees failure as a stumbling block. Someone that has a fixed mindset believes that I'm either good at it or I'm not. It's either I'm good at forex or I'm not. Alright. So someone that have a fixed mindset will say my abilities are unchanging. That means he does not believe in himself. He believes that whatever he can do, that is the best he can do. He cannot do any further. He cannot do any better. Alright. His abilities are unchanging. So I do not like to be challenged. If you don't like to be challenged, then this business is not for you, because 80% of the time the business is going to challenge you, the market is going to challenge you. So if you don't like to be challenged, if you don't accept challenges as an opportunity to grow, the mistakes that you make that causes you to maybe lose a certain amount of money, you should see that as a stepping stone, because you have a growth mindset. I want you to have a growth mindset. But if you have a fixed mindset, you will not you will be you have what is called you have what is called hate for challenges, which is not very good. So I can either do it or I can't. So my potential is predetermined. He believes that everything that he can do is already determined. Right. When I'm frustrated, I give up. You don't have to have a fixed mindset when you're trading forex. You don't give up when you are frustrated, because you're going to be frustrated. Not all trades are actually going to go in your favor, as I said earlier. Most trades are going to go against you, but your ability to maintain your cool, to relax and believe on the competitive edge that your strategy has over the market, that will certainly play out at the end of the day. Alright, that will certainly play out at the end of the day. It's what makes you a successful forex trader. So if you are not frustrated and you don't give up, alright, you continue. That's why my favorite quote is give your strategy, or give yourself enough time so that your edge will play out. Alright. If you are risking too much of your account, you are not giving yourself enough time for your edge to play out. Right? If you are frustrated and you give up, you are not giving yourself enough time for your edge to play out. So feedback and criticisms are taken personal. Right? Someone that has a fixed mindset takes criticism. Somebody wakes up one morning and tells you that forex is not for you. You take it personal. Right? That is someone that has a fixed mindset. Rather, you should have a growth mindset that sees failure as an opportunity to grow. So I stick to what I know. you are not going to grow when you are fixated upon a particular knowledge you have. Right? I have a friend that has this problem. He just believes in what he knows. He doesn't want to change anything you tell him about something, about what he feels he knows. He's not going to take it. All right. So he sticks to what he knows. All right. He sticks to what he knows, which is not good. Rather, for it has to be something that you try new things, because there is always a better way. All right. There's always a better way to do something. All right. And our major aim in the financial market is to minimize our losses and then magnify our gains. All right. Small losses, cut your losses short, let your winners run. That's one very 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 popular quote. So when a trade doesn't go your way, because most of the time trades are not going to go your way. So what do you do when a trade doesn't go your way? Are you going to just dump the position and go the opposite direction, or are you going to remove yourself from the trade, just close the trade, just close the trade and accept the loss? Are you going to get stressed out? Are you going to start complaining how forex is not for you, how this and that, how you are going to maybe commit suicide, or all of that? Are you just going to get stressed out, stressing yourself for no reason? Or are you going to just relax? The right thing to do is to relax and let the trade work its way out. Because before ever having a trading strategy, we must have backtested that particular trading strategy, and then you have known that trading strategy has an edge over the market, a competitive edge over the market. So on the long run, if you don't give up, the strategy is sure to come out with profit. All right. And in Wealth Bank, we have been able to backtest a whole lot of strategies. All right, a whole lot of strategies that have competitive edges over the market. That if you can stick to, even though you're having 10 losing trades, you don't mind. You stick to what you have. All right, your trading plan. All right, at the end of the day, you see that you come out profitable. So let's talk about characteristics of an unsuccessful forex trader. If someone is unsuccessful in a particular field of endeavor, it is obviously because the person has some characteristics. He has some things that he's doing, all right, that is making him unsuccessful. So one of the major characteristics of someone who is unsuccessful in the forex market is that he's searching for a holy grail. He's searching for something that every trade he takes, he doesn't lose. All right, every trade he takes, he wants to be profitable. There is nothing like that. All right, there is nothing like that. Let nobody deceive you that I will give you a system that all your trades will be going in your favor. You're not going to have even one. You're not going to have a single loss. That is a lie, because there's nothing like that. There's no holy grail in the financial market. All right, so absence of proper risk management. The safe trader doesn't properly manages its risks. Every business has some level of risk. All right, so your ability to manage your risks is what is going to give you, is what's going to keep you longer in the market. It's going to keep you long enough for your competitive edge to play out at the end of the day. All right, so if you don't have proper risk management, you're not going to see if that strategy it has a competitive edge over the market, because you're not going to stay longer in the market to find out if that strategy has a competitive edge, because you are taking high risks. You're not properly managing your risks, so you are going to blow your account. So absence of adequate education. How can you become a lawyer without education? How can you become a doctor? How can you become a surgeon without education? Right? Many people feel that they can become a successful forex trader without education. That is not true. All right, that is not true. We need proper education, and it's a good thing that you are here in World Bank Academy trying to educate yourself. All right, that is the first step in the right direction. Emotional discipline. All right, emotional discipline is basically closing the trade when you are not supposed to close the trade, taking your profit when you are not supposed to take your profit. You are emotional to what is happening on or during the course of a particular trade. All right, you have to let the trade run, whether it's going against you or going to your favor. Let the trade run. Don't be scared. All right, don't be scared. So you have to have emotional discipline. You have to discipline yourself. That's what makes a successful forex trader. An unsuccessful trader doesn't have emotional discipline. He cuts the trade anyhow. He just, yeah, that's basically gambling. All right, you're basically gambling. You're just placing trades, coming out of those trades because you don't have a reason for entering those trades. That's why you are entering and coming out anyhow. So you have to have emotional discipline. The number one, if anybody is to ask me, what's the number one thing if someone wants to become a successful forex trader, I will say discipline. All right, discipline. You need to be disciplined to follow some sets of rules. To follow some set of rules. When we talk about trading plan, you're going to understand what I mean by that. So we have 6 attributes of a successful forex trader. What are those things that a successful forex trader is doing that makes him successful at the end of the day? So he has a skill or aptitude. All right. What that means, what that simply means is that he's educated. He has the skill in trading forex. All right. It's not just like anybody that wakes up one morning and want to make millions from trading forex without being properly educated. All right. And then he has a desire to practice. He's hardworking. All right, he's practicing always, morning to night. There are some times that I don't sleep. I stay out through the night. All I'm doing is practicing. He has a desire. He has a passion for practice. He evaluates and knows his risks. All right, and decide whether or not to take that risk. So some people just take trades and they don't evaluate the risks. They don't know how much they are risking if the trade goes against them, or how much they are going to get when the trade goes in their favor. So that is very, very wrong. All right, you need to evaluate. You need to know for a certain, all right, how much you are going to lose if the trade doesn't go in your favor. All right, so you have to evaluate and know your risk. So you have to have and execute a plan. All successful traders have a plan. They have a strategy. At the course of this lecture, we're going to be teaching you a strategy. Your success using that strategy is highly determined by you not just knowing the strategy, but adequately executing that particular strategy, right? Because the strategy is a successful strategy because we have backtested the strategy. It's a profitable strategy. The strategy we have in World Bank, about 3 of them we are going to be teaching you. They are all profitable strategy because personally I have backtested them. So now your ability to adequately not just have the strategy, understand the strategy, but execute the strategy is what makes you a successful trader. So you're able to control your emotion, the emotion of fear and greed. You're able to curtail it. It is a bad thing if you don't have fear. All right, it's a bad thing if you don't have fear. All right, you have to have some amount of fear, but your ability to control your fear, all right, your ability to control it is what matters, because not everybody can see a trade going in their favor and may not have they may not have the urge to cut the trade with the loss, all right, because of fear. All right, but your ability to control that fear and believe in what you have is what makes you a successful forex trader or not. All right, so you have to have enough greed. All right, many people believe greed is bad, but in forex you have to have enough of greed. What does that mean? It means that if a trade is going in your favor, all right, and has hit, and your strategy says it should hit 100 pips, as soon as it gets to 100 pips, take off the trade. Don't let the trade go more than that, because according to your strategy that you have backtested, 100 pips had a competitive edge over the market than other amounts of pips. So there is a high possibility that it might get to 100 pips, 101 pips, and then move against you and even get as far as hitting your stop loss. So you have to have enough greed according to your strategy. All right, so let's talk about your trading plan. All right, just like you have a business plan, the plan for execution of a particular business, so do you need a trading plan when it comes to forex trading. You need to know the exact time frame. You have to have clarity of the exact time frame you are trading. All right, you need to say, okay, I'm taking this trade based on 15 minutes time frame, 1 hour time frame, 4 hours time frame, daily, weekly, and all of that. You have to be sure of the time frame you are using. You are using more than one time frame. You say, okay, I'm taking my analysis from the 15 minutes to 1 hour time frame and all of that. So your trading plan has to have the exact order in which, that's the exact plan in which you need to take a particular trade. Your risk management in forex, we are advised not to risk more than 3% of our capital. Alright, that means for every loss that you have, it should not deplete your capital by more than 3% for each trade. Alright, say if you have $100 account, every trade you take on $100 account should not lose more than $2 to $3, alright, of your trading capital if you have $100 account, because $1 is 1% of your $100 account, $2 is 2% of your $100 account, $3 is 3% of your $100 account. So every trade you take should not lose more than $3. That's proper risk management now. So condition, you need to know the conditions for placing a trade. Is the market in a range? Is the market in a trendy scenario? You need to know the scenarios for placing a particular trade. You need to know the kinds of markets that you are placing the trade. Alright, is it on the equity market? Is it on the currency, the bond, the futures, and all of that? So you need to know, you need to determine the exact entry. Alright, you need to have a plan for when the market does maybe up, down, and left and right, you place your trade. So you have to have an entry criteria. Alright, you have to have an entry reason for every single trade that you take. You cannot just enter any trade because you feel like entering the trade. You have to have a certain entry reason before you enter a particular trade, and all of these are all part of our trading plan that we are going to be giving to you at the end of this course. Alright, so we need to know exactly where you're going to place your stop loss order, or where you're going to be placing your hedge. Alright, since in this academy we teach you what is called hedging, you know exactly where you are supposed to place your hedge. Alright, so according to your trading plan, you know exactly where you're supposed to place your hedge or your stop loss. So your target, where exactly are you supposed to be placing your take profit? Alright, or are you going to be trailing your profit? What trailing simply means is that as the market is going in your favor, you are moving your stop loss and following the trade, right, by a certain degree. Okay, maybe you are following the trade by 10 pips. When the market goes 10 pips in your favor, you bring your stop loss to break even, right, so that if the market goes against you, you are not going to be losing anything. Right? If the market goes 20 pips, you are trailing by 10 pips, remember, so you take your stop loss to 10 pips profit, right, so that if the market goes against you, you have been able to lock 10 pips. That's no matter what wants to happen, because you are trailing your stops, that means you are locking profit. Alright, even if the market goes against you, it's not going to deplete your balance, rather it's going to close with a certain amount of profit that you have been able to lock. Alright, so trailing stop loss actually means locking profit in a particular direction. Maybe the market is going up and you are profiting from the upward movement. You are trailing, you are following the market with your stop loss, and you are locking profit. So you have to have a trading journal. A trading journal is just more like record keeping. What happened today? What happened today affected your trading? What is the exact reason for entry? And how did the trade turn out? Did it go the way you wanted? Why did it not go the way you wanted? So trading journal is really, really important in the sense that it helps you to improve on yourself. There are many things you are going to discover when you keep a trading journal. Alright, it's a journal that basically reflects how you see the market. Alright, your own perspective of the market. So your trading journal may, in the long run, determine the currency pairs that you trade, because maybe USD JPY is the currency pair that you are having the most amount of wins. Alright, you're having the most amount of wins on USD JPY. So you keep, according to your trading journal, you might say, okay, USD, I had success with USD JPY the most amount of time. Alright, so it helps you to improve on yourself. Alright, it helps you to improve on yourself. So you keep your trading data on a daily basis. Alright, you write out what you experience on a daily basis. You write out what you found out on a daily basis. You write out maybe ideas like, if I had entered here, I would have made more profit than where I entered, and all of that. So that's what the trading journal is meant for. So we need to have what is called a confirmation checklist. Alright, what is a confirmation checklist? Confirmation checklist is actually the criteria you are looking for to enter a buy position or a sell position. What are those things that you are looking for. All right, that is based on maybe your trading plan. What are those criteria that you're looking for you to enter either for a buy or a sell trade? Okay, so according to your trading your confirmation checklist, it might be the market has to be in a support level, um, and the market has to do what we call in a World Bank V bounce, or you have to see some candlesticks pattern form. All of those are confirmation checklists. Once you see this thing, you can take a particular decision. All right. So another way of explaining confirmation checklist is like, let's take for example, the market is it's 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 someone who came to pitch an idea to you. All right, and you are the investor. You are an angel investor. All right, the person is pitching the idea to you. All right, now there are things that you are looking for in that person before you will be able to say, okay, I choose you I will choose your business idea for me to invest in. All right, if that criteria are not met, we are talking of money here. All right, there is no how you are going to choose that particular person. All right, so now, why is it that some people just want to enter trades when criteria are not met? Because of impatience. They just want to run into trade, comes out, and basically, all of that. Confirmation checklist helps you to have a reason for entering a particular trade. So if a trade does this, you check. If it does this, you check. And we're going to be giving you a complete confirmation checklist for our strategy. All right, what do you have to see, all right, before you enter a particular trade? Where are you going to place your stop loss or your pending order? All of that are going to be part of what we are going to give you when we teach you the strategy that we have in World Bank Academy. So we're moving forward, and this is basic 2. In basic 2, we are going to be talking about the types of traders. All right, the types of traders. We're going to be talking about the kinds of traders. There's a difference between the types of traders and the kinds of traders. All right, we're going to be talking about fundamentals. We're going to be talking about what moves the forex market. We're going to be talking about the law of demand and supply. The law of demand and supply. So let's move forward. There are basically 4 types of traders. All right, we have the scalpers, we have the day traders, we have the swing traders, and we have the position size trader. All right, we have the scalpers, we have the day trader, we have the swing trader, we have the position size trader. All right, so a scalper is someone who holds onto a position for not more than few seconds or few minutes. All right, he's not willing to stay long in any position, that's in any trade. He basically wants to go in and out of a particular trade and grab small amount of pips or profit, all right, as many times as possible during a day. So a scalper doesn't hold on to a trade for more than a second or few minutes. So he tends to make quick profit out of the market. All right. So there are some time frames. If you want to be a scalper, there are some time frames you have to be trading. Right. Those are the 1 minute to the 15-minute time frame. Right. Because those are where quick moves are really happening. So let's talk about the characteristics of one who is a scalper, because before you become a forex trader, it is really, really important that you choose the way you want to trade the forex market. All right. Most people have various characteristics that is leading them towards scalping. Most people have various characteristics that are leading them towards swing trading. Most people have various characteristics that lead them towards position size trading and all of that. So if you want to be a scalper, these are the characteristics, all right, that you can see in yourself that you say, okay, I want to be a scalper. So you like fast trading and you are an excitement, all right. You like trading very fast. You like to be in and out of the market very fast, all right. You don't mind being focused on your chart for several hours. You can be on your chart for 12 hours, 5 hours, 4 hours, and the rest. You are not someone that has distraction problem, all right. You are not someone that is impatient. You are someone who is very patient, all right, in terms of watching the market. All right, you are very, very patient in terms of watching and looking at your charts. So you are an impatient person who doesn't like to wait for long trades. right? You don't like waiting 2 days, 3 days, 4 days for you to get a trade signal that matches your trading criteria. That's your confirmation checklist and your trading plan, right? You are trading on the smaller time frame. Why? Because you want fast moves, right? You want quick moves. You want to be seeing opportunities here and there. You want to know the outcome of whatever trade you are taking within few minutes to few seconds. So now you have fast fingers, all right? You have fast fingers. You can quickly close the trade. You can quickly open the trade, and you are a surgeon, right? That's basically a joke. That's basically a joke. So you might not be the forex scalper if you get easily stressed out by fast moving environment, right? If something is happening too fast, you just get stressed out. You give up. You say, "Oh, this thing is moving too fast. I cannot concentrate. I cannot keep up." All right. So you can't commit several hours of undivided attention. All right. You cannot commit 4 hours of just looking at the chart without doing any other thing. All right. So you are not meant to be a scalper if you cannot if you cannot commit undivided attention. So you rather make fewer trades with higher profit gain. If you are someone that you want to take only 2 trades a week, but you want higher profit gains, you want plenty, you want your trade to go 200 pips, 300 pips, and all of that, you need to be very, very patient. You need to wait for those opportunities, and you will take fewer trades which has higher profit potentials. All right. So you like taking your time to analyze the overall picture of the market. When you are scalping, you are not basically why scalping is quite risky because you are not basically looking at the overall picture of the market. You are not looking at where the overall direction of the market is going. You're just basically taking price volatility. The market is going down, you look for a way to go down. The market is going up, look for a way to go up. Right? So that's what a scalper basically is. So you can be a day trader. A day trader is similar to a scalper, just that when we are day trading, you tend to pick a position at the beginning of the day, all right, and ensure that you either take profit or a loss before midnight. You don't basically leave your trade overnight. Right, that one makes you a day trader. As the name implies, you don't leave your trade for over a period of one day. So what are the characteristics that you will see in yourself that you say, okay, day trading is for you? You like beginning and ending a trade within one day. You have time to analyze the market at the beginning of the day and can monitor it throughout the day. You are not supposed to be a day trader if you cannot monitor your trade. The fact that you are taking the trade in the morning doesn't undermine the fact that you have to continually monitor the trade. You have to be checking the trade whether it's going well or it's not going well. Just basically maybe adjusting one or two things that you need to adjust. So you need that time. So you like to know whether or not your wins, that you are winning or losing at the end of the day. Right? This is the characteristic that you need to have to become a day trader. So you might not be suitable to become a day trader if you like longer or shorter term trading. Day trader is basically like in the middle. You're just in the middle. You are not a scalper, you are not a swing trader, you're just in the middle. So you are not a day trader if you like to take longer trades or if you like to take very short trades. Right? So you don't have time to analyze the market and monitor it throughout the day. Alright? You are not supposed to be a day trader if you don't have time to monitor your trades. Alright? So you have a day job. If you have a job, what you should be doing is swing trading. Why? Because the outcome of your trades when you are swing trading, it takes time for it to materialize. Right? But if you are doing day trading, it has to be a full-time job. Being that you need enough time, to monitor the trade, place the trade and all of that. So now swing trading is for people or are for those people that like to hold on to a trade for several days. Alright, for several days at a time. There are traders who cannot monitor the chart always, alright, but they can dedicate at least a couple of hours, maybe 1 hour, to analyze the market every night in order to make a trading decision. Alright, there are people there, and it is ideal for people that have a job. Alright, so these are the characteristics that you want to see in yourself for you to say, okay, I would like to be a swing trader. You don't mind holding a trade for several days. Your trades can last 5 days. Right, it's just moving up and down. And you are willing to take fewer trades. You are not willing to take 10 trades. You are not willing to take 20 trades. You are willing to take the most necessary trades. Alright. So you are a very you don't mind having large stop losses. Right? You know the effect of having large stop losses is that the market may go negative against you by a certain number of pips. Alright, so you don't freak out, you don't mind having large stop losses, right? Because you are not there watching the market. So you do not have a tight stop loss so that the market doesn't trigger your stop loss and later goes in your direction. Rather, you have a large stop loss that the market can play. Tell you the forex market doesn't move in a straight direction. If it wants to go up, it goes up, comes down, goes up, comes down. But generally, it is moving in a particular direction. Alright. So if you don't have a large enough stop loss, it's possible that you might be right that the direction is up, but it triggers your stop loss. So if you are doing swing trading, you have to have large enough stop loss. You have to be very patient. If you are leaving trades for 10 days, you have to be very patient. Leaving trades for 2 days, you have to be very patient. Alright? You don't have to be someone who wants to see the outcome within a day. You don't have to be someone who wants to see the outcome within few minutes, few seconds, and all of that. So you have to be a very, very patient person. So you are able to remain calm when the trade moves against you. Alright? So you might not be a swing trader if you like fast-paced, action-packed trading. What that simply means is that you want trade that is quick. Alright, you want to see the result, you want to see what's going on, you just want quick trading and all of that. You are an impatient person. That you are impatient and you like to know whether you are right or wrong immediately. You don't want to wait for 2 days to know if your forecast was right. You don't want to have to wait for 2 days or 3 days or 5 days or thereabout to know if your forecast was right or wrong. Alright, so if you don't have that patience to wait, then forex swing trading is not for you. Alright, you get sweaty and anxious when the trade goes against you, because before a trade plays out, it might want to go against you by a certain number of pips. So if you are a swing trader, you can bear, you are not sweaty, you are not anxious. So far as you are using proper risk management, you already know the percentage that you are going to lose if that trade goes against you. You know the percentage you are going to gain if it goes in your favor. So you can't spend a couple of hours every day to analyze the market. Alright, you are someone that is so busy that even 1 hour you cannot give. Alright, you cannot spend to just analyze the market. Alright, you can't give up your world of Warcraft raising season. That's basically a joke. That you cannot give up maybe a little time of playing game to just analyze the market and take position. Alright, so you cannot be a swing trader if you have all of these characteristics. So a swing trader basically takes advantage of swings. Alright, we have two kinds of swings. We have the swing highs and the swing lows. Alright, swings are basically turning points. Alright, if you observe, the market was going up and it swinged lower, or it was going up, alright, at the first instance that we have here, and then it swinged lower. Alright, now the market was going down, then it swinged higher. Alright, when an upward market turns downward, we call that a swing high. Right, when a downward market turns upward, we call that a swing low. Alright, so you are just basically trying to take advantage of the various swings that the market is making. Alright, if it's swinging up, you go up. If it's swinging down, you go down. So these are market swings, turning points. Alright, turning points. So based on your strategy, you are going to determine the swings of the market. You'll be right, you'll be wrong. Alright, you'll be right, you'll be wrong. Right, but based on your strategy, if it has a competitive edge, you are going to find out that at the end of the day you might come out profitable. So position size trader, this is ideal for those people that can leave their trade for several weeks, several months, even a year, 2 years, 3 years, and all of that. They are basically fundamental traders. Alright, they're basically fundamental traders in the sense that they trade based on fundamental. And most of these big banks are position size trader because they have a large enough equity. When I say equity, they have a large enough amount of money, all right, that can handle a trade that can last for up to 1 year. Even though it's going against them for 1 year, they don't mind. They just take a position, all right. So you might not be a forex position size trader if you are an independent thinker. That means, okay, sorry, you might be a forex position size trader if you are an independent thinker, that you have the ability to ignore peculiar opinion and make your own educated guesses to where the market is going. All right, you don't mind if the market is going down, you don't mind if the market is going up. All you just need to do is, after you have heard the news, you have heard the fundamentals, all right, you go and place your trade. Even if the market wants to go against you by 1,000 pips, you have taken your position, all right. You wait for it to come to your favor whenever the market wants to do that. So you have a great understanding of the fundamentals and have good foresight into how they affect the currency pairs you are trading. Alright, as you have knowledge of fundamentals, which we are going to be discussing very soon. Alright, you have thick skin and can weather any retracement. Alright, you can weather any, that's the market going against you by a large amount of pips. You don't mind, you are okay with it. Alright, you have enough capital. I said it, you have enough capital to withstand several hundred pips loss. Alright, several hundred pips loss and all of that. Right, several hundred pips, like 1,000 pips, 2,000 pips, 800 pips, and all of that. If you have a very small capital, you might not be able to stomach a hundred pips negative, right? Because that's going to be a very big negative to you, right? So you don't mind waiting for grand risk reward, right? You are into long-term forex trading. Alright, and you are looking to get thousands of pips. Alright, you can wait for a whole year just for your dreams to be achieved of making maybe 1,000 pips, 2,000 pips, 3,000 pips, as the case may be. And then, most importantly, you are extremely patient and calm. You are not someone who wants to make fast money. You are not someone who wants, because you already have money in the first place. You're not someone who wants to make quick gains. You're not someone who is impatient and want to see the result of your trade at the end of the day. Alright, you have the patience and you are calm. You might not be a forex position size trader if and only if you are easily swayed by popular opinion on the market. Maybe someone wakes up one morning and say the euro US dollars is not going up, and you are on a position for up, and you just quickly close the position for up. That means you are not sure of what you are doing. So you are not supposed to be a forex position size trader if you are swayed by popular opinion, because there are lots of opinions. Everybody has one or two things to say. Everyone has one or two things to say. Alright, so you just take your position and you leave it. So you don't have a good understanding of how fundamental affects the market in the long run. Right? You need to know how fundamental, how news event, how maybe crisis that happen in a particular economy can affect that country's financial asset in the long run. They are causing what is called inflation or deflation. Alright, inflation. So you aren't a patient person. Even if you are somewhat patient, you might not be that patient. Alright, you might be patient to leave your trade for 1 day, 2 days, 3 days, but you might not be that patient to leave your trade for 1 year. Right? Maybe 1 year, in the whole 1 year, it is really negative. You are patient. You are waiting for it to read positive. 2 years have gone. It's really negative. You're waiting for it to read positive. Position size trading is not meant for you. You don't have enough equity. You don't have enough trading capital. Right? You don't like it when the market goes against you. Alright? You don't like when the market goes against you. You like seeing your result fast. You like quick gains. You like quick losses. You like seeing whatever is the outcome of your trading within maybe given a very short period of time. You don't want to wait for that long to see if your competitive edge is going to play out or not. You don't understand. So we have kinds of trader. Remember, we have types of traders. Now we have kinds of trader. When we are talking of the kinds of trader, we are talking of what do you as a trader rely on. when it comes to making your trading decisions. All right, the kind of trader you are is based on what you rely on to make your trading decision, in bracket, which is a decision to buy or to sell a particular financial asset, all right, or a particular currency pair. So the kind of trader you are is based on what you rely on, the informations you rely on to make a buying decision or a selling decision. Right? So we have three kinds of trader. We have the fundamental traders, the technical traders, and the sentimental trader. Fundamental traders make or rely on currency pair. So the kind of trader you are is based on what you rely on, the informations you rely on to make a buying decision or a selling decision. Right? So we have three kinds of trader. We have the fundamental traders, the technical traders, and the sentimental trader. Fundamental traders make or rely on fundamental news, events, or data releases, all right, to make a buy or a sell decision. So fundamental traders make decisions to buy or sell a particular financial asset based on fundamental data releases. Which are basically, let's move on. So technical traders make their decisions to buy or sell a particular financial asset based on price movement on the charts, all right, or if they base their decision on what they can see. If the price is going up, they can base the decision to buy or sell, all right, based on the kind of trader. So they are basing their decision on what they are seeing on the chart, or they are basing their decision based on market reaction to what is called technical tools, technical indicators. We have various kinds of indicators in the forex market. So some people may base their decision on MA crosses. We say when MA1 crosses over MA2, we buy or we sell. All right. So anybody that does that is basically a technical trader. All right. It's basically a technical trader. These technical traders can be divided into two. We have price action traders and indicator traders. Price action traders are those traders that trade the naked charts, right? The naked chart, and that's what we're going to be teaching you how to do. All right, the naked charts. And then the indicator traders are those traders that rely on on indicators to take their buying or selling decisions. All right. So we have what is called sentimental traders. All right, a sentimental trader combines both the technical and fundamental data / bias in order to make a trading decision. All right. So a sentimental trader is either a fundamentalist or a technicalist, in the sense that he takes information from the fundamental aspect of the forex market and also from the technical aspect of the forex market. Combining them together, he makes a trading decision either to buy or sell a particular financial asset. All right. So that's what a sentimental trader is. What we are basically going to be teaching you is how to become a sentimental trader. Right, we're going to teach you how you can use news events in order to take and combining news events with technical analysis. You can make decisions to either buy or sell a particular financial asset. So let's talk about the difference between a fundamental trader and a technical trader. Technical analysis. A technical trader uses what is called technical analysis, while a fundamental trader does what is called fundamental analysis. So number one, what is technical analysis? A technical analyst focuses solely on charts and past price action, while the fundamental analyst concentrates on the financial drivers of the economy itself. All right, he focuses on what is happening on the economy that affects the financial asset of that particular country's trading sims. We have investing.com and the rest to check out for news releases in order to take a buy or sell decision based on fundamentals, based on news releases. Alright, so we have a trader, that's a technical trader, is a trader who attempts to anticipate future price movement using past price behavior. Alright, the technical trader tends to determine the future with the information he has of the past. Alright, he uses the past to determine the future. Alright, why a fundamental analyst is a trader that believes on the sentiment based on current news and economic data releases that drives the market. So he believes on the sentiment. Maybe the sentiment is bullish, all right. He takes a bullish decision, all right, based on the sentiment, all right, based on the sentiment that is found in economic data releases. So now let's talk about fundamental proper. What are How can we do fundamental analysis? What are those things? How can the fundamental how can your knowledge of fundamental aid you to become a successful forex trader? As I said earlier, in World Bank Academy, we are sentimental traders, being that we believe in the fundamentals and we also believe in the technicals. All right. So let's explain the fundamentals using a car. Every car that is moving has fuel. All right. Every car that is moving is supposed to have brakes. All right. Every car that is moving has a certain speed that it's moving at. All right. So now, what does the driver signify? Because we are using the car as a representation. All right. So the driver of the cars is the CBN governor. Whatever happens to the financial asset of any economy is based on the decision that is made by the central bank of that country. All right. If we have the Central Bank of Nigeria making a decision to increase maybe interest rate, it's going to affect the financial asset of Nigeria. All right. So whatever is happening in a particular economy that is determined by the CBN governor affects the price of the financial asset of that particular economy. So now let's explain the forex market. That's how does the fundamental affect the forex market, all right, and most especially how does the driver, as the CBN, the central bank of that economy, how does it affect the forex market? How does it affect the financial asset of the country in question? All right. So let's say we are talking about Nigeria, for example, the financial asset of Nigeria. The CBN governor is charged with the responsibility of either regulating the price of the Nigerian naira. How do I mean? If there is economic growth, which means the Nigerian naira, that is inflation, the exchange rate of the Nigerian naira is going high in relation to other financial assets. All right, there's economic growth. Okay. So, and he sees that the economic growth is too much. The aim of every economy is to maintain stability. It's a scenario where we don't have the economy moving too fast or too slow. So it's to maintain stability. In a scenario where the economy is moving too fast, it could be a bad thing at the end of the day because it could lead to what is called inflation. When the economy is moving too slow, it can be a bad thing in the sense that it can lead to what is called deflation. Alright, so how does the driver, the CBN governor, controls how fast an economy is growing or how slow it grows when necessary? Alright, so he can determine that by applying the brakes. Alright, applying the brakes, which is interest rate. If the CBN governor increases interest rate, what do you think is going to happen to production? What do you think is the direct effect to production? Because given the scenario of this car, we are looking at more fuel, or which is more production or more productivity, the faster the economic growth, right? The faster the faster the car moves, right? So if the car is moving too fast, and remember the aim of the economy is not to move too fast, it's to be stable. The car is moving too fast. How does the CBN governor regulate that movement, that economic growth? Is by interest rate, because what is causing that fast growth in the first place is productivity. When there is so much productivity in a particular economy, the financial assets of that particular economy tends to increase in value, right? Because there's a lot of production. There are many people demanding the financial asset of that particular country, right? Due to maybe export and import, right? If people are buying a lot of things from China, the value of the financial asset of the Chinese people is going to be higher All right. Why is it going to be higher? Because many people are exchanging the money they have to the Chinese CNY. All right. The Chinese yen. Okay. So because they are demanding this Chinese yen, what is going to happen to the price of the Chinese yen? Is going to go up, right? Because demand, when there's high demand for a particular commodity, the price of that commodity goes up. All right. So now, if the commodity, the price of a particular financial asset is going to exponentially, is going at a very fast rate, all right, which is not good. What the CBN governor will simply do is that it increases interest rate, so that people are going to take. Because what drives productivity in the first place is money. When there's a lot of money in a particular economy, there is high productivity. So when the CBN governor discovers that the economy is growing at an exponential rate and he wants to stabilize the economy, all he just simply needs to do increase interest rate. Once he increases interest rate, people are going to take the money into the bank, right? The monies that they have in various production activities, they're going to take the money and put in the bank. Why? Because they are going to be having an extra interest than what they were supposed to be having, because interest rate has been increased. Let's take for example now, the interest rate was at 10% per annum. Now the CBN governor has increased it to 20% per annum. Doing that, he has been able to seduce investors. He has been able to, because people like to make quick money, right? They want to make money that they are not doing. They are not doing anything. Right? They don't want to sit down and make money. So what they just simply need to do, it interests them when they see that there's a scenario where they can just put their money somewhere and the money grows exponentially. So if the CBN governor increases interest rate, it seduces investors. It makes people to put their money in the bank, because they're going to be having a higher interest on the money that is kept on in the bank. All right. So now, if the CBN governor sees that the economy is too slow and wants to facilitate that particular economy, what it simply does is that that's when we have scenarios where they do what is called quantitative easing. All right, quantitative easing, which is a scenario where we have relief funds, all right, bailout funds are being pushed into a country, into a particular economy, so that it keeps the economy afloat. When Nigeria fell into recession, there were lots of grants coming out. There were lots of people giving out funds. The government were trying to look into businesses, so that the aim of doing that was very, very simple: to increase productivity. They were looking to invest in the agricultural sectors and all of that. The aim was to increase productivity, so that productivity now is going to cause economic growth. All right, it's going to cause economic growth, and it's going to balance our financial asset. That's the value, the exchange rate of our financial asset. So that is how the CBN governor can regulate the growth of a particular economy, right? Using the brakes, which is the interest rate. If he increases it, if he increases the interest rate, it seduces investors to keep their money in the bank and reduces production or productivity. All right. If he decreases interest rate, all right, it makes the investors to take out their money from the bank and invest it in one or two productive activities that leads to higher productivity, that leads to economic growth. Right. So you see, the economy is balanced. Whenever the CBN governor sees that the economy is too slow, he knows what to do. All right. He releases funds into the economy. All right. And then if you see that the economy is too fast, he knows what to do. He take out funds from the economy. So another thing I would like to make you understand is that countries like Japan, they operate on what is called negative interest rate. What that simply means is that if you keep a certain amount of money in the bank, we are going to be having a minus rather than an increase. All right. So if you keep like 100,000 naira in the bank in Japan, at the end of the day, you might end up with 50,000 naira. So it forces people to invest the money that they have into one or two productive activity, all right, which in turn causes economic growth. If you look well, if you are able to focus, you will discover that the Japan are striving based on technology. They don't have any natural resource, all right. They're not as, sorry to say, they're not as blessed as other countries that have crude oil, gold deposit, diamonds, and all of that. All right, but yet they are one of the most stable economies we have in the world. Why is it? Why is that? Because they are able to regulate their economy using interest rate. Right. So with a negative interest rate, it forces people to take their money out of the bank and invest their money in one or two productive activity that can, in the long run, lead to employment and a host of many other good things. So it is worthy to note that the more the fuel or the more the productivity, the more the speed or the more the economic growth. All right. So let's move forward. Now there are indicators, right? When you go to investing.com, all right, there are indicators. That's things that you need to see as a fundamental trader in order to make a buy or sell decision. All right. So one of those indicators are non-farm payroll. Non-farm payroll is a data that shows the employment rate, how much of employment was, or how many new people were added in terms of employment into a particular economy, that's into the United States economy. All right. So it is released every first Friday of the month. Every first Friday of the month. And when this information are released, there's high volatility in the market, as the market either move up very fast or move down, and all of that. So it is basically a declaration of the amount of employment that was added to a particular economy, and that economy happens to be the United States. All right. So it's a data release by the United States government of the amount of employment added to the particular economy. So how does the non-farm payroll serve as an indicator for a fundamental trader to either take a buy or a sell decision? It's very simple. All right. If last month, on the 1st of last month, the data release was at plus 200, all right, plus 200, and this month we are seeing minus 200, what do you think is going to happen? Very, very simple. It shows that the American economy is losing workmanship, all right, it's losing manpower, therefore production is going to be affected. Right. And if production is affected, what do you think will happen to price? That's the exchange rate, or the price of the country in question, that's the financial asset of that particular country, will be affected. All right. So if there is no manpower to carry out productive activity, right, in a particular economy, right, what is simply going to happen, what that is indicating is that the financial asset of that particular economy is going to fall. It's going to fall. We don't know how long, but it could be 1 month, it could be 2 months, based on how long that particular event continue to happen. Right. It could be that every month it's decreasing, right. So it could continue to fall, or it could increase based on the event that the data release that we have. Right. So we have commodity price. There are some economy that are commodity based economy. All right. Countries like Nigeria were based on crude oil. All right. Countries like the Canada, they are based on crude oil. That's their economy rather is based on the export or import of crude oil. All right. So if crude oil prices are up, what do you think will happen to the Canadian economy? It's going to be up. All right. That's the Canadian financial asset is going to be higher. Why is it going to be higher? Because there's much demand for its product. That's the product it exports, which happens to be crude oil. All right. So some countries are commodity based economy. Right. So we have PMI, CPI, trade balance, export and import, PPI, and the rest. These are the indicators. These are things that you should be going to a website called investing.com to look out for. Right. You're going to be looking out for all of these indicators so that you can make a buy or sell decision. What we're going to be doing a live, that's a practical on how we can use the forex, that's the fundamentals, to forecast the forex market. All right. So sometimes what might affect the forex market may be news releases like geographical, maybe natural disaster, or maybe war, tribal war. All right. That can affect the country's financial asset. Right? If there's war in America, the value of the financial asset of America would go down. Why is it going down? Because there's less demand for that particular financial asset due to what? The war. If there's a natural disaster like earthquake on the American economy, what do you think will happen to the financial asset of America? It's going to go down. Why? Because there will be lesser demand during that period of the natural disaster. Understand? In America, right? For the country's financial asset, right? That would now have an effect on the price. That's the exchange rate of that country's financial asset. So we have political events, inflation, economical data release, global environment, interest rate. So what you are basically going to be looking for when you go to the site I'm recommending is you're going to be looking for news events that affects productivity. You see, commodity price affects productivity. All right, commodity price affects productivity. Non-farm payroll, a level of employment, that the manpower in a particular economy affects productivity. All right, trade balance, level of export and import into an economy, PPI, CPI, trade PMI, and all of that. They are indicators that reflects the level of productivity in a particular economy. Geographical war or natural disaster can also affect productivity in an economy. So when you go to this recommended site, what you're going to be looking for is news events that concerns productivity. So let's do that practically. Let's take for example on the 1st of March, right? I'm taking my date to the 1st of March. So first of all, we'll go to investing.com. Investing.com. So when you open investing.com's page, this is what you are likely to see. Alright, and then you come to tools. Alright, tools. Then you click on economic calendar. So a fundamental trader basically looks at the economic calendar. Alright, so when you look at the economic calendar, you ensure that this current time zone is the time zone you are in. Alright, if you are in Africa, you look for West African time. Alright, I'm trying to get West African time. Alright, so we have we are currently located in West Africa, so now we have +1 GMT because we are located +1 of the Greenwich Meridian time. So this you can use this to, that's the scheduled data releases for today. When you click yesterday, you see the ones that were meant for yesterday. All right, the one of today, you see the ones that are meant for today. Tomorrow you can see the data releases that will be released tomorrow. This week, Monday to Friday, all the releases that will be released during the course of this week. You can even see for next week. All right. So for today, if you're a fundamental trader, all right, you will be looking at the data release for today. All right, you're going to be trading what is called the divergence between two economies. When I say divergence, I mean the difference in strength of one economy over another. All right, we're going to be trading the divergence. Let's take divergence first of all. So how we make money as fundamental traders is very, very simple. By trading the divergence of a country's financial asset. All right, we have a lot of cars. We have different economies. All right, we have different economies in the financial that are trading in the financial market. All right, so we are trading the difference. When one economy is going down, the other is going up. So we are taking advantage of either the downward movement of a particular economy by selling, or the upward movement of a particular financial asset by buying. Alright, so we are trading the difference between these two economies. If the dollar is doing well, we are buying the dollar. If the euro is doing well, we are buying the euro, right? So how we make money in the financial market is by trading the divergence between these two economies. So let's simply look at a live example here. Let's go to the 1st of March. Alright, let's go to the 1st of March, which was non-farm payroll day. Let me show you how we'll have been able to determine what happened in the market on this day. Okay, click on apply. Alright, and you see, this is a whole lot of information. And what I like to do is to focus. When you are trading forex, in fact, as a rule of thumb, I would like to advise that you trade a certain currency pair, master that currency pair before moving to another. Because when you are able to master a particular currency pair, you can trade other currency pairs. Alright, you just apply the same knowledge you were able to gain from mastering maybe GBP USD, for example, alright, into trading others. Alright, so now let's say we have chosen GBP USD to, or let's say we have chosen the euro or the euro US dollars. Right, we want to master the euro US dollar. We are only trading the euro US dollars. So I cleared out my chart. That means I don't want to see information about Argentina, Nigeria, Japan, and the rest. The only currency pair I am looking out for it's euro US dollar. So I'm going to go and pick that pair. Alright, I'm going to pick the United States dollars over here. And I'm going to pick the United Kingdom GBP. That's the Great Britain pound. That's the currency pair I want to be trading. The GBP and the United States dollar. So I'm only looking for information that concerns the Great Britain pound and the United States dollars. Alright, the United States economy. So I'll come here to category, right, and I'm going to pick if I have maybe preference, of the kind of news I want to be looking out for. I'll click on the news, maybe employment news, news on economic activities, inflation, confidence index, and all of that. Alright, I'm going to click on the specific news that I'm interested in. Alright, so now, while importance, all the news that comes out, all the data release that we have in these various economy, they have level of importance. Alright, and we're going to be choosing from 2 bulls, 1, 2 to 3 bulls. That shows you high importance. If you have 2 bulls, it shows you that it is high importance. It is more important than the 1 bull. Right, that the 3 bulls is more important than the 2 bull. Right, so the level. I'm basically clicking on them so that I want to only see the informations that are highly important. I don't want to see information that are not important like this. So I've clicked on apply. So having done that, it brings out all the information that I have requested for. I remember I changed my date to the 1st of March. Right, 1st of March. I want to show you how a particular data release affected the market on the 1st of March. Alright, so now see, this is the GBP manufacturing PMI. GBP manufacturing PMI that was released 10:30 on the 1st of March.
Okay.
Alright, so now prior before this information, we have this we had this information at 52.0. These were the 2 things we were seeing. We were seeing the previous and the forecast. The forecast is basically that market analysts are forecasting that due to some of the information they have, they are saying that maybe the market is going to, that there is the actual is going to be different from the previous by certain percentages. Alright, so now we have not seen 52. That was when it happened. That's when this was updated. Alright, if you check some other, like this scenario, which is tomorrow, the actual have not been updated because it has not happened yet. Alright, so now let's go back to 1st of March, which has happened. Let's see how we'll have been able to know that take either a buy trade or a sell trade based on what we can see. So imagine the previous that we could see, we saw it at 52.6. Alright, 52.6. And then the forecast, that's the the analysts had forecasted that due to one or two conditions that they have, the release that is going to come out is going to be at 52.0, and actually it was at 52.0. All right. So now look at the previous. The previous is higher than the forecast, and obviously the previous is higher than the actual, which shows weakness. Right? It shows weakness on GBP, and whenever there is weakness on GBP, there's strength on US dollars. Right? Whenever there's weakness on GBP, there's strength on US dollars. That is to say, we are supposed to be buying if this is the GBP.
Is at that time?
Hey, you're not supposed to talk. Okay, well, just talk about it. Cut that part. Yeah, listen. You buy it after you must have seen the data release, right? After this particular one has
the actual
has been released, and you have confirmed, alright, that it's at 52.0. The market would apparently be around. Let's actually go to that day. That was March 1st, right? Listen, it's March 1st. Around here, right? We even saw that the GBP was trying to go up, but as soon as that news was released, the strength of the news took it down, right? Because it's telling you that GBP is weakening, and when GBP is weakening, US dollars is gaining strength. So what you are supposed to do is to sell, right? The currency pair called GBP USD, you sell it. That means you change. Yeah, you are forecasting that the market is going to go down first of all. And it also means that you are exchanging all the GBP, you are selling all the GBP you have to buy US dollars. So after you must have looked at this data release, the sentiment you are going to have by seeing that it went from 52.6 down to 52.0, and the actual was actually 52.0, the sentiment you are going to have is going to be bearish, it's going to be downward. Alright, so when you come to the chart, you are looking for selling opportunities. You're looking for that. Maybe you are using candlesticks. You are looking for bearish candlestick pattern. That's candlestick pattern that shows downward movement. All right. So that's that. So now another data release was released for the United States dollars. See this same data release, manufacturing PMI. All right, and the manufacturing PMI that was released for the United States dollars was also on a negative. But why does it still favor the United States dollars in relation to the GBP? This is why it's favored. You see, the manufacturing PMI for the United States dollars dropped from 53.7 to 53.0. Right, it actually dropped, but 53.0 is still stronger than 52.0. Alright, that is why the GBP, right? That's why the GBP is losing strength against the United States dollars, because to some extent, alright, by maybe 1%, the manufacturing PMI. The manufacturing PMI for the United States is better than that of the GBP. So it still shows that the United States is still stronger than the GBP, because the actual for the GBP was at 52.0, while the actual for the United States dollars was at 54.2. 54 is higher than 52. So that's why you still see the GBP falling in relation to the United States dollars. It's falling in relation to the United States dollar. That is how you can use economic activity to determine. That's how fundamental traders basically.
When it's released immediately.
When it is released immediately, you start looking for the opportunity from then.
Or meaning that you'll be watching the chart.
Not really. This news are scheduled. This one was scheduled at 2:15.
Mm-hmm.
Sorry, 10:30 rather. Once it's 2:30, you come to your chart and
2:30.
And yes, exactly 2:30, the news will be released. All right, it was
Yeah, I don't
scheduled
get
at
it was showing.
10:30 rather. At exactly 10:30, the news will be released. You'll see the actual. And after you have seen the actual, you come here and look for selling opportunities based on the strategies I'm going to teach you. Alright? Based on the strategies I'm going to teach you. So if you don't see any selling opportunities, you don't take the trade. But if you see selling opportunities, you gladly take the trade. Alright? So now 52 points. I told you that we are sentimental traders. We use both news and technical. Someone that is only a fundamental trader will just come and buy and sell. If the market, now the market is saying sell, he just comes here, sell. He doesn't look
Any other thing.
or any other thing. But we are more precise. Alright, we are not just going to take the trade blindly. Alright, because what are we? We are sentimental traders. We combine fundamentals and we also combine technicals and we take trading decisions. So you understand perfectly how this scenario was able to affect price of a particular financial asset. It caused a decline in the GBP because the United States dollars was somewhat stronger than the GBP in terms of PMI, manufacturing PMI. So that is how you can trade the divergence between two economies. That's the strength of one against the weakness of another. So what moves the market? When we talk about what moves the forex market, we are simply talking about the factors that causes price to either go up or go down. Alright? As the exchange rate of a particular financial asset to either go up or go down. Alright, so many traders, especially the fundamental traders, believe that the financial market is basically moved by the fundamentals. Alright, but I say that is a complete no-no to me. Why did I say so? Because I believe that even when it is the fundamentals that causes the traders to take a buy or sell decision, it is still left to the buyers or sellers to take the decision at the end of the day. So I give the power back to the buyers or sellers. Okay, so let's talk about markets. Alright, what is a market? A market is a place where people come together to buy goods and services, not just buy. They buy whatever. What happens in the market is that there is buying and there is selling of goods and services in a marketplace. Alright, so buying signifies demand, while selling signifies supply. Alright, buying signifies demand, while selling signifies supply. So what is demand? Demand is the amount of goods and services that consumers are willing to buy at all prices. Okay, alright. So demand is not complete if consumers are only willing to buy and are not able to buy, alright, at all prices. So demand is not complete if consumers are only willing to buy but are not able to buy. So to analyze demand, we use a demand schedule. That is a table that lists the quantity supplied and then the quantity demanded or bought at various prices. Alright, then the demand curve is a graph showing the demand schedule. Alright, so let's talk about the demand schedule. Looking about the demand schedule, we talk about price in relation to quantity bought. Alright, so looking at the price schedule, we have when a particular commodity is at $1, we saw that the demand for that commodity is like 7. Okay, from the price schedule we have, when the price went up to $2, we saw that the demand for that particular commodity went down to 6. When it went up to 3, we saw it go down to 4. When it went up to 4, we saw it go down to 3. Went down to 5, or went up to 5, and we saw it going down to 2. So going to 6, we have it at 1, and then when the price got to 7, we had 0 demand. Alright, so you could see from this demand schedule, we could notice that price and quantity supplied or quantity bought is as a result, is a direct result of the price. So that It's what we have here in our demand curve. That basically it's the two figures we have. It's the price of movie tickets plotted against the number of movie tickets per month that were bought based on that. So law of demand. What does demand mean? Notice from our price schedule that the higher the price, the lower the quantity demanded. The lower the price, the higher the quantity demanded. So the law represents an inverse relationship between price and the quantity demanded. All right. So what is quantity demanded? Quantity demanded is the amount of a goods or service that consumers are willing and most importantly able to buy at specific prices. All right. So there may be a will, and there is no ability to buy that. There's no liquidity for the consumers to buy. So there cannot be demand if there is no liquidity. You cannot demand for what you don't have the money to afford. Okay, so quantity demanded is the amount of goods or services that consumers are willing and able to buy at a specific price. All right, so if we have a certain amount of goods and consumers don't have the liquidity or they don't have the money to purchase that goods, then there is no QD. All right, there is no quantity demanded. Because there is a will, but there is no ability. All right, so let's move forward. So, what's the law of supply? Right, the law of supply simply states that if prices are high, the quantity supplied increase. All right, if prices are low, the quantity supplied decrease. All right. When we talked about the marketplace, we try to see the relationship. Right. When we talk about the marketplace, we try to see the relationship between buying and selling, all right, which is demand and supply. If there is demand for a particular commodity, what do you think will happen to the supply? The supply is going to go up. Why is the supply going to go up? Because there is demand for that commodity. All right. If there's less demand for a particular commodity, what do you think will happen to supply? Supply is going to go down because there's less demand for that particular commodity. So we could see that it's very, very obvious that the demand for a particular commodity is what is directly proportional to the supply for that commodity. All right. So if I were to be a producer of say handbags and there is no demand for my product, why should I produce more? Okay. So that is that. So the law of supply states that if prices are high, quantity supply increases. If prices are low, quantity supply decreases. Price and quantity supplied have a direct relationship, unlike demand that's an inverse relationship with price. The higher the price, the lesser the quantity demanded. While for the law of supply, the higher the demand, the higher the quantity supplied. All right, so you have a direct relationship. It has a direct relationship. So, what is quantity supplied? Just as when we talked about quantity demanded, quantity supplied is the amount of a goods or service that producers are willing and able to offer for sale at a specific price. Right? This is the amount of goods or service that producers are willing and able to offer for sale at a specific price. So let's just quickly look at the chart. Right? But before we look at the chart, let's look at price movement along the demand curve. All right, price movement along the demand curve. This is what we have looked at in the previous demand curve. All right, see, you could see price. That's the price getting lower, the quantity demanded getting higher. All right, so just telling you the relationship as the inverse relationship that exists between price and quantity demanded. All right, because the quantity demanded is not approximate to the quantity supplied. What I simply mean by that is that what we have produced, that's what is being produced in Nigeria, cannot meet the demand for that we have in the Nigerian economy. Therefore, there is need for import. All right, there's need for import, and you know what import does to a particular financial asset? It devalues it. All right, because you have to exchange when you go to import. All right, maybe you're traveling to China, you go to import a particular goods, you have to change the money you have to that of the Chinese. All right, Chinese yen, and if you do that, you are devaluing your currency. Why are you devaluing your currency? You are demanding the financial asset of another economy by exchanging use. All right, so that's how it works. So when we talk about equilibrium, It's where demand and supply meet. All right, and that's the aim of every economy. All right, we have some economies like the that of the US, that of the Canada, that of the Europe, and all of that. They are fairly stable. Not that they are perfect, but they are fairly stable because like what we see in 2008, where the market crashed, was as we looked at when we talked about the fundamentals. We saw that even the United States dollars crashed 2008. All right, so they are trying to gain stability. They don't want to be moving too fast. They don't want to be moving too slow. So what do we trade? The diversion, the difference at a given time in price. That's in exchange price at a given time. That's what we trade in the forex market. So looking at this graph, as I said earlier, you could see that where price and quantity demanded meet, it's called equilibrium position. That's stability. All right, so let's move forward. Okay, I want to put something into perspective. All right, so talking about the law of supply and demand. All right, the law of supply and demand is a theory that explains the interaction between the supply of a particular resource and the demand for that resource. All right, so it's a law that explains the interaction, that's the relationship that exists between supply and demand of a particular resource. All right, generally, the lower the supply, and that if there is a low supply for a particular commodity and then there is a high demand for that particular commodity, what do you think will happen to the price? The price is going to go up. There was going to be an increase in price because there is lower supply and higher demand. So in contrast, if the demand, or sorry, if the supply of that commodity is higher than the demand for that particular commodity, what do you think was going to happen to price? The price is going to fall. All right, so that is when we talk about quantity. All right, so if something is in abundance, all right, the value of that thing reduces. All right, like we have water in Nigeria, we have water in abundance. That's why you could buy maybe pure water for as cheap as 10 naira. Okay, but if you go to the sub-Saharan desert, we could get that same amount of water, that same quantity of water for as much as 100 naira or 500 naira or thereabout. That's just to put things in perspective. So generally, the low the supply, that's when there is low supply and there is high demand, right? That alone increases price, right? It increases price. Then in contrast, if there is greater supply, that's if there is the particular commodity is in excess, and then that's going to cause a lower demand for that particular commodity, which is going to in turn affect the price. All right, so that is another perspective that you could see demand and supply. All right, so let's look at how that can work on the chart. Okay, so we could look at this chart going upward. Look at this chart going upward. Let me highlight that. You could look at this chart going upward. We could see at this point there was higher demand. All right, there was higher demand but lower supply for a particular commodity. That's why we saw the market moving up. But at this point there was higher supply but lower demand for that particular commodity, because the commodity becomes in excess. The supply for that particular financial asset became in excess, therefore the demand goes down. Remember, when something is in excess, the value reduces. All right, if when we did not have much of Android phones, see, the price of Android phone was very high because it was seen as a very, very valuable commodity by those that could not afford it. All right, so the price was very, very high. So but when we have substitution like the Chinese Technos and other phones that came in, Gioni and the rest, we discovered that the price of other phones became fairly stable. They started to reduce. All right, so that is just a clear example of how supply can affect demand. All right, and then which can also affect price. All right, so if the particular commodity is very, very costly, what tends to happen most of the time is that there will be higher supply for that commodity. There will be competition. All right, okay, let's say this is a chart showing the supply of rice. All right, and then the demand and supply of rice. All right. So you could notice that at this point there is um there is high demand but lesser supply. That's why the price of that particular commodity went up. Right. So at this point there was high supply. So what happens to the price? I tell you, whenever there is high supply of a particular commodity, it shows that that commodity is in excess. All right. So what often happens is that the commodity loses momentum, so the price fell. So okay, let's say that this is a graph showing the supply. That's the okay. Let's say that this graph is showing us the relationship that exists between two shops. Okay, two shops. This is shop A and this is shop B. All right, this is shop B. This is shop A. All right. So when shop A was the only shop in that particular area, all right, where people could buy bread, they were selling their bread at 100 naira. Okay, they were selling their bread at 100 naira. Okay, and they were increasing the price. They were increasing the price every week by 10 naira. So this week it's 100 naira, next week it is 210 naira, next week it is, it's going up. The price is going up basically. But when shop B was introduced at this point, they came with a marketing strategy which was to reduce the price of bread. They were now selling their bread at 80 naira. So whenever demand, because this graph is showing us the graph of shop A in relation to shop B, is showing us the graph of shop A in relation to shop B. So whenever you see this graph going down, you know that shop B is now getting the customers, alright, because now they reduce the price of bread to 80 naira. They reduce the price of bread to 80 naira. So people are now, instead of buying bread, because people like to have it cheaper, instead of buying bread in shop A, they are now buying bread in shop B. So you see, shop B started to fall. Alright, this chart started showing weakness of shop B, of shop A rather. It started showing us weakness of shop A and it started to fall. And whenever shop A is falling, it means there is strength in shop B. Alright, so when shop A is going down, it means that the shop B is gaining strength. Alright, so let's put that into perspective. That's the right perspective. Shop A is the euro, which is the base currency. Shop B is the United States dollars, which in this scenario is the quote currency. So whenever you see the chart going up, you know that the base currency is doing good. Alright, whenever you see the chart going down, you know the quote currency is doing good. Therefore, the base currency which this chart represents is doing badly. So I want you to notice something, okay? Your duty as a trader is to buy when the base currency is doing good, and to sell this currency pair when the base currency wants to start doing bad. Because whenever you buy in the forex market, you are speculating that the price of a particular commodity, which happens to be euro, would be increasing. That's the exchange price for the euro. That means the euro are doing better. The exchange rate of 1 euro to dollars would be higher. Alright, so it's getting high. This is what I told you is the price scale. So the exchange price of 1 euro is getting higher. So at this point where the shift was initiated, you should be looking to sell. I'll teach you how to know when exactly to sell. Alright, how to know when exactly to sell. Alright, so where this shift want to happen, I'll teach you how exactly to know when to sell. So because if you continue buying at this point, even the wins, maybe you had the trade opened here for a buy and the market was going in your favor, you are making profit. When this shift happened, that's your profit. Maybe you are like 100 naira profit over here, and this shift started happening, you would be like minus 10 naira from your profit to know your capital. In this case, minus 20 naira, like that, right, until it will get to where you have entered the market and start reading negative of your capital. Alright, so you should always know when this shift want to happen, and how you can know when this shift want to happen is through candlesticks. Alright, mastering candlesticks. Not just only mastering candlestick, knowing what support and resistance are, knowing technical analysis and all of that. So we're going to be teaching you all of that at the course of this lecture. Okay, so this is intermediate, and we're going to be talking about the two types of trends. We're going to be talking about what is a trend. We're going to talk about the types of trend. Okay, so let's just move forward. This is the point where we are going to be a little bit practical. Alright, so now we have the market moving upward like this. Alright, because the first market doesn't move in a straight direction. It doesn't move in a straight direction. If it wants to go up, it goes up by making an impulsive move. Let's call this I, and then doing the pullback. Call this P. Alright, so talking about the subject matter for today, the types of trend. We have two types of trend. We have the trendy market. The up and down trend falls under the trendy market, and then we have the ranging market. The ranging market is simply characterized by price moving in between two zones. Alright, those zones are called the resistance and support zones. So price moves from support to resistance, from resistance to support. So in between these two zones is what makes the market to range. Alright, and before we classify a market as a ranging market, the market has to prove to us that it has found resistance at a particular level and has found support at a particular level and is ranging in between those levels. So talking about the two types of market, we have the trendy market, we have the ranging market. The trendy market is made up of two types of trend, the uptrend and the downtrend. So what makes it an uptrend? The market is said to be in an uptrend when the price or market movement is making sets of higher lows, alright, higher lows and higher highs. What that means is that all market have highs and lows. All market, let me draw it out. All market have highs and lows. Whether an uptrend market or a downtrend market, they all have highs and lows. Okay, so this is a high, and then this is a low. Okay, this is a high, and then this is a low. All market, this is a downtrend, alright, because the market is going down. This is an uptrend because the market is going up. But as I said earlier, in the first market, we don't expect to see an uptrend as straight as this. The market moves up by making an impulsive move. That means a long move into that direction, and then it pulls back a little bit, makes another move that breaks this high, alright, and then makes a pullback. So the market, for the market to be in an uptrend, the market is making sets of high that are higher than the previous high. Alright, so this high, the difference between this high and this high is that this high, it's a higher high. Why is it a higher high? It's higher than the previous, it's higher than the previous high. Alright, it's higher than this previous high. While this other high is also called the higher high. Why is it called the higher high? Because it is higher than the previous high. Okay, so in the downtrend is characterized by market movement in this pattern. The market moves in the downtrend by making sets of higher lows. That's highs that's lower highs that are lower than the previous high. I told you that all market, whether uptrend or downtrend, has highs and lows. Okay, so for this uptrend now, we have the high here, we have the low here, we have the high here, we have the low. But the difference between this high and this high is that this particular high is higher than this high. So that's why we see in an uptrend market, the market is making sets of higher highs that are higher than the previous high, highs that are higher than the previous high, so it's moving upward, and then it's making sets of lower highs or higher lows rather. So lows, this is low that is higher than the previous low. This higher low is higher than the previous low. So all market has highs and lows. Now for this downtrend market, we have the high and we have the low, we have the high and we have the low, we have the high and we have the low, we have the high and we have low. But the difference between this and this is that in the downtrend market, the market is making sets of lower highs. That's highs that are lower than the previous highs, highs that are lower than the previous highs, highs that are lower than the previous highs, highs that are lower, lows that are lower than the previous low. So we call it a lower low. Lows, this is a low, this is a low, but the difference between this low and this low is that this very low is lower than the previous low. So those are the types of markets that we have. Alright, these are the types of markets that we have. So let's move forward.
Okay, so this is technical analysis part of our course, and then we're going to be talking about candlesticks, we're going to talk about breakouts, we're going to talk about price action, the act of naked trading, we're talking about support and resistance. All right, talk about trend line. Okay, so talking about candlesticks, I want to talk about the language of the market. All right, the language of the market. The market is deaf and dumb. All right, obviously your chart cannot communicate to you in verbal, that cannot communicate vocally with you, but they do communicate anyway. So the market is deaf and dumb, but it communicates through sign languages. All right, so candlesticks are representations that aid market communication to traders. All right, it reflects the state of the battle between the bulls and the bears of any market. All right, so candlestick, basically the way the appearance, that's the image the candlestick takes, is it represents what is happening in the market. So that's how it communicates to traders. All right, so you understanding what the market is saying and taking the right decision based on your understanding of what the market is saying, it's a skill that you need to have to become a successful forex trader. So as with all sound languages, the market may be interpreted differently. All right, may be interpreted differently, that's individually. All right, based on the discretion of the individual, in based on the discretion of the individual. So, but at the end of the day, the market is always right. All right, the market is always right, and those who understand the right message passed by the market are those who succeed in this business. All right, so let me just quickly So let's just simply talk about what are candlesticks. All right, candlesticks, as I said earlier, they depict or reflect the state of the battle between the bulls and the bears of any market over a certain period of time. All right, and they are plotted automatically as a result of market reaction to price. So candlesticks are plotted automatically as a result of market reaction to price. Okay, so moving forward, I want to give you a little secret. All right, why you need to understand that. The reason why you need to understand candlestick is to enable you to take advantage of price slash market continuation or reversal pattern. When I mean continuation pattern is that you may see some formations that supports the other that represents market continuation, that the market want to continue in a particular direction and you are already in that direction. You leave it, you remember the goal of a trader is to make more profit than losses, right? So if you see market continuation pattern and then you are already on a trade for that particular maybe it was a buy trade, right? And you are on a buy trade and you see market continuation pattern, that means the market is it wants to continue the buy side. It wants to continue to the buy side, all right? So now let's say you're on a buy trade and then you see reversal patterns, that's reversal candlesticks. Right, so that's the market is communicating to you that get out of this market. I'm trying to reverse. I'm trying to go the opposite direction. All right, I'm no longer bullish. All right, so the market, if you understand candlesticks, is going to enable you take advantage of price continuation or market or price reversals. All right, maybe the price that the market wants to reverse at a particular place, you start seeing reversal candlestick patterns, you know that the market wants to reverse. Right, so let's talk about pro tips. I want to give you a tip, like as a pro. The smaller the wick of a candle, the less volatile the price was during that time frame. Okay, you know, the candles are basically plotted according to the time frame in which you selected. Right, so if you select a 1 hour time frame, you are simply saying that each candles should plot the market sentiment for 1 hour, right? You should plot the market sentiment for 1 hour. So if you go to 2 hours candles, that's the time frame you selected was 2 hours. You are basically plotting the market sentiment for 2 hours. All right. If you go to one daily, you are basically each candle is going to represent 1 day. All right. It's going to take 24 hours for the candle to be completely formed. Alright, and it's going to be representing the market sentiment for 1 full day, whether bullish or bearish. Alright, so the smaller the wick of a candlestick, the less volatile price was during that time frame. Alright, so if you see longer wicks, then the price was very volatile, it was going up and down. All right, but if you see less smaller wicks, you know, okay, it was fairly stable. You could now you could take advantage of that knowledge. All right, you take advantage of this tip. All right, so now what are bearish candles? A bearish candle indicates that bears control the market for the most part during a specific time frame. All right, it indicates that the bears controlled the market for the most part during that specific time frame. I'm going to go into further explanation of this, but I just want you to understand what bearish candles are. So let's talk about bullish candles. All right, the bullish candles indicates that the bulls control the market for the most part during that specific time frame. All right, so the bulls control that particular um, market for the most part during that selected time frame. All right, so that's why we have a bullish candle. That a bullish candle is a candle that represents buying pressure. That it shows you that the buyers were in control of the market over that period of time. That there was a lot of buying happening. There were lots of buying happening in that particular market at that particular time. All right, so um, before we get into price action, let's just go back and look in depth into candlesticks. All right, let's go back and look.
So let's just quickly go into the major kinds of candlesticks that we have and what they signify. Alright, let us go into the recommended candlesticks that we have and what they signify. Okay, so we have the bullish candlesticks, we have the bearish candlestick, we have the inverted hammer, we have the hammer, and we have the dojis. Alright, we have the dojis. Alright, the characteristics of the bullish candlestick, when they say something went up, alright, now let me draw, something went up. It started from down, right? For the fact that they say it went up, it means it started from somewhere that was lower and ended somewhere that is higher, right? When they say something went down, it started from somewhere that is higher and ended somewhere that is lower. So the bullish candlestick has it open. That means it opened at somewhere that is lower and closed at somewhere that is higher. All right. So let us just talk about the bullish candle. The bullish candle basically represents, or basically tells us that the bulls were in control of the market. That's the buyers were in control of the market for that particular period, because this particular, all these candles are painted according to the time frame in which you set. If you set one day, each candle will be painted. That's the whole information about that market is going to be painted within the time period of one full day. All right, it's going to be painted within the time period of one full day. So if you say 4 hours, each 4 hours new candles will be painted according to what is happening in the market. So you just basically summarize the state of the battle between the bulls and the bears. All right, so now what this bullish candle represents is that the market started at 6, somewhere around here, 6. It opened at 6, because when something is going up, it started from down and went up. Okay, it opened at 6, but this shadow that we have here tells us of the low. That's the lowest place the market went to. So having opened at 6, it went as low as 7, but did not stay at 7, but closed at 2. And then this upper shadow here tells us how high the market went. So it told us that, okay, though it closed at 2, but it went as high as 1. It closed at 2, but it went as high as 1. So the same is just the opposite is the bearish candle. The bearish candle usually opens at somewhere which is higher. Remember, if something goes down, let's say something went down, it basically started from somewhere that is higher and closed at somewhere that is lower. So the bearish candle basically starts from a price that is higher and close at a price that is lower. So let us look at this. It started from 2 and closed at 6. Then the high is telling us the highest point it went before retracing and closing at 6. And then the low is telling us the lowest point it went, that's 7, before it retraced and closed at where it closed, 6. Right, so these are, and the bearish candle basically tells us, or the information is passing across, is that the bears, that's the people that are trying to take the market down, are in control for that particular time period. That's the information is telling us, that the bears won the bulls for that particular time period. So the market, you should look for selling opportunities, or you should look to sell. All right, so let's talk about the inverted hammer. The inverted hammer shows rejection. This long wick shows that though the bulls were trying to take the market to 1, but the bears, that's the sellers, pushed the market down, and the market closed at this level. However, the market opened, this is they call it a bullish inverted hammer. All right, a bullish inverted hammer. We have bearish inverted hammer. It's just the opposite. So now for a bullish inverted hammer, the market started at a lower point. It opened at say 6, all right, and closed at around let's say 4. Okay, it closed at 4. So what makes it a hammer is that the wick is 2 times the body. Whenever you see a wick that is 2 times the body, you classify that as a hammer. And then what does it represent? What is it trying to tell us? It's trying to tell us that the bulls were trying to take the market to 1, but they could not survive the bearish pressure that pushed the market, that up to the extent that the market had to fall and close at a lower price. Okay, so the representation of this is that the market is trying to go down, all right, but you don't just enter down. You have to look for other confirmations before you enter down. Whenever you see an inverted hammer, you have to look for other confirmations so that you can enter for a down trend. You don't just blindly go, okay, I've seen an inverted hammer, you press down. Though what it is telling you, the information is giving you is that that the market wants to go down, but you have to wait for other confirmation before you go down. So now we have the hammer. The hammer, if the hammer is found in a downtrend, that's market going down, it's simply telling you that the market wants to go up, that downtrend is over, that they are the bears, that's the sellers. They try to push the market to 7 or 6, but the bulls came in before the close of the market. That's because the close of that particular time period, and were able to push the market to 3. And if you notice, the hammer is the wick of the hammer is basically 2 times the body of the hammer. So that's what makes it a hammer, and it indicates that the price wants to go up. That's the indication that the market wants to go up. But you don't just enter up anyhow. You wait for confirmation. And at the course of this lecture, we're going to talk about the various confirmations that you're going to be having. Especially using the practical book, you could check out for all those confirmations. So the best way to trade all of these candlesticks patterns are basically at support and resistance level. So we'll get the support and resistance level, you understand better what we mean.
Which is very, very close to each other. Right, so and then we have long wicks. So what a doji basically represents is indecision in the market. So if we have the market going up and then we see a doji, it's signifying that there is indecision coming into the market, which would lead that market down. So it's a reversal pattern. Alright, these are basically reversal patterns. When the market is going up and then we see a doji appear, it's signifying that the market wants to go down because there's indecision, there's confusion. Why do we not have the confusion when the market was going up? Well, we have the confusion here. So when we see a doji in a particular level in the chart, I'm going to be showing you those levels. Alright, we will know that the market is thinking of reversing. So it's a reversal candlestick pattern. Whenever a doji appears, it's a reversal candlestick pattern. Let's just talk about a bearish engulfing pattern. The bearish engulfing candlestick pattern is basically formed from 2 candles. Alright, we have the smaller candle, then we have the bigger candle. Right, when we have a bearish engulfing candle, it means that this is a bull candle, this is a bear candle, that this may be a white candle, this may be a black candle, this may be a green candle. That's according to how you set it. If this is a green candle, this is a red candle, according to how you set it. So the red candle is totally engulfing the body of the blue candle or the green candle as you set it. So when we see a pattern like this pattern is recognized as a bearish reversal pattern. But the market was formerly going up, and then we have it trying to reverse downward. Right? You see that you could notice that the bulls that were taking the market up started to get smaller. That's why we have a small candle forming, and then we now saw the bears coming in with full force, which make the market to go down, right, and fully engulfed the bulls. All right, that's this bullish candle. Right now, with the bullish engulfing candle the bullish engulfing candle, it's a bullish reversal pattern. All right, it is formed by 2 candles. Right, it's formed by 2 candles. One is the bearish candle being engulfed by a bullish candle. Right, the bullish candle is fully engulfing the body of the bearish candle. All right, it's fully engulfing the body of the bearish candle. So we have a bullish engulfing pattern, which represents a bullish reversal pattern. That means the market, it was going bearish, but it wants to reverse bullish. All right, so that's
So let's talk about how candlesticks are formed. All right, candlesticks are basically formed by combining candlesticks on lower time frame. Candlesticks are formed by combining candlesticks from lower time frame. So let's say we are on a 1 hour chart. All right, and then we had an inverted hammer, for example. How was that inverted hammer formed? It was formed by a 30 minutes candle that was bearish, and then a small bullish candle. That's 30 minutes the market was bearish, and the remaining 30 minutes the market was a little bit bullish. All right, if you notice, the bulls are smaller than the bears. That's why it signals trend reversal. Okay, now combining these two, we get this. All right, we get this because this is the recent remain, which is bullish, and then we have the shadow appearing as the bearish movement. The shadow is appearing as the bearish movement, all right, because it's going down. All right, it's a bearish movement. Okay, so this is how a bullish hammer is formed. A bullish hammer is formed by combining a bearish candle and a bullish candle. So notice the bearish candle took the market down, but the bulls engulfed. Okay, the bulls totally engulfed the bears and then took the market, and the market ended up on a 1 hour. So for 30 minutes ago the market was going down. All right, 30 minutes ago the market was going down, and that was what formed the wick. But the bulls came in after this market had closed at this point, and they were able to push the market upward. So the market closed higher than where the bears started. All right, this is where the bears started. So, and they ended here. So the bulls came in there and pushed the market above even where the bears started, showing you that there is influx. All right, there is influx of bulls. All right, there are influx of bullish pressure. That's why this particular hammer signifies a bullish movement. All right, it signifies that the downward trend is ending and then a bullish trend is coming up. This signifies bullish pressure. It signifies bullish reversal. All right, it signifies bullish reversal. It means that the market wants to go up, while this means that the market wants to go down. All right. So, however, this is also a reversal candle. But it signifies indecision. All right. So when you see this, it signifies indecision. This is called a doji. So how a doji is formed? Doji is basically formed by a bearish candle coming down, all right, and then the bullish candle came up and closed up here. So if you notice, they're almost equal. The bearish and the bulls are almost equal, and the market did not really move that much. That's to say that the open, all right, and the closes are almost the same. They are roughly the same. That's why we have it as indecision. So they are almost equal. So if the market was going up, for example, and then we had indecision at this point, it's telling you that the market wants to reverse it down. All right, so it can be a reversal signal. It can be a bullish reversal signal. It can be a bearish reversal signal, because if we see this doji on a downtrend, let's say the market was going down, all right, and we saw a doji, all right, the characteristics of the doji, the open and the close price are fairly the same. They are very close to each other, all right, and the wicks are long. We saw a doji. Maybe the market was going down. We saw a doji. It's a signal that the market wants to go up. But we cannot just jump and click the buy. All right, we're not just going to try. We wait for other confirmation. We'll deal, or we'll go deep into the strategy. Okay, so let's talk about, and then let's look at breakouts. Okay, what are breakouts? Okay, let's look at that. Yeah, so breakout of structures. All right, we have market structure. First of all, before we talk about breakout of structures, let's talk about what is market structure. Market structure refers, all right, to the direction / pattern an underlying financial asset wants to make. I told you that in the forex market, the most important thing is pattern. The market makes a lot of patterns. It makes a lot of repeatable patterns. So if you can recognize this pattern,
you can make a lot of money in forex. That if you can sit down, look at the chart, and discover a particular pattern, that's the way the market behaves, all right, the pattern or characteristics that the market has, you can make a lot of money by just leveraging on that particular pattern. So all you just need to do, if you discover a pattern, you back test it, and then that could be a very, very profitable or very, very profitable pattern. So now market structure, it refers to the direction or pattern and underlying financial asset want to make. All right, so we have different kinds of pattern. We have the ranging pattern. That's in a ranging market. The movement pattern in a ranging market is that the market goes up and comes down, goes up and comes down. It's just ranging in between two zones. Okay, it's ranging in between two zones. That's why it's called a ranging pattern or ranging market. In a trending market, the market cannot just go in a straight trend direction. Rather, it moves up and come down. All right, it moves up and come down. Okay, it moves up and come down. So that's the pattern. That's the market structure for an upward trend. We have the market structure for a downward trend. All right, we have the market structure for a downward trend. That we call it a downward. The market is going downward. Okay, so the pattern for a year is that it's making sets of higher lows, sets of higher lows, and sets of lower lows. This one is making sets of higher highs and sets of higher lows. Okay, so that's the market structure for an uptrend, market structure for a downtrend, market structure for a ranging market. All right, so now talking about breakout of structure, let's say you have a zone. All right, this is your zone. This line represents, let's say, your resistance zone. Represent your resistance zone. And when they say valid break, it means that the market closed at least 30% of the candle or of the market, the general market, as is outside that zone. All right, let's say we are looking at this line as our zone. 30% of the previous of another candle closes above this zone. It's called the valid breakout. That means it has broken out of structure. All right, it has broken out of structure. So now if we have a candle, now we have a particular zone. Okay, and then we have the market closing just about 10% of the candle. 90% is still inside that structure. All right, and 10% is out of that structure. This is called the fake out, because usually the market can continue in that same direction. Maybe this was a resistance, it bounces back and come down. Now if we have 20% outside that zone and 80% inside that zone, it's still telling you it's still a fake out. All right, because the market is maybe still reacting to that very zone. That's why 30% could not go out of that zone. All right, but if we have from 30% upward, we know that okay, this zone has been broke. That there have been a breakout out of that zone. The market is powerful enough to have broken out of that zone. It has come out of that zone by 30%. So it's usually a signal when you don't just rush and enter trade. You wait for the signal, either a break and retest, before you enter for a particular direction. All right, a break. Now we have gotten a valid break. That's 30% is out of that zone. Okay, so it's a valid break. Now we'll wait for other confirmations, or if we want to go aggressively, we can enter here for a buy. All right, we can have a break out of structure too for a downtrend. Let's say this was a downtrend and market is retesting here. This is like 10% out, so it's not a valid break. It came again 20%. It's not a valid break until we had something like this. This is a valid break. All right, this is a valid break.
That's going down.
Yes, going down. This is a valid break. So if we are seeing a valid break, we can enter aggressively here for a sell, and 80% to 70% of the time we'll make a lot of money. Okay, make a lot of money.
I thought you said we should wait for it to come back and retest.
That if you want to be you want to be defensive. All right, you don't want to be aggressive, but you make more money sometimes if you are very aggressive, because you get one of the best entries possible. So now let's talk about some other thing.
Okay, let's talk about price action. All right, price action is considered the act of naked trading. When we say naked trading, it's a scenario where you have to look at your chart and forecast where the market is going to go. All right, price action is also considered the act of using past historical data to determine where price will go in the future. It's more like what weather forecasters do. They use past historical data to determine what is going to be the weather condition of a particular place. Okay, so that is what we basically do in price action trading, we are basically using what we can see to determine what we cannot see. All right, so it also entails the study of price reaction to support and resistance zones. Right, there are zones in the chart which are described as support and resistance zones. So price action, that's how price react to this zone, is what is called price action to this zone. Right, so market structure, it's also it is price action that basically form what we call market structure. A market structure is the perceived pattern an underlying asset, as an underlying financial asset, wants to make. Alright, so as I told you that we have the different ways in which the market moved. Alright, we talked about different ways in which the market moved. That's the uptrend, the downtrend, and the ranging market, and all of that. Alright, so market structure is the perceived pattern an underlying asset want to make. So before we have an uptrend, there is a structure, there is a way the market moves. So we say, okay, this is an uptrend. And before we have a downtrend, there is a way the market moves, and we say, okay, at the end of the day, there will be a downtrend. So it is the perceived pattern an underlying asset is trying to make. So still talking about price action. Still talking about price action, we're going to be looking at support. What are support? We're going to be looking at what are resistance. Okay, let's look at support. Supports are called demand zones. They are also called floor. So and they're also called buyer zones. So why is a support described as a demand zone? But basically, let me define what a support is. A support is a level that tends to turn a downward movement upward. Right? Notice that the market was moving down. Alright, getting to a support level, it turned upward. Alright, so a support level is a zone, it's a range in between two price where market coming down tends to push the market upward. So why is a support zone called a demand zone? It's otherwise called a demand zone because we believe that there is influx of buying pressure at that zone. Alright, so there is lots of demand at that zone. That's why the market move upward after getting to that zone. Alright, why is it considered a floor? It is considered a floor because if you throw a ball downward, right, the ball is going to bounce. Okay, so it's more like a floor. It acts as a floor. So why is it called buyer zone? It's a zone which is we believe that it is set aside for buyers to buy a particular financial asset, more like a price range, a particular specific price, where when the market gets to that price, we see a recurrent action. All right, we are talking about price action. We see a recurrent action of buying in that particular zone, so we call it a demand zone or a buyer zone. Right, so in a support zone, we see that market coming down usually turns and goes up. Right, so just like when you throw a ball, it bounces off a floor. That throw a ball downward, it bounces from the floor upward. So that's what that is. So let's talk about resistance. Okay, what are resistance? Resistance acts as roof, resistance acts as supply zones, and they also act as seller zones. So resistance basically turns a price moving upward, downward. Basically turns the price moving upward, downward. Alright. So why are they called supply zones? Because it is believed that that there are suppliers, that's their that at when the market gets to that particular zone, there are influx of supply for a particular commodity which will lead that particular market downward. So it is described as a supply zone because whenever the market gets to that particular level, we notice that the market usually turns direction, and we know as traders that what will make a market to turn going up, right, is a resistance, okay, which may be due to excess supply of that particular financial asset. Right, so why is it called a roof? If you throw a ball upward, what does it do? When it gets to the ceiling or when it gets to the roof, it bounces off of that roof, right? So you throw a ball upward, when it gets to the ceiling, it bounces down. So we take a resistance to be a roof because when price get to that particular zone, it tends to bounce downward. Right, it tends to bounce downward. So we call it the seller zone because we see a lot of selling pressure whenever price get to a resistance zone. So whenever price gets to a resistance zone, we see a lot of selling pressure which tends to move the market down. So we call it a seller zone. Right, so these are the ways we can describe resistance.
Let's see, we have 1, 2, 3, 4, have a 5, a 6. Alright, so the zone between 1 and 2 is your resistance because it's supposed to act as a roof. Alright, the zone between 6 or 5 and 6 is your support because it's supposed to act as a floor. When you throw a ball down, it bounces off and goes up. Alright, you throw a ball to the ceiling, it bounces off and goes down. Alright, so that's how price acts on a ranging market. So how support and resistance act on a ranging market. So we are talking about ranging market now. I'm going to talk about how it acts on a what? On a trending market. So now, on a ranging market, this is what we are going to see. And then now there's something very, very important. For a support or for a zone between 1 and 2 or 5 and 6 to be termed a resistance or a support, with the market has to prove to us that that place is a resistance or a support. What I simply mean by that is that, let's say market was going up, all right, and turn down. That could happen. It can be for any reason. Okay, can be for any reason. Then we have something like this. It can be for any reason. The turn can be for any reason. But when we have something like this, all right, any reason can be for any reason. All right, we came back to this same zone and acted the same way. Remember, we're talking about price action. Talking about price action now. First time, it gave relevance by turning at this particular zone, the zone between 1 to 2. First of all, we see it could be anything. Anything can cause price to turn. But the second time price came to that zone between 1 and 2, it turned again. It has proven itself to be a resistance zone. So when we have first touch and then we have second touch acting the same, the keyword acting the same. First time he went here, turned, it acted the same. Second time he came here, turned, it's acting the same. It's now we have now confirmed. This is now a confirmed resistance that whenever price comes here is to resist, that the market resists. So now if we see price coming here, we don't just enter blindly. According to the strategy I'm going to teach you, we'll look for reversal candlestick pattern, all right, or we're going to look for our end bounce. What I mean by end bounce is you're going to understand that when we'll get into our strategy. All right, end bounce, it means we have an impulsive move to that zone and then we have a reversal move. Okay, so you are supposed to enter, you're supposed to cut the movement like this, so you have an N. Okay, and then we have an N bounce. So after the market must have proven itself by showing you first sign of turning, second sign of what? Turning. The third time you take a decision, all right, you take a similar decision to how the market have acted in the past. You take a similar decision to how the market has acted in the past. Remember, first time it turned down, second time it turned down, third time you take a similar direction to how the market has acted what in the past. All right, you take a similar direction. So this is, it forms an N. All right, so when the market comes here, all right, this has not been proven to be a support. Why? Because only one time like the market came and turned. So but if we have something like this, market coming here and turned, it's now relevant because we have at least 2 turns. All right, we have 1, then we have 2. Okay, so the market has turned. So whenever the market comes, whether 1 year time, 2 year time, according to the time frame we are trading, whenever it comes here to this particular zone, what should we be looking for? V bounce. All right, it's called the V bounce. When we see the V bounce, I'm going to, when we go into live trading of this strategy, I'm going to show you exactly how a V bounce looks like. All right, market coming down, it bounced up, so we are supposed to enter here so that we catch the potential movement that is supposed to come up. All right, we have the N bounce for resistance zones, we have the V bounce for support zones. All right, so that's how support and resistance act on a ranging market. They act by when they get to, and remember how we were able to confirm that this zone between 1 and 2 is a potential reversal zone, is because sometimes it can break. It's a potential reversal zone is that first the market came here the first time and had an action of turning. All right, it came here the second time and turned. So the third time, the 2 turns are given relevant to this zone. All right, if this market came here and broke up, we say okay, it's normal. because this zone was not that relevant. But first time it came and turned, came here again and turned. Third time, what do? We follow the trend. That's how we work in forex. We follow whatever is happening. First time it came and turned. Second time, third time, we look for our own entry reason. Alright, entry reason. That's why you cannot just enter, because you don't know if price now want to break. Alright, so you look for entry reason. That's why we have the V bounce. Alright, impulsive move, directional or reversal move. So that's how market acts in the ranging market. So now let's talk about how market acts, how support and resistance act. Alright, how they act in trendy market. Let's talk about how they act in trendy market. Alright, how they act in trendy market. So to know or to find out the way the market is acting, that support and resistance are acting in a ranging market, we do what is called trend line drawing. Alright, we do what is called trend line drawing. Trend lines are horizontal support and resistance. They are diagonal support and resistance. These are horizontal. Something is horizontal, is moving in a straight line direction from one point to another point, straight direction. When we say something is diagonal, it's moving, is it perpendicular? It's moving this way. Alright, this is diagonal movement. Alright, this is diagonal movement. Alright, either up or down. This is another diagonal movement to the downside. Right, diagonal movement to the upside, diagonal movement to the downside. So how do we know support and resistance in a trendy market? We talked about it in the ranging market, that it moves in between two prices. So does it happen in a trendy market? Only that we draw our support for an uptrend this way. Alright, we draw our support for an uptrend this way by connecting what? The lows, the higher lows. Bam. Alright, remember when we talk about uptrend, we say an uptrend is only an uptrend if it forms what is called higher lows. Right? So now, if we're able to connect 1, 2, we look for what? Our V bounce, because this has confirmed to be a support, a diagonal support. So we look for our what? V bounce. So we enter for a potential buying opportunity. Okay, so now when the market is going down in a downtrend, we try to draw a trend line that connects 2 points. If it doesn't connect 2 points, no relevance there. So once we're able to get two perfect connection, what do we look for again? We look for our V bounce. Alright, because the market has proven itself to be in a diagonal. Sorry, that was a mistake. This is let me draw for the downtrend. So we have talked about how the market moves in a trendy environment. Now let's talk about in a ranging environment. Now let's talk about how the market moves in a trendy environment. Okay, it's basically the same thing, only that in a trendy market we use what is called a trend line. Right? While here we use what is called a horizontal line to mark up our support and resistance zone. Over here in a trendy market we use what is called trend line to mark up our support and resistance zone still, only that in a trendy market the trend line we use are support and resistance, but they are not just ordinary support and resistance, they are diagonal support and resistance. When the market is moving this way, it's called diagonally. All right. When the market is moving this way, it's called horizontal. Okay, so we use this is for range. Market is moving sideward. All right, sideways movement. All right, but when the market is moving this way, it's moving diagonally. If that is moving this way or this way, it's moving diagonally. Okay, so we use diagonal support and resistance. And how we are able to confirm a diagonal support and resistance is that we have first touch, second touch, make addition, we look for V bounces at our third touch. And how we are able to draw this is by connecting the lows, all right, the lower highs that I told you about in the previous class. So we have L, all right, L, okay, and then we have L. So when we connect the lower highs or the higher lows, okay, the higher lows, because remember when we talk about upward movement, we're simply talking about market making sets of higher lows. The previous low or the present low is higher than the previous low. The present low is higher than the previous low, so it's making sets of higher lows. Now you know the market is going in an upward direction. So having connected the first low and we've connected a second higher low, we have been able to get two touches that gives relevance to a particular trend line we're about to draw. Alright, so the third time the market comes there, we don't just enter blindly, we enter with a signal, and that signal is a V formation. So for a downtrend, the market is moving downward, so it's moving diagonally. Alright, it's moving diagonally downward. So all we need to do is connect the highs. Alright, we need to connect the highs. Now we need to connect the highs. Alright, so the characteristic of a downward movement is that it's making sets of higher lows. Alright, HL, higher lows. Okay, HLs. And it's making sets of lower lows, higher lows. That's the characteristics of the downward movement. Okay, so higher lows. Alright, so all we just need to do to give relevance is to connect two higher lows. Alright, this is high and then this is higher low. So connecting two, it will give us a forecast of where the third one is going to happen. Connecting two, 1, 2 is going to give us a what? Forecast of where the third, the number 3 is going to happen. Okay, and then when we have seen the third touch, we look for a V formation. Alright, a V or is an N formation. We look for an N formation rather, because this is a resistance. Alright, resistance are meant to push market downward. This is a diagonal resistance. This is diagonal support. Diagonal resistance, diagonal support. So we look for N. Whenever the market goes to a resistance, we look for N formation. Whenever the market goes to a support, we look for V formation. So these are diagonal support, look for V formation. These are a diagonal resistance, so we should look for N formation. So that's what you need to know about price action. Alright, another thing you need to know about price action is very, very simple. That's the law of when a support is broken, it becomes a resistance. Alright, when a support is broken, it becomes a resistance. Let's say the market was moving in this particular direction. Okay, market in a trendy market moves by breaking reversal points, or by breaking, that's in an upward trending market breaks highs. Alright, let's say this is a high. Alright, the market moves by breaking that high and finding support on that high. Alright, if you want to move up again, what you just need to do, break this roof, make that roof a floor. Alright, that's how it does when it's going up. So now this is market structure, this is how market moves, this is price action. So if market wants to move upward, it moves upward by breaking highs and forming lows on those highs. It broke a high, alright, and then it formed a low on that high. That's what we call pullback. Break, impulsive move, broke, pull back to retest. Impulsive move, broke, pull back to what we look for, V formation, pull back to retest. Okay, look for V formation. So this is a high, and then we have a low. Alright, that's how it works. So on a downward moving market, we will have something like this. This is how we'll have it to retest. So we can have something like this. So how market move downward in a downward trend is that it breaks lows and forms high. Alright, and retests as a high. It breaks lows and it breaks lows and retests as a high. It breaks this low, this lower low, and retests as a higher low. As a higher low. Very, very important. Very, very important. We're following. Are you sure? Alright. So we have lows, we have lower low. Remember, whenever a support is broken, that's a downward turning point, is broken, it becomes a roof. Whenever a floor is broken, it becomes a roof. Whenever a floor is broken, this is the break. When we talk about breakout strategy, this is the break. It becomes a roof. Floor, roof, floor, roof, floor, roof. Alright, floor, roof, floor, roof, roof, floor, roof, floor, roof. Oh my, we'll have something like this. A floor. Okay, that is how price moves upward. Alright, this is how price moves upward. It moves upward by breaking a high and forming a low. That's it broke a high. This is the breakout. Alright, and retraces back to form a low. Okay, it broke a high, retraces back to form a low. Alright, a low. That's how price moves. Now if it's moving downward, how price move downward? Alright, how price move downward? Very simple. It breaks a low and forms a high. Breaks a low and forms a high. Right. So another law to support and resistance is that whenever a high is broken, it becomes a floor, right, or a low. Whenever a high is broken, it becomes a low. Whenever a high is broken, it becomes a low. Whenever a low is broken, it becomes a high. Whenever a low is broken, it becomes a high. Whenever a lower low is broken, it becomes a higher low. Alright. Whenever a lower low is broken, it becomes a higher low. So that's how market moves in trend. Notice, as this market is an upward trend, it's moving upward basically by breaking highs and forming lows. Breaking highs and forming lows. This one now is moving downward by breaking lows and forming highs. Breaking lows and forming highs. That is market structure. That is price action. Alright. First law, support and resistance. Whenever a market approaches a resistance zone, it falls back. What confirms the resistance? 1, 2 touch, third touch, enter for sell. Alright. What confirms the resistance? 1, 2 touch, third touch, enter for sell. What confirms a support? 1, 2 touch, third touch, you enter for a buy. What confirms a trend line that's a diagonal support? 1, 2 touch, third touch, you enter for a buy. What confirms rather a diagonal roof? It's first touch, second touch, third touch, you enter for a sell. Alright, you look for N formation. Alright, or on resistance, you always look for N formation. On support, you always look for V formation. So now let's look at this. Alright, let's look at this. This third thing to support and resistance is that whenever it's support, alright, whenever it supports, the lows are called support. Whenever its support is broken, it becomes a roof. Alright. Whenever a floor is broken, it becomes a ceiling. Whenever a floor is broken, it becomes a ceiling. Alright. Whenever a ceiling is broken, it becomes a floor. Whenever a ceiling is broken, it becomes a floor. Whenever a ceiling is broken, just like you are on the down floor, you're able to bore a hole over here. Okay, this is the roof of the down floor. This is like 1, 2, 3, 3-story building. Okay, 3-story building, and we have you here. You want to move up, you break here. Alright, and then you come down, bounce here, break here. Alright, come down, bounce here, break here, come down, bounce here, and that is how price move upward. It wants to move down, it breaks down, Alright, this is not a break. It comes up, breaks down. This is the break, valid break. More than 30% out. Comes down again. Goes up again. Retest that zone. Break. Alright, that's how price basically moves down. So now let's talk about
Okay, let's look. Right, let's look for support and resistance in a chart. Right, let's look for support and resistance in a chart so that we can see if we can catch those moves. Okay. So I want to show you the ways in which I draw my support and resistance. Okay, I want to show you the ways in which I draw my support and resistance. I basically draw my support and resistance on the 4 hours or any time frame. Support and resistance work on any time frame. Okay, they work on any time frame. Is it the 15 minutes? Is it the 1 hour? Is it the 4 hours? Is it the 1 day? Any time frame. Support and resistance work. Right. So how I basically draw my trend lines. They tell you the major law of drawing the trend line is to connect the lows. Okay, that's for an uptrend. When you see an obvious uptrend, okay, what you do is connect the lows. So this is a low, and then I just drag it to the future. I drag it upward. Let's say all of this has not happened. All of this has not happened. I want to catch this move. I just draw my trend lines upward like this. Okay, we just draw it like this. Okay. There are various ways of drawing it. Okay, that's not perfect. Start here. Okay, so there are various. This is the way I draw a trend line in a downtrending market. Okay, because you'll see very obviously this market is trending down. So all I just need to do is to connect the high. Whenever the market is trending down, what do? We connect the highs. Okay, so let's say we have seen this much. Let me box all of that. Okay, we have seen this much. Okay, how do you know if market is about to go down? What we just need to do is to see sets of lower highs forming. So you see this is a high, right? Because it's turns, this is a high, and then we have this is a low, right? Now you see this high is lower than this high. So we have seen sets of lower highs starting to form. Alright, sets of lower highs starting to form. So what you just need to do is connect the two that you can see and wait for the third one to happen in line of this. Okay, wait for the third one to happen in the line of this drawing. Okay, obviously we saw that the third one didn't happen close to that, so what we just simply need to do is to keep drawing trend lines, okay, and see the one that's after we have seen something like this, we could draw something like this. Okay, all I'm just doing is connecting the highs and waiting for the third one to happen in line of my lines. Okay, see, we have been able to draw from here. That's a high. I've gotten a lower high. So now the third one is happening in line of this our line. Okay, we drew from this high, then we have a lower high here. So connecting these two, we could catch the third one. Right? Having caught the third one, we see we are in the start of this impulsive move. We are at the very start of this impulsive move. So this was a pullback. Now we are at the start of this impulsive move. So let me just draw that. For better understanding. We have the market moving like this. We have the market moving like this and coming down. Okay, and then the market moved like this. So when it moved like this, we connected the highs. Okay, we connected this high to this high. Having connected that high to this high, we are waiting for the third one to happen in the line of this. Okay, in the line of this our drawing. So the third one happened here. Right? So we are able to look for other confirmations. I'm going to be teaching you other confirmations that you need to see to enter for a sell, right? To catch this move. So, but for now, what I need you to know is just how to draw trend lines. Master it. Practice. Connect the highs you are getting. As you want to forecast a downward movement, connect the highs. You want to focus an upward movement, connect the lows. Okay, just let them touch. Okay, so I'll be drawing my trend line like this in this scenario. I'm trying to connect this low, which is that if I'm trying to focus an upward movement, I connect the lows. If I'm trying to focus a downward movement, I connect the highs. Okay, so now you see the market has as for an upward movement, we have a low. We have a low that is higher. We have another low that is higher than this low. Okay, so we connect them. So if even though we had connected like this, we'll have been able to catch this. Okay, we'll have been able to catch this particular movement because it happened in the trend line. It happened along the axis of where we drew our trend line. Okay, so we connected from here to here. That's these two lows, and then the third one happened in line of where we drew our. So we do further confirmations. I'm going to teach you how we do other confirmations to get an entry for the third touch. Okay, so we had on this particular point we had the first touch, we have the second touch, and over here we have an M bounce. Alright, what are we looking for? An M bounce. Right, let me just box that. Okay, so over here, what do we see? An N bounce. Okay, an N bounce. If you could see what I'm saying, there's an N bounce along the line of the trend line we have drawn. Okay, there's an N bounce along the line of the trend line we have drawn. So we'll just keep drawing trend line. So to draw a trend line for a downtrend, remember I say you connect the highs. Okay, that's you connect the higher lows. Now see, this is a high, this is also a high, but the difference between this high and this high is that this high is lower than this high. So this is a lower high. Okay, it's a high, but it's a lower high. Right, so that this is a low, this is a low, and this is also a low. But the difference between this low and this low and this low is that this low is higher than this low, so it's a lower high, right? Right, and then we have this low being still lower than this low. So this particular low is called the lower high, and LH. This one is a low, LH, because it's higher than this, and then this is higher than this. Right, so we just connect two. We connect the first one, which happens to be 1. Let's call it 1. Okay, and then when we get the second touch, we wait for the third one to happen along that line. Okay, so we connect this is 2. So after connecting these 2, wait for the third one to happen along that line. I'm going to be seeing what's going to be the result. So when the third one happens, we start looking for confirmations. Right, But what I want you to focus now on is how to draw these lines. Okay, how to draw this line. So the best way to draw this line is to zoom out. So you see the whole price action, the whole market price action. Like now, see in this area, I want to draw a trend line. Or after zooming out, I am able to see the best of everything that is going on in this market. I'm able to see the best of everything that's going on in this market. So all I need to do is connect the lows that I can see. Right, connect the lows that I can see. So having connected here to here, I'm able to catch this V bounce that's about to happen. Alright, let me draw it out. I'm able to catch this V bounce. Alright, so let's see. Connected to, we have something like this. Okay, we have something like this. So the third time we have a V bounce. Okay, the market coming down, it bounced, it got rejected, and it went as up as this. Okay, so this is V bounce. Alright, so you just practice in an uptrend. Remember, you connect the lows. Okay, that's the higher lows, and then in the downtrend, you tend to connect the highs. Okay, the higher lows. Okay, let me try to draw a trend line in this scenario. Let me try to draw a trend line in this scenario. Okay, this is how I will have drawn my trend line. This is how I will have drawn my trend line. So from here to here to here. And if you notice how I'm drawing my trend line, I'm drawing it from body to body, and then this happened along where I draw my trend line, from body to body. Okay, from body to body. What I simply mean by that, I'm going to explain. What I simply mean by body to body, I'm going to explain. Then I'll talk about week to week. Okay, so now this is an example of week to week. An example of week to week. Alright, I don't want to confuse you, but I usually draw my trend line from either body to body or week to tip of week. Okay, so I'll explain that further, but all you need to do is that you're connecting the lows. The major thing, you are connecting the lows, right? You're connecting the lows so that the third time you make your decision. So I'm still drawing trend lines in this particular market. You see what I just do now. You see I've been able to connect this with this, that now we have body to weak tip, body to the shadow. All right, body to shadow, and we have another bounce here. You see, it's so perfect. We are catching the beginning of this moves, right? This moves. So we have an end bounce. Remember, a diagonal resistance, we usually have an end bounce, right? So we have something like this. Market coming down, getting to that point, it got rejected. So we have something like this. I'm trying to draw it out so you see exactly what I mean. Okay. So you see, having connected these two from here to here, we're able to catch this third one and this fourth one. Okay, that is all you need to know. Just practice on how you can draw trend lines. Okay, from your manual that you have, we'll be giving you charts on that manual. So you just use a pencil and the manual. You just draw the trend lines on the manual, and then check your index to see if you are correct. Okay, that's how you can master the act of drawing trend lines. So from our weekly analysis videos, we're going to be drawing trend lines on those weekly analysis videos, so you could also learn from there how to draw trend lines. Okay, you learn also how to draw trend lines. So we just remember, in a downtrend we connect the highs, the lower highs. Okay, in an uptrend we connect the lows. Okay, connect the lows. That's we connect the lower highs. We connect the lower highs so that we can catch a V bounce. Okay, so that's how trend line works. So let me just talk on the principle of body to body and body to week and week to week. Right, body to body, body to body, body to week and week to week. Let me just talk more about that principle. Okay, example of body to body, body to week and week to week. Let me just do a quick example of drawing trend lines that way. Okay, we have the top of the week connecting to the tip of the week. Right, this is how you can draw it. You draw that's this week, this very week, this one connecting to the tip of this other week. You see, we'll have not caught this movement doing that. So that's why it's not just only that way you draw. So if you draw it like this, that's tip to tip, and you don't catch, you also draw it like this, right? Body to what? Body. So body to body, you cut. That's tip of the body. Let me zoom in so you see what I mean. So we have body, this is the body, that's body, and then we have to body. So you cut it, cut this move. That's the market touched here. So after it touched, you look for your end bounce. Okay, it's your end bounce. Okay, so that's how you basically do body to body. So that's how we basically do tip to tip. Then we talk about body to body. So let's do tip to body. We can do it all in this particular diagram. So you can do all of them. Okay, you can do all of them. So you catch the movement. You catch the movement. Okay. So you could do tip to body. Let's do tip to body. Okay, let's do tip to body. Let's do tip to body. So we do tip to body. We're gonna have something like this. Tip to body. Good. Tip to body, you'll have cut this bounce. Okay, you'll have cut this bounce. And that bounce is not just an ordinary bounce. This bounce pushed the market down by almost 100 and 200 pips. It pushed the market down by 200 pips. Oh, even more. Pushed the market down by lots of pips. Okay, that's like almost 300 pips. Okay, 300 pips. Right, this is our pip calculator. This is what we use to measure the distance covered by the market, right, in a particular direction. This is what we use to, this particular tool in TradingView. TradingView is what we use to measure the distance covered by the market in a particular direction. So we have the market bouncing here, and then when we measure, it went 300 pips. Okay, 325 pips to be more precise, or 333 pips to be more precise. Okay, so that's how we'll have used body to body, that's body to body, tip to body, and then wick, that's tip to body, tip to body, tip to tip, body to body. Okay, and we could also do it here too. We could also do it here. So I just need to do is zoom out so I can see the whole market structure. Okay, I can see the whole market structure. So I could draw something like this. Alright, so this is an example. I think body to body, body to body, body to body. Let me zoom in so you see. Oh, it's not body to body. This is not body to body. This break is a fake out. So we have something like this. Right, we have something like this. So you have something like this. The most important thing is looking at drawing these lines perfectly. Here, that's body to body. This reversal, this is V bounce actually, but it's a breakout V bounce. It's not, it's a breakout V bounce. So this breakout V bounce is happening in the line of our trend line. It's happening in the line of trend line. So we'll have looked for, because of our other confirmations, we'll have entered around here. We'll have entered around here and still catch this move. Okay, we'll have entered around here and still catch this move. So the most important thing is that we drew from body to body. Alright, so now we can draw from body to wick. Now you see, can you notice this small wick over here? This very small wick. Okay, so let's take the body from body to that wick. Alright, still the same thing from body to that tip, the tip of that small wick. Alright, so that's how we do it. That's how we do it. So we could do wick to wick. Let me look for a scenario. Let me look for a scenario where we have wick to wick. This is a scenario. This is a scenario where we have wick to wick. Okay, and then yes, this is a scenario we have wick to wick, and then we saw the market making an end bounce in the line of this our wick. Right, an end bounce in the line of this our wick, an end bounce in the line of this our wick. Okay, it's an end bounce in the line of this our wick. Right, so that's what you need to know. That's what you need to know for now. You just draw your trend lines perfectly. Draw your trend lines perfectly. So the practical book is meant to sharpen your skills when it comes to drawing trend lines. Okay, sharpen your skills when it comes to drawing trend lines. So I'm going to be drawing as much trend lines as possible. Right, I'm drawing as much trend lines as possible. Right, so 1, 2. We take decision from here. Take decision from here and all of that. Okay, 1, 2. Decision here. Decision here. All right. So we could do, this is body to body, and then to another body and all of that. So we could, I'm saying that just trend lines are everywhere, support and resistance are everywhere. I just know how to draw them rightly. Okay, just know how to draw rightly. So we have wick to wick. If you look at this scenario, we have wick to wick. Okay, wick to wick, and V bounce over here. Okay, so wick to wick, V bounce. We had the V bounce here, wick to wick tip, and we had the V bounce here. Okay, so wick to wick, V bounce over here, V bounce. Okay, that's how it works. So we could do wick to body. Wick to body. We'll catch this small move. Okay, that's wick to body. That's tip of wick. We're looking at the tip of this wick to the body of this. and then we cut this little move. Okay, this little move. Okay, as I told you, I'm going to be showing you how I draw my trend line. Okay, there are three basic ways. There are three basic ways in which I draw my trend line. So I can draw my trend line connecting the body, that's the topmost part of the body, to another topmost part of the body. Then we look for our V bounce here. Okay, we look for our V bounce here. Or I can draw my trend line this way. This one is called tip to tip. I can take the tip of the candle to another tip of a candle, so that the third one happens here. So we say tip to tip. Alright, that's the tip, that's the very tip of the candle to another tip. So the V bounce happens here. Or I can draw my trend line this way. I can draw my trend line from wick tip, that's the tip of the wick to the body. Alright, the tip of the wick to the body. So we have wick top, that's the wick tip to the body. We have the body to the body, right? And then we have the tip to the tip. That's the way I draw my trend line. So for those of you that don't understand, let me just make it very, very clear. So for the tip to tip, you see, this is the tip of the candle, right? This is the tip of the candle, right? And then I'm connecting it to the tip of the candle, right? That's what I'm basically doing to draw my trend line. So another way I do it for body to body. Okay, this is tip to what? Tip to body. If you notice, I'm taking it from the tip of the candle to the body of the candle. Alright, so this is wick to tip. Sorry, we have tip to body. So now, the scenario where we have tip to tip, from the tip of the candle to the tip of the candle. Alright, the scenario where we have body to body. Remember, the scenario where we have body to body, we have from the beginning of the body, that's the body, to the beginning of what? The body. Those are the ways in which I draw my trend line. Those are the ways in which I draw my trend line. So let's talk about resistance. How does support and resistance, that's in a ranging market, how do we trade a ranging market? How can you trade a ranging market? Right? Remember, ranging markets are a market that are in consolidation. That's market that are moving sideways. Okay, how do you trade? That's how do you find support and resistance in a ranging market? Alright, so I don't expect you to understand all of this, right, at a time. Alright, okay, I don't expect you to understand all of what I'm doing right now at once. But as we go on with the weekly market analysis videos and other videos I'm going to be doing in the week, you're going to understand why I draw my trend. That's my horizontal lines like this in a ranging market. Okay, so with time you're going to understand how to draw perfect lines like this. If you notice, remember the law we talked about, that whenever this is support, right? Because the market coming down, it went up, right? The market coming down, it went up. So when the support was broken, it becomes a resistance. I see that when this support was broken, it becomes a resistance. So now the market coming up back to this support, it resisted. Coming back to this support, it resisted. Coming back to this support, it resisted. So this support has been broken. It now becomes a resistance. Okay, so how I like to look at support turning into resistance is that, okay, there were buyers here that were taking the market upward, buyers here taking the market upward, buyers here taking the market upward. So when these buyers were conquered, what happened? The sellers now took over this position. They now took over this space, so that whenever the market comes back to this place, they sell to take the market downward. Comes back, they sell to take the market downward. Come back, they sell. So now the market is in a range. If you look at this, the price action all over this area, market is in a range. So we just try to connect the turns. Okay, that's the highs. We connect the highs. We connect the highs. All of this, we want to get the most amount of touches. We have the first, the second, we connected the third, and we got the fourth. So that whenever the market comes to this area, I told you that it's not just a line; it's an area. Okay, so we could say this is the area. Right, this is the area. It should not be too big. This is the area. So whenever the market comes to this area, we look for an end bounce. Comes to this area, we look for an end bounce, end bounce, end bounce. Alright, we have not worked here because it was a freak out. Alright, so we have an end bounce, all of that. So that's how you draw a resistance, a ranging resistance. Alright, so I'm going to be drawing lines to help you further understand that. Right. So now looking at this, we see that we have connected this. I've been able to connect this. This was a turning point. This was a fake out. You see, fake outs happen a lot of time. It was a fake out. Right. And then we have the V bounce. We have the V. All of these are V bounces. All of these are V bounces. Okay. So now having connected this clear one you have seen, and connecting this clear one and connecting the most touches, that's the most amount of touch that you can get. All right. We'll be able to catch this. We'll be able to catch all of this. We'll be able to catch all of this, all of that. So let me just see if I can draw how price moved. Okay, I like to draw how price moved. All right, so I have movement like this. Told you these are my range. This is how a ranging market is supposed to look. All right, if you're not seeing those lines, let me change my lines to a black line. Okay, so you can see it. I believe you can see it better now. You can see it better now. So I'm just trying to draw how price moved. So you see price is just moving in between a range. It's not going further than this. It's just moving in between the range. Alright, moving in between this range. Whenever price come up to this zone, it goes down. Whenever it come up to this zone, it goes down. That's how price continues to do. Alright, whenever it come up to this zone, it goes down. Alright, whenever it come up to this zone, so the price is in a range. Okay, price is in a range. You come up to this zone, goes down. So you'll be catching whenever price come here, you sell. Whenever price come here, you buy. Whenever price come here, you sell, buy, sell, buy, sell, buy, and all of that. That's how you catch price action in this kind of move. Alright, in this kind of move. So this is a ranging move. Okay, so this is how you catch price action in that kind of move. And then when we get a breakout, we'll come and see a retest here. So this is recent what market is going to do. Right, we got a breakout around this area, so we are coming to get a retest around this area. We're supposed to see a retest around here. Okay, so we have something like this. We're hoping to see a retest as market coming here and going down, right? Coming here to retest and going down. So that's basically, so when we do our weekly videos and other videos that we're going to be doing, you are going to better understand all of this. Okay, and then with your practice using your manual book, you're going to understand all of this. You're going to better understand all of this. Right, so looking at this market, you could see that from this place, that's from here to about this point, the market was ranging. Okay, the market was ranging. Okay, so how we have caught this move, what we just simply needed to do was to draw we are supposed to draw horizontal support and resistance. Okay, so I would have to zoom out. Maybe my chart was a little bit inward like this. All I just need to do to see the range is that I'll have to zoom out. Okay, zooming out, I'll see that the market, I'll look for places that the market touched more than one time. Okay, see, imagine the scenario. If I connect here, okay, look, we want more touches. Alright, we want more touches. We're looking for scenarios where the market touched more than one time. Right, so this is my resistance. We got to fake out here. But we notice, if you notice that whenever the market comes to this zone, it was even this fake out. It was a fake out. So we got a fake out here. We got the market resisted at this point. So you see, the fact that the market is coming to this point and resisting, it has given relevance to this line we just drew on the chart. Okay, this is just a normal line that we drew on the chart. Okay, and that line is rejecting price. It has the power of support and resistance. This is the power of resistance in this scenario. So if you notice, whenever the price comes to this zone, it got resisted. So it happened the first time, it happened the second time, it happened the third time, it happened the fourth time. So after happening 1 and 2 times, we know that in fact this is the second time. Alright, if you zoom closely, you see that this is the second time. So after happening 1, 2, we do it the third time. That's whenever the market comes here, we look for our end bounce, right? Because it's a resistant, we look for end bounce. Support, we look for V bounce. Okay, so it happened here, we're not taking action. It happened here, we're not taking action. So from the third time the market is coming here, we look for what? Our end bounce. So we got our end bounce here, 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 and then we got our end bounce here, we got our end bounce here, end bounce, and all of these are end bounces. Okay, so that's how we draw resistance. Okay, now drawing support, all we just need to do is connect the downward. Okay, that's connecting the down. So we see the market retraced, that's coming down, it went up, it came down to this same zone. That we want to draw this line in a way that it has more touches. Okay, so we take it a little bit up, we see that we can catch this, we can catch this, we can catch this, we can catch this, catch all of this. So when we have gotten this happening the first time, the second time, we can start looking for V bounces from the third time, the fourth time, the fifth time, the sixth time, to the seventh time, and then all of this, okay, all of this. This will have been a whole lot of money for you to make, a whole lot. So this is when the market was in a range. Alright, this is when the market was in a range. So we saw a fake out. This is a fake out. Even this is a very big fake out. It seemed as though the market had broken this range, but we saw the market moving back into that range. So that is how you draw a horizontal support and resistance. All you just need to do is look for the touches. Alright, try to draw a horizontal line that has price reacting by turning to the opposite direction. That if you look at this, the market turns in the opposite direction. It happened the second time over here, it happened the third time over here, it happened the fourth time, the fifth time, the sixth time. So we'll have cashed all of this. So having for the fact that it has done the first time, the second time, and we drew this our line, when it happens the third time, we'll cash this. When it happens the fourth time, we'll cash it with the other things I'm going to add to the strategy. You're going to know how you can catch all of this. Right? You're going to be catching all of this. Okay, yeah.
Okay, so this is your first profitable strategy. This is your first profitable strategy, and it's going to be the London breakout strategy. Okay, first thing you do to set up your London break strategy is to go to tradingview.com, as the mentor has already opened tradingview.com for you. All you just need to do is log into your tradingview.com. While logging into your tradingview.com, search or add the symbol Euro US dollars. Okay, Euro USD. No, it has to be all, so you could see Euro US dollars. So you add the Euro US dollars. Okay, after adding the Euro US dollars, ensure that the time frame is in the 1 hour. Okay, when you set your time frame at 1 hour, it means each of these candle is going to be worth 1 hour. I mean, it's going to take 1 hour for each of them to form. So having said that, if you notice, look down where we have the black. You see, this is 2 o'clock, this is 3 o'clock, this is 4 o'clock, this is 5 o'clock, this is 5 o'clock, this is 6 o'clock, then this is 7 o'clock. Okay, so you look at the 7 o'clock candle, but before looking at the 7 o'clock candle, ensure that this time zone is set to London. Alright, I told you earlier that this is the London breakout strategy, and this is step 1. Alright, so this is step 1, this is the London breakout strategy. So you set your time zone to be at London, so you click London. Alright, so the 7 o'clock candle is the focal point. All you just need to do is to box the 7 o'clock candle. This is the 7 o'clock candle. I'm going to be looking for horizontal line. This is where you get horizontal line. Alright, you see trend lines, info line. Yeah, this is what I click. Trend lines, info line. And this is horizontal line. Okay, so I'll click on the horizontal line and box. This is the candle I'm looking at. This is my focal point. So I'll box it. I'll put it in a box. When I say box, I'll put it in a box. Okay, and I'll close that. I'm going to enclose the high and the low of it. I'm going to enclose. Remember when we taught you guys about the high and the low? Okay, the high and the low. So I'm going to measure 3 pips. Alright, 3 pips above the high and 3 pips below the high. That's where I'm going to set my pending order for this step 1. 3 pips. Now it's 3.6. So roughly 3 pips, like 3.3. We can take 3.3. Alright, roughly 3 pips. So we're going to, using alternate H, we can get our horizontal line automatically. So after I used this tool, this is called the pip measurement tool, to measure out 3 pips. So I'll measure for the low of the 7 o'clock candle. This is the 7 o'clock candle, right? I'm going to measure 3 pips below the 7 o'clock candle. Okay, 3 pips below the 7 o'clock candle. So this is 3 pips, around 3.3. That's about 3 pips below the 7 o'clock candle. Then all I need to do is to delete this. This was just like an indicator. So the idea is to box your 7 o'clock candle. Alright, as soon as your 7 o'clock candle closes, you box it. Alright, and then measure 3 pips away. That's from the high, and 3 pips from the low. So this is what's the first step. Alright, this is the first step. So you just need to do, I'm sure you have your MetaTrader on your laptop, installed on your laptop. So you just double click on this. Alright, if it's in style, you click coordinates and copy this figure. This is what you're going to use for your buy stop. Whatever, when it's up, it's a buy stop. When it's down, it's a sell stop. Okay, so you click, if it's in style, you click the coordinate and copy this. Alright, you copy this. So I'll cut or copy, I'll copy Ctrl C. Okay, Ctrl C. So I will now go to my MetaTrader app and place a buy stop. That's where my buy stop is going to be, and my sell stop is going to be here. You place a sell stop to catch a downward movement. You place a buy stop to catch an upward movement. Take note, you place a buy stop to catch an upward break, and then you place a sell stop to catch a downward break. So I'll just go to my MetaTrader app. This is my MetaTrader app. Alright, this is my MetaTrader app. So what I need to do now is to place an order. So to place that order, it's going to be a pending order. So I'll come to new order. Alright, I'll choose the lot size. For every $100 you have in your account, you use 0.02. Alright, you either type it, say 0.02. Okay, so that I'll look at this particular place instead of market execution. Remember when we talked about market execution, that it's to enter at the moment. All right, is to place the trade at where the market is, but we don't want to place the trade at where the market is. We want to place the trade 3 pips above the high of the 8 o'clock, of the 7 o'clock candle. So we come and we click a buy stop. All right, a buy stop, and then we paste that price. Ctrl V, we paste that price that was mentioned. That's the 3 pips away from the high, and then we place a pending order. Why it's acting this way is because the market has already reached the pending order place before we are actually late. We are like 28 minutes late. So the market is already at the spot where we want to place our pending order. So whenever the market is at the spot where you want to place your pending order, you can just do a market execution because it obviously broke the high. Alright. So that is what we'll do. It obviously broke the high. So we are placing a direct trade. 0.02. Okay. So now, if it had not broken the high and the market just closed initially, we'll have placed our buy stop 3 pips above, and then place a sell stop 3 pips below. So how do you place a sell stop? You copy this, you double click. Remember, you double click on this line, which is 3 pips below the low of your 7 o'clock candle. 3 pips below the low of your 7 o'clock candle. So how do I know it's 3 pips? I use my measurement tool, this very tool. I click from the lowest low, that's the low of the 7 o'clock candle, and I measured around 3.3 pips, roughly 3 pips. Okay, so I'm going to double click on this to get the figure, the coordinate figure, and then I'll copy this. So I'll use it for my sell stop. Okay, I'll use this for my sell stop. So I would copy this. So I will double click and highlight and then copy it, Ctrl C. Okay, so I will now take it to the chart. And click on new order, the same lot size I use for my buy stop, and then I click on pending order because it's also a pending order, but now sell stop. The down one is the sell stop. All right, the down is the sell stop. So I'll just paste. Okay, and place a sell stop. So this is the exact trade. This is the exact trade that opened. This is the exact trade. Okay, this is the trade. So having done that, and I see that the market has triggered the up, that's the up trade, I will just simply delete this by pressing cancel. Alright, see 0.02, the trade will open 0.02 euro US dollars. Okay, 0.02 euro US dollar. I'm going to cancel this one since it has triggered the top. Alright, it has triggered the the high, that's the highest wick. It has already triggered the highest wick. That's 3 pips away from the highest wick. That's triggered. So we know that the market wants to go up. Okay, 70% of the time it's going to go up, but not every time. So I want to teach you how to make profit those 70% of the time, and even how to make profit even when the market is not going in your direction. Okay, so now remember if this candle, new candle, if we were early enough, we would have not been caught out. That we would have not placed the market execution trade. We're only placing that market execution trade because obviously the market has broken the 3 pips high, or it has broken our 3 pips high first. Okay, so the first step is for the market to break your 3 pips high or your low. You can choose. So just draw your business is to just take measurement from the high. All right, take measurement 3 pips from the high, around 3 pips, roughly 3 pips, and then take roughly 3 pips from the low. Okay, roughly 3 pips from the low. Okay, that's your business. And place this. You place these horizontal lines by pressing after measuring 3 pips. That's clicking the low. You measure 3 pips. You click on Alt H. Okay, Alt H is the shortcut for placing the horizontal line. So Alt H, and then you measure 3 pips above, 3 pips above the high. This is the high of this candle. 3 pips above the high, and then you do Alt H again. Alt H. Okay, so that's how you get that. So after doing that, you are going to double click on the high, copy the coordinate, and place a buy stop. Okay, double click on this high distance, on the high horizontal line, and place a buy stop, because you are forecasting, you are giving an instruction to the broker to open a buy trade if the market gets to that place. So the place the market gets to, first of all, the trade is going to be triggered, and it's going to be triggered open. So once a direction has been triggered open, what you simply do is you close the other direction. You close the other direction, and then the next step is to place your hedge. All right, is to place your hedge. So the up one, you place a buy stop. Copying this, you're going to be placing a buy stop for the up, and then you place a sell stop for the down. That's for the down 3 pips. So sell stop for the down. Okay, so now the market has triggered the up. Okay, the market has triggered the up. So what do we do that the market has triggered the up? We close this. We close this. Okay, we take off this. Okay, we delete it. We click on delete. All right, we delete that. Now we now know that the market has picked a direction which is upward. So now, since the market has picked a direction upward, we are going to measure from where the market, that's our entry. If it has picked downward, we'll have closed the up. Now we pick the up, so we close the down. So we're going to measure. We're going to measure from the entry. We use our pip calculator. We use this calculator a lot. That's this pip calculator. Our measuring tool. We use it a lot. So we'll place it on the body, on the line, on that very line, and then measure. Want to see how far. That's this very candle. All right, this very candle. That's the 7 o'clock candle, which is our focal point. The 7 o'clock candle is our focal point. So now looking at the 7 o'clock candle, which is the red candle that you can see over there, from measuring from our entry to its low, it's about 14 pips. So we round it up to 20. We don't want anything less than 20 pips. All right, so we place Alt H again to place where we are going to be placing our hedge. So this is where we are going to place our hedge. And remember, our hedge is a trade in the opposite direction. That's a sell stop trade. So our hedge in this scenario is going to be a sell stop with double the lot size used for buy for the trade that triggered, okay, that triggered. So that is what our hedge is going to be. It's going to be double the lot size. So remember, our hedge is going to be placed 20 pips below where we entered. All right. So now, what have we been able to do? We have been able to create a zone recovery. All right. We have been able to create a zone recovery. Okay. That's what we have been able to do by following these simple steps. So we'll go now and place our hedge. Okay, we'll go now and place our hedge. So our hedge sell stop It's a sell stop order. It's a sell stop order because it's a pending order. The market has not gotten there, but we are just saying, just in case the market retraces here, that's the market from here retraces down here and triggers here, we should place a trade. That's a sell stop. We should place a trade with double the lot size we used for the trade that triggered. That's the up trade now triggered, and we use. Remember, we were using for $100 account that we had. We're using 0 point that we have actually. We're using 0.02. So here it should be 0.04 because it is double the size of the initial trade that was triggered. So we'll copy this figure by double clicking. We'll copy this line. That's the percentage of this line. That's the calibration of this line. We'll copy that by double clicking. We'll copy the figure and then Ctrl C. Ctrl C. We have copied the figure. Okay, now we'll go to place our hedge. We'll go and place our hedge right now. We're going to go and place our hedge. So to place our hedge, we'll click on new order. We double the lot size, which is 0.0 to 0.04. All right. These are, make sure that the pair is euro US dollar 0.04. We come instead of market execution, which means enter now. We say no, we don't want to enter now. We want it to be a pending order. Hedges are meant to protect you. Okay, so if the market goes against you, I'm going to explain why we are placing that hedge. All right. So if the market goes against you, you are still going to come out profitable. All right. So now we place our sell stop. All right. This is our sell stop, and we place that figure. Control V. Control V. Okay. So that is that. So after doing this, you place your trade. It's a pending order. See the trades that are currently on. Okay. The trades that are currently on are reading, while our pending order. So what we just placed now. So this was the sell stop order that we initially placed. Okay, this was the sell stop order that we initially placed before we had this one triggered. So when this one was triggered, we simply just cancel it. Okay, we cancel that sell stop order, and this is our hedge. Okay, this is our hedge. We leave the hedge, but we cancel the sell stop order. All right. So what is going to be a take profit order? Let's go and find out what our take profit order will be. So now take profit order, because it is 20 pips. Now it's contextual because it is 20. When I mean contextual, it's according to the context. All right. So it's contextual because it is 20 pips. We're able to measure from where we entered. We were able to measure a round figure which was 20 pips. We are going to be targeting 50. Okay, we're going to be targeting 50. Our target is going to be 50. All right. It's going to be 50 pips. I'm coming. Let me take this off. Our target is going to be 50 pips. Okay, so we'll measure out 50 pips by drawing. That's 50 pips to the buy side because it triggered the buy pending order. So that's the 50 pips. Okay, you use Alt H to place the line there to mark your take profit for the buy trade. Okay, to mark the take profit for the buy trade. So now, if the market comes and triggers our sell trade, for example, we don't know if that is going to happen, but in case that happens, this is going to be our take profit for our sell trade. All right, this is going to be the take profit for our sell trade. It's going to be 50 pips. Okay, also going to be 50 pips. So Alt H to mark that part up. Okay, so now I want us to go and edit. We want to do what? We want to modify our orders. We'll modify our stop loss order. That's our sell stop order. And we're going to modify our buy trade that has been triggered. All right, it was formerly a buy stop that was triggered. So we're going to modify it. We want to use this take profit. Okay, we want to say, okay, if it goes by, it should take profit here. All right, if it continues by, it should. That if it continues buying, it should take profit at this level, this very level. Okay, the level of 1.1342. 1.13428. all right, that's the level we want it to take profit. While if it goes down against us and triggers here and come to this point, it should take profit at 1.1216. all right, 1.1216. Please listen very, very careful, and this is the most important part. This is the most important thing, because this is where you make the money. Okay, this is how you make the money, basically. So now see, the market triggered up. We're saying if it triggers down here, it should take profit here. You know, we have placed the sell stop order, which is double the lot size of this. Okay, double the lot size of this. We have placed the sell stop order already. So now we're saying if the market goes negative and triggers here, it should take profit here. So let's now set the take profit for our buy stop. That's our buy trade that triggered. So we double click, copy the coordinates. Alright, copy the coordinate, go to our MetaTrader app, and then edit that very trade. Okay, that very trade that we just opened this morning is what we are going to be editing. Okay, and this is the trade. This is the trade. So I would right click, click on modify, and then this is your take profit. So I'll just highlight this and Control V. So we have been able to set a take profit. Alright, so after setting your take profit, you will want to know where the stop loss is going to be. Okay, the stop loss is going to be the take profit of your hedge. Okay, so now I'll go back to my chart. I'll go back to my chart. This is our take profit. So our stop loss for this trade is going to be the take profit for our hedge. Okay, it's going to be the take profit for our hedge. So we'll measure this. We'll measure this out. So we'll copy that, rather the coordinates. We'll copy that. Control C. Okay, Control C, and then we'll go back to this field and paste it. Okay, we'll paste it. So now we have our normal take profit, which is 50 pips above, and we have our stop loss, which is about 70 pips, because if you want to measure from where we entered, it's about 70 pips. All right, it's about 70 pips below, because our zone recovery is 20 pips. So take note, our zone recovery in this scenario, all right, is 20 pips. But if, just in case, we had a scenario where you had measured 3 pips from 3 pips above, you measured down, and it was like, let's say 21 pips or 22 pips, you go to the next round figure. You go to you put your hedge trade in the next round figure, which is 30. If it's more than 30, you put your hedge in the next round figure, which is 40. That's where we stop. All right, I don't think there's any of these candles that can go above 40 pips. Okay, that's the early morning candles. I don't think any of them can go above 40 pips. Okay, just saying. There's a possibility when there's news anyway, but only at rare cases. Okay, rare cases. So we stop at 40 pips. So contextually, if after measuring, for example, 3 pips above the high, all right, 3 pips above the high, and then the trade triggers the buy side of the market, and then we closed the sell trade we had, which was 3 pips below the low. We closed that out, and then want to measure our zone recovery. We simply place our measuring tool, all right, and measure if this was not 13, because it is 13, we went to a round figure, which was 20. Okay, but if this was like, let's say 22, we go to 30, which is a round figure. If this was like 32, we go to 40, which is a round figure. So our zone recovery is contextually. So now, because of this context, this scenario, after measuring from the 3 pips that was triggered, that's the 3 pip buy stop that was triggered, we saw that it was 13, so we put it to the round figure, which was 20. Okay, which was 20. So listen very, very careful. So now we have placed our take profit for the buy stop. Right, we have placed our take profit for the buy stop. Now I want to place, and we got the stop loss for the take profit. All right, this was our take profit for this our buy trade. This is our take profit. Then our stop loss was the take profit for our hedge. Okay, this is our hedge. We are going to go and modify the trade we have there, and the take profit is going to be this. All right, for our hedge. So let's go and modify our order. So we just click on modify. That order has been modified. Okay, that order has been modified. So the next thing to do, the next and simple thing to do is to modify your sell stop order. Okay, this is your sell stop order. The very trade we took on the 13th. Today's date is 13th of March. Right, as you can see, 13th of March. So this is 13th of March 2019. All right, so this is the very trade we took today. So we want to modify our sell stop. We want to put its own take profit. So we right click. All right, click on modify. All right. So we'll go to our chart and copy 50 pips. You know, it's actually 50 pips. And these our take profits are contextually. All right. I'm going to give you the figures because it is a 20 pip zone recovery. We are using 50 pips. Okay, because it's a 20 pip zone recovery, we are using 50 pips take profit target. If this was a 30 pip zone recovery, we'll use 75. If it was a 40 pip zone recovery, we are going to use 100 pips. All right, we're going to be using 100 pips. So for every 10 pips zone recovery, for example, if for every 10 pips zone recovery, we are basically using 25. All right, we're basically using 25. So 20 pips, 25 plus 25, we have 50 pips zone recovery. So 30 pips, 25 plus 25 plus 25, which is 75. All right, so now let me just write that out. 30 pips for 20 pips zone recovery, 20 pip pips zone recovery, our take, that's TP target equals to 50 pips. All right, 50 pips. All right, for 30 pips Z arrow, that's our zone recovery. Let's use Z arrow as our zone recovery. Z arrow is equals to 75. Okay, for 40 pips Z arrow, it equals to 100 pips target, right? 100 pips target. Right, so this pips target. Right, so this is what we are talking about. So this is your formula. 20 pips zone recovery. That's after it triggered our buy trade, we measured 20 pips. And why do we measure 20 pips? Because when we measure from the high, that's where we got triggered, to the end of this our 7 o'clock, the red candle that we have here, which is our 7 o'clock candle. Alright, our 7 o'clock candle, we saw that it was 14 pips, so we rounded it up to a round figure, which was 20 pips. Okay, so for 20 pips zone recovery, our target is equals to 50 pips, so we will be targeting 50 pips. If this, let's say after measuring from here, and it was like 22, that is the red candle, the tail of the red candle. When I say the tail, I mean the low of the red candle was like 22. We'll have measured 30 pips zone recovery, like 30 pips zone recovery. Okay, 30 pips zone recovery. And if we are using 30 pips zone recovery, is equals to 75 pips target. So that means our take profit for our buy will have been 75 pips. Okay, then our take profit for our sell using our TP calculator will have been 75 pips, around 75 pips. Okay, around 75 pips. That's how we do it. So now, to go further, we want to set our take profit target for our hedge. Okay, we want to set our take profit target for our hedge. So this, if the market comes down and triggers our hedge, this is where we want to take profit out of that our hedge. Okay, we want to take profit at 50 pips. So we'll double click on this. We're going to be double clicking on this, and then we're going to copy it out. All right, we're copying it out, and then we'll go to our MetaTrader app and then place it in take profit. Okay, so that's going to be our take profit target. All right, take profit. Now what's going to be our stop loss? Who can guess what's going to be our stop loss? Who can guess what's going to be our stop loss? All right, remember, for our take, for this our buy trade, our take profit was 50 pips, our stop loss was 70 pips. All right, which is the take profit. The 70 pips was the take profit of our hedge. So now we have gotten the take profit of our hedge. We have placed it on our hedge trade. Now what will be our stop loss of our hedge? Yes, who can guess? Who can guess? Who can guess? All right, let me help you out. So this is going to be the take profit, the stop loss rather, for our hedge. Why? Because it is the take profit for our zone recovery. So control copy. That's going to be our stop loss, and I'm going to place a stop loss over there, and then I'll click on modify. So if our hedge is triggered, that's where it's going to take profit. Okay, that is where it's going to take profit. If our hedge is triggered, that is where it's going to take profit, and that's where our buy trade is going to cut with a loss. Okay, because the market did not go buy, it went sell, but we're still going to come out profitable. Should I prove that? I'm going to prove that to you. All right, so see, from our trade we had playing there, I told you when we talked about lot size, 0.02, which we use to enter that trade, 0.02, which we use for the entry of this trade, is 2 cents per pip. 2 cents per pip. So 2 cents per pip times, I want to show you how we'll come out profitable. Okay, so 2 cents per pip. 2 cents, that's 2 cents is in real life is 0.2. Alright, but in forex 2 cents is 0.02. Alright, that's 0.2 divided by 10. 0.2 divided, that's 0.2 divided by 10. It's equals to 0.02. Okay, so in forex 0.2 means 2 cents per pip. So 2 cents per pip times how many pips target? 50 pips. So if the up one wins, this is going to be our profit. Alright, 50 pips, 2 cents per pip times 50. Let me do the calculation. I'm waiting. That's 0.2 times 0.2 times 50. 0.2 times 50, which is equals to $10. Okay, we make $10 if it hits our take profit target directly without coming to hit our hedge. Okay, so if the market goes in our direction as it's doing right now without retracing to hit our hedge, it goes directly and hit our take profit order. What do we simply have? We have simply made $10. Okay, this is $10. So now if it triggers our hedge and hits the take profit target for our hedge, we'll still come out profitable. How do I mean? Okay, so the hedge, remember the hedge is double the size of our entry for our normal buy stop. Alright, the double the size of our entry. The double the size of 0.2 is 0.4. That's why we use a 0.4 lot size to place this particular trade. 0.4 lot size to place that particular trade. So it's going to be 0.4 times 50, right? Because it's 50 pips target. So wherever the market goes, so far it goes 50 pips, you make profit. Okay, 50 pips target. So that's like 0.4. You know why it's 0.4 instead of 0.04? In real life it's 0.4, but in forex when you want to put it, when you want to set your lot size, is use 0.04. Don't use 0.4 because 0.4 means $4 per pip. It's for Christ's sake. 0.4 means $4 per pip. Alright, so now 0.4 times, that's contagious, that's in real life we know 0.4 is 4 cents, but in forex 0.4 is $4 per pip. But in what we are trying to say is that the 0.04 we use is actually worth 4 cents. Alright, so this is 4 cents in real life, but in forex if you use this lot size, you're using $4 per pip, which is risky for your $100 account. Okay, so you use 0.04. 0.04 is what we are representing by 0.4, which is the actual figure in reality. So 0.4 times what? 50 pips target. Right, if the market hits our 50 pips target, it will be equals to 0.4. Help me do the calculation. Let's go. We will be faster. 0.4 times 50. That's 20 pips. All right, equals to 20. That's your profit. Alright, this is your profit if the market comes down and hits this your target. But remember, if you hit this your target, you are losing for this up trade. Right, you are losing for this up trade. And if you lose, how much have you lose? You lose 0.02 times. That's from where you entered to here is 70 pips, right? It's about 70 pips. So you lose 70 pips and gain 50 pips. You lose 70 pips and gain 50 pips. So 0.02 times 0.02, which was the initial entry for your buy, which did not go as planned. You say 0.02 times, that's 0.2 actually, but you know in forex the last time we used was 0.02. So 0.2 times 70 pips is going to be, you're going to minus it from your profit that you had here. So let's just calculate your loss. Your loss is going to be here. So you're going to say minus 0.2 times 70, because from your buy trade to where the buy trade stop loss is about 70 pips. So that will be what? Type in 0.2 times 70. 0.2 times 70 is equals to 14, so minus 14, which is equals to 14. Okay, which is equals to 14. So this is how it looks like. All right, so let's do the minus. All right, so 20 minus 14. 20 minus 14. Are we not still profitable? We are by about $5 or $6. So we say 20 minus 14, that's 14. So we still came out with a profit of $6, even when we're wrong. Because we're wrong, we see the market will go up because the market triggered our buy stop. We're expecting that the market will go up, but the market didn't. Rather, it went down. So we still came out with with about $6. So let me just do that out for you so you see what I mean. So now it's going to be 20 minus 14. So what do we have? 20 minus 14 is equals to what? That's 20 minus 14 is equals to, what do we have? 6. Okay, so you still came out profitable. So now let me give you another scenario. Okay, let me give you another scenario. The scenario where the market, the idea is that as soon as the market triggers your sell stop, which is double the size of your initial entry, as soon as it triggers this, you place another hedge, and that hedge is going to be at this your entry. In case it triggers, you're going to place another hedge at this your entry. So you're going to place a hedge using a buy stop hedge at this your entry, so that if the market now goes like this, all right, and triggers this your entry again, you're still going to come out profitable. Okay, so what's the lot size you're going to use when your initial was 0.2? What's going to be the lot size that you're going to use here? It's going to be 0.3. Why is it 0.3? Because it's not going to be 0.3. It's rather going to be 2.5 times bigger than your initial. All right, your initial was 0.2, right? So 2.5 times bigger than your initial would be 5. That would be 0.5. Okay, so it's going to be 0.5. So we'll place another buy stop over here. That if it immediately triggers here, we place our buy stop, expecting that it will not trigger. But in a scenario where after triggering here, the market comes here, market can be choppy at times. It comes here, triggers here. So as soon as it triggers here as a security measure, you place a buy stop trade, and that buy stop trade is going to have the same take profit and the same stop loss of your buy trade. Okay, you're going to have the same take profit and the same stop loss of your buy trade. So you place a buy stop order, which happens to be your hedge. Okay, it's going to be your hedge. It's going to serve as your hedge with a lot size 2 times that 2.5 times bigger than your initial. 2.5 times bigger of our initial, which is 0.02, is 0.05. Okay, so that's what we are going to be using here. 0.05, which is 0.5 in reality. All right, 0.5. So 0.5 is going to be what we are going to use here. All right, as our buy stop. Remember, the buy stop is going to have the same take profit target with your buy trade and the same stop loss. All right, with your buy trade. So if the market now goes in our favor, we're going to come out with profit. So if the market goes in our favor, that after hitting here, this was the one that eventually won. All right, let's say this was the one that eventually won. What do we have? We're going to do some small mathematics there again. We now have the first trade, which was 0.2. All right, or which in forex was 0.02, but in reality 0.2. So we have 0.2 plus 0.5. All right, plus 0.5, which gives us 0.7. So 0.7 was the total lot size that hit our 50 pip target. So we're going to say 0.7 times 50. That's our profit, 35. All right, that's the sell stop, the initial trade plus your buy stop order that was triggered. Let's say the buy stop order was triggered after. So see how the market moved. The market moved from where you entered initially, triggered your sell stop, and then continued in your direction. So as soon as it triggers your sell stop, you place a hedge order, right? You place a hedge order over here at the initial entry, right, with a 0.5 lot size, which is a lot size that is bigger than, that's 2.5 times bigger than your initial.
All right, 2.5 times bigger than your initial. So if the market now hit our take profit after doing this kind of movement, moving from here, trigger this, and then you place this one, it triggers it and hit your take profit. This is what you're going to do. Now you have two trades, 0.2 plus 0.5, which give us 0.7. So we're going to do 0.7 times 50. All right, 0.7 times 50. 0.7 times what? 50. It equals to 35, right? It's equals to 35. But we lose a particular trade. This trade did not go down, so we lose 70 pips on this trade. All right, so we lose 70 pips on this trade. We lose 70 pips on this trade. So the 70 pips with a lot size of how much? 0.4. So we say 0.4 is going to be minus 0.4. It's going to be minus 0.4. Okay, it's going to be minus 0.4. Okay, so let's say we have a scenario like this. We have a scenario like this. Okay, that's 0.4 times 0.4. 0.4 is going to be 0.4 times 0.4 times 70 pips. All right, 0.4 times 70 pips. All right, 0.4 times 70 pips is going to be, because we are measuring from here, that the loss for our sell stop, because the market did not go the sell direction and hit our take profit target. So we're measuring the loss. We're measuring the loss. So we're measuring the loss now for our sell stop order, right? Which was double the size of our initial. All right. So we're going to measure that right now. We're going to measure that right away, which is 70 pips away. It's going to be 70 pips away. All right. So it's going to be 70 pips away. Going to be 70 pips away. So now that's going to be zero. That's the lot size, which is 0.4 times 70. All right, the actual lot size was 0.04, but I'm just saying that in reality it's about 0.4, which is 4 cents. 4 cents. All right, 4 cents times 70. 4 cents times 70. All right, 4 cents times 70, which is obviously going to be 28. So you still came out with profit. All right, so let's do that. Let's do that. That's going to be 0.4 times 70, which is equals to what? 28. That's our minus 28. All right, so this is what we have. Let me shift this. I just want to demarcate this. When we're talking about this was just if the market at your 0.2 did not trigger your zone recovery and went directly and hit your take profit, you will have made $10. All right, but now it triggered your zone recovery, and now it triggered your entry again. As your hedge trade you place immediately, your zone recovery was triggered. The hedge trade you place immediately, your zone recovery was triggered, and then now hit your target. That's what we are calculating. All right, so the total loss size that went and hit your target was the total loss size that finally hit your target was 0.2 plus 0.5, which gave us 0.7. All right, 0.7 times 50, that's your 50 pips target. All right, your 50 pips target. Your 50 pips target. All right, that equals to 35. Now, but we have a loss. The loss of this, that because it triggered this 0.4. All right, the loss of this 0.4 is going to be 0.4 times 70 pips. All right, your stop loss was here, so it's 70 pips. All right, 0.4 times 70 pips. 0.4 times 70 pips equals to 28. So 35, which was a profit, minus 28. What are you going to come out with? All right, let's do that. We have we have 35 minus 28. So that will be equals to what? Who is a mathematician over there? 35 minus 28. That's $7. All right, that's equals to $7. So you came out with a profit of $7. This is how you make forex very simple. You are able to trade forex with confidence because you are sure that even though the market does not go according to how you said the market was going to go, you are going to come out with at least
the worst thing that can happen, the worst case scenario, you come out with a small loss, with a very very small loss. Okay, very very small loss. So now this is where you are going to lose, and this is going to be your last trade you are going to place. All right, this is going to be the last trade you are going to place. So if the market triggers your hedge, remember, as soon as it triggers your hedge, you place another trade here. That's at your sell, where you place your sell stop order. All right, your initial sell stop order. So as soon as the market triggers this, you place your hedge. So you place the hedge immediately this one triggers. All right, and you're going to be placing this one with a lot size of 0 points, that's 1.5 times bigger than this. So it's going to be 0.2 0.3. All right, because 1.5 times of 0.2 is about 0.3. all right, so 0.3. So if you place a trade of 0.3 there, and let's say, let me just draw that out. Let's say the market came to this place and triggered the market can do like this most times. All right, triggers this is where you're going to come out with a small loss. It triggers your buy stop, that's your hedge buy stop, and then goes back and trigger, and immediately, I told you, immediately it triggers your buy hedge trade, you open a trade here with 0.03, which obviously is 0.3. all right, so you open a trade here with 0.3. So after having opened a trade here with 0.3, what you are going to do is to, you are going to leave the market. And remember, when you open a trade, a sell stop pending order, here. All right, when your take profit is going to be the take profit for your sell stop, and your stop loss is going to be the stop loss for your sell stop too. Okay, going to be the sales, let's get me right. Your take profit is going to be the take profit of your sell stop, that's this of your sell stop that was triggered, and your stop loss is going to be the stop loss of your sell stop. So you just replicate the same trade. You are basically going to be replicating the same trade. Okay, so you are basically going to be replicating the same trade. So now it has triggered your sell stop. Okay, that's triggered your sell stop, and that your sell stop was 1.5 times bigger than your initial. It was 1.5 times bigger than your initial. So 1.5 times of 0.2 is about 0.3. Okay, so we now say 0.3. We place a sell stop order over here, a sell stop order with 0.3. So let me just show you how that will have been done. You just come here, click on new order, and you simply place a sell stop order. You edit this to, you type in 0.03, and then you place a sell stop order with that's the value of this line. All right, you get the value of this line by double clicking and copying the coordinate. So let's say we did that, copy the coordinate, and all we just need to do is type in that coordinate here, or paste it. You can copy it with your pen and then type it here later on. So Ctrl V, and then we place that particular trade, just in case. We are not going to be placing it because that has not happened. Just saying, if the market plays out in that kind of way, that's what you will do. Okay, what you will do. So now look, I want you to see something. Okay, I want you to see. So now if you place your trade, your sell stop trade over here with that with what I've just taught you, that's 1.5 times bigger than this, you're going to come out with a loss, but that loss is going to be very very small. Okay, so see, let's do the calculation. So we have 0.4 plus 0.3, because you are going to be placing a sell stop over here with 0.3. You need to place a sell stop with 0.03 actually, because it's a $100 account, that's 3 cents per pip, but in reality it's 0.3. okay, they're going to be placing a sell stop there with 0.3. okay, as the market does a move from where it has triggered initially, comes down to trigger your zone recovery, and comes up to trigger your because immediately it triggers your zone recovery, you place another hedge, it comes here to trigger the hedge, and then it's coming back to your zone recovery again, and to trigger because immediately it triggers this your hedge, you place a trade with 1 time, that is 1 time
1.5 times bigger than your initial, which happens to be 0.3. Okay, so you sell stop with 0.3. Alright, so placing a sell stop here with 0.3, the same target, okay, the same target for your sell stop, the same take profit, the same stop loss. So you place the trade here. So that will mean that if the market now goes in this direction, right? If the market now goes in this direction and hits your take profit target, right, and hits your take profit target, this is going to be your profit and loss, right? It's going to be your profit and loss. So your profit is going to be 0.4 plus 0.3, that is 7. 4 plus 3, 4, 5, 6, 4, 5, 6, 7. That's 0.7, okay? So you have 0.7 times 50. 0.7 times 50. We already know what that is. That's 35 equals to 35. That's your profit. You made $35. Okay? You made $35. Then how much do you lose? How much do you lose? Minus the whole, there's when we calculated the whole lot size for this particular trade, it was 0.7, say, right? It was 0.7. So 0.7 in this scenario, 0.7 times 50. 0.7 times 50 is good. Let's check what that is. 0.7 times 50. So it's going to be minus 0.7 times 50. We'll come out with a very small loss. 0.7 times 50. That's like 35. Sorry, it's not 50. It's going to be 0.7, because this is the loss. This is the loss. It's going to be times 70. All right, 0.7 times 70, which happens to be 50. Okay, so that's going to be 0.7 times 70, which is equals to $50. So this is what we have. It's going to be minus this. Right, so minus this. That's going to enter your account a little bit, right? You know it's going to touch your account a little bit. That's going to be total of, that's like $15 loss. All right, $15 is going to be subtracted. That's like you're going to lose this, and then you're going to lose an extra $15. All right. What I mean by that is that you have a $35 loss, right? So you have $35. So 50 minus $35, that's like $15. So that $15 is going to be taken out of your equity. That's your capital. If you have $100 minus $15, you're going to be left with like $85. Right? You're going to be left with like $85. So what we have here, it's our our 35. Let's take note of that. Our 35 minus 50 is equals to minus 15. So that is your profit and loss. This is the only time you'll be coming out with a loss. Alright, this is the only time you'll be coming out with a loss. So that's how zone recovery works. Right, you do it 4 times. If the market triggers your entry, that's your buy stop, you place a zone recovery according contextual zone recovery. Alright, how do you place a contextual zone recovery? Is by measuring from your entry to the lowest wick, and you measure from the entry to the lowest wick. If it's 14, you take it to a round figure of 20. If it is 21 or 22, take it to a round figure of 30. Okay, of 30. All right, of 30. If measuring from where the market had triggered initially, and here it is like 31, you measure to 40. Your zone recovery is going to be like 40. Okay, so that's what you need to know about zone recovery. So when you place your zone recovery, the market now comes from where you entered and triggers your, say, 30 pips zone recovery. Remember, because it's 30 pips, it's going to be 75 pips target. All right, 75 pip target, 75 pip target. All right, so that is how it works. If it's a 40 pips zone recovery, it's going to be 100 pips target, 100 pips target. So if the market hits, it comes from here, hits here, that's 1. and then say it comes here and immediately it hits here, you know what to do. Place a hedge which is 2.5 times higher. Alright, 2.5 higher. And then if it hits here, immediately it hits here, you place another hedge here, and this will be your last hedge. Whatever wants to happen should happen. Alright, so that's how we do our zone recovery trading strategy. That's our hedging trading strategy. That's how we do it. All right. So thank you very much. I hope you understand. But just in case you are finding it difficult, just contact the mentor. All right. Contact the mentor. Is going to book an appointment with you and remotely access your computer and show you and give you a better understanding of how the strategies work. You might even take a trade with you. Okay. That's how. Thank you very much. Okay, so this is the zone recovery class. This is the zone recovery class. Um, let's just take this random date. You could pick any date, okay? You could basically pick any date, but let's just take this random date. So what we are looking for is the 7 o'clock candle. Remember, this is set to London. Alright, this is set to London. So what we're looking for is the 7 o'clock candle, and this happens to be the 7 o'clock candle. This candle, this green candle that we see here, all right, it happens to be the 7 o'clock candle. Let me zoom in so you see it. This very candle, I could put it in, I could highlight it so you really see the exact candle I'm talking about. Okay, so this is it. Come in. Okay, so this candle is the candle I'm talking about. The candle in the green box. Okay, this candle is the candle I'm talking about. If you look down, it's the 7 o'clock candle. That's after setting this to your London. Alright, so this 7 o'clock over here, it's about 9 o'clock in the morning Nigerian time. It's about 9 o'clock Nigerian time. Okay, this is like 9 o'clock Nigerian time. So all you just need to do is to already this triangle, this rectangle that we have used has enabled us to box it. Okay, we have boxed it. That means we have placed it in a box. That's we place the high and then the low of this candle. So what we just need to do is measure 3 pips away from 3 pips away, like roughly 3 pips. Okay, 3 pips away from the high, and then we measure 3 pips away from the low of our box. Okay, 3 pips away from the high and like 3 pips away from the low of our box. So we want to see which is going to trigger first, and obviously we saw that the market triggered our sell stop. The market triggered our sell stop first. So these are our sell stop. We're going to be placing 2 pending orders. Okay, we're going to be placing 2 pending orders. Here is going to be a sell stop, while here is going to be a buy stop. Okay, here is going to be a buy stop. So buy stop. So if you notice, the next candle, that's this candle, this green candle over here, was what triggered our sell stop, which was 3 pips away from the low of this box, right? This green box. So it triggered our sell stop. So the market is expected to sell. Okay, but that did not happen. So immediately it triggers our sell stop, we close this order, our buy stop order, which is a pending order. Another that is not yet open, it's a pending order. So now we have the sell stop order. So now remember, contextual zone recovery, what we do is that we measure and put it in a round figure. Like, see, in this scenario, from where we have our sell stop that triggered to where we have our wick, that's the end of the other side of the box, right? It's like 14 pips, right? 14 is not enough, so we round it to a round figure of 20. So the least we use is 20. The least zone recovery size we use is 20. So I use the alternate H. I use the alternate H to, that's maybe I measure from here and then got to this point, which is 20 pips, then I use alternate H to mark that point. Alright, alternate H. So having done that now, and I will now place a buy stop over here with double the lot size I used here. A buy stop over here with double the lot size I used. So if I were to use, let's say 0.2, okay. If I were to use 0.2 over here, I'm going to use 0.4 up there as my what zone, as our hedge. Alright, so we have to use 0.4, and obviously we saw that the market triggered our sell stop. That means that as soon as it triggers our sell stop, we open a hedge with 0.4. That's double this. Alright, double this. So the market came to this place and triggered our what? It triggered our buy stop. Immediately it triggers our buy stop. What do? We come down to where we had our former sell stop and place another trade with 2.5 times our initial risk. 2.5 times our initial risk. So 2.5 times our initial risk is 0.5. Alright, 0.5. So we place another sell stop over here with 0.5. But this is how the market did. The market came this way and triggered this place. So immediately it triggers our 0.5. We place another hedge, which is the last, which happens to be the last one with 2.5 of this. What am I saying? 1.5 of our initial entry. 1.5 of our initial entry, which happens to be 0.3. So immediately this our sell stop was triggered. 0.5 sell stop was triggered. Immediately we place another trade here with 1.5 of this. Okay, so 1.5 of this. That's 0.3. That's 1.5 of our initial. So now the market now ended up in this direction. That it ended up going 50 pips in this direction. As you can see, obviously, just with using my eyes, I knew that the market went 50 pips in this direction. But let me confirm that. Remember, whenever we have a 20 pip zone recovery, our target is what? 50 pips. Alright, and we got our 50 pips over here. Alright, so it hit our 50 pips target. So what is our profit or loss? Now calculate our profit or loss. The market we entered here for a sell, right? And the market went against us and triggered our 0.4, right? So after triggering our 0.4, we came down and triggered our 0.5, because immediately it triggers our 0.4, we opened another trade of 0.5. Okay, immediately it triggers our 0.5, we open another trade with 0.3. This is called zone recovery. This is called hedging. Alright, immediately our sell stop, which was our first trade, was triggered. We opened the hedge. Immediately our hedge was triggered. We opened another hedge at this exact location. Immediately the hedge in the exact location was triggered. We opened another hedge, which is the last. So you do it 4 times. 1, 2, 3, 4. Only 4 times. Then whatever, even though the market wants to rally around here, you just leave it. Alright, until it gets to a target. Alright, your target of 50 pips. So we have target of 50 pips above, and then target of 50 pips below. Target of 50 pips below. As you can see, so the market first got to our 50 pips above. So let's calculate our profit or loss. Let us calculate our profit or loss. Let's calculate our profits or loss. I told you, whenever it gets to the fourth time, we come out with a loss, no matter where the direction comes, but the loss is very small. So we calculate our profit or loss, because your aim is to minimize losses and maximize profit. Calculate our profit or loss. So this is how it goes. So now we say 0.4 plus 0.3 is equals to 0.7. Alright, 0.7. So 0.4 plus plus 0.3 is equals to 0.7. 0.7 now, 0.7 times 50 pips is equals to what? 0.7 times 50 pips is equals to what? Let's do the maths. 0.7 times 50 is like 35, right? $35. So that's our profit, because this was the one that hit the target. This is our profit, $35. So our loss, 0.2 plus 0.5. Alright, 0.7. 0.2 plus 0.5 happens to be 0.7. Let me mark that out. 0.2 plus 0.5 equals to 0.7. Alright, 0.7. Okay, now 0.7 times 0.7 times 70 pips, because it was the one that lost, times 70 pips is equals to what? That will be the loss. So 0.7 times 70 pips, $49 loss. Alright, equals to $49. So we minus 49, we minus 35 from this, our loss. Alright, let me indicate. This is our loss. And this is our, because this is the one that hits the target, so this will be our profit. This is our profit, and then this is our loss. So we'll subtract our profit, we'll subtract our loss from our profit. So that will be 35 minus 49. Right, 35 minus 49. 35 minus 49 is equals to 15. Alright, so you only lost $15. Alright, you only lost $15. Okay, around that amount. You lost $15 because that's like minus 15. Alright, so you made a profit of 35, and then you had a loss of 15. That's of 49. So you take out your loss from your profit and a little bit of your capital. So that's why we have minus 15. Alright, minus 15. So on the days where you are going to be profitable, you see, if you do this consistently for 1 month, you come out with at least 40%. At least 40%. I'm just saying defensive. At least 40% of whatever capital you have. So let's just do the back test on another day. Alright, let's just pick a random date. Just about any day would do. I want to show you a flawless day. Alright, okay, I want to show you a flawless day like this day. Okay, let's check out this day, this very day. Alright, so this is the 7 o'clock candle of the 13th of February 2019. Alright, so this is the 7 o'clock candle. This is our 7 o'clock candle. This very candle, this red candle over here, this red candle is our 7 o'clock candle. So what I just need to do is to put it in a box. Alright, I measure from this is the candle, so I measure from its highest, its high to its low. Alright, so I can put it in a box. So I just want to put it in a box. Good. Okay, so we put it in a box. This is the 7 o'clock candle. So having put it in a box, we measure 3 pips away from the box, the upper zone of the box, 3 pips away from the upper zone of the box, and then 3 pips below the lower part of the box. Alright, 3 pips below the lower part of the box. So we are looking for where the market is going to trigger first. Obviously, we have seen that the market triggered our sell first. but we are going to place two orders prior before this happen. All right, prior before this happen. This one is going to be sell stop. The one under is going to be sell stop. Sell stop. All right, sell stop. All right, and it's going to be 0.2. Sell stop with our initial 0.2. 0.2. Then it's going to be a buy stop. A buy stop 0.2. Okay, so when one triggers, and obviously it was a down that triggered on this day. Alright, it was a down that triggered on this very day. So when one trigger, we cancel the other. So in this day, the down trigger, that's the sell triggered. So we just come and we cancel our buy, and then we now place our hedge. So our hedge is going to be measured to this part. So we're going to measure from our entry to the box. So it's like 17 pips. Right, so we just round it up to 20 pips and alt H to place that. Alt H. So now this is our zone recovery. Doing that, we have been able to get our zone recovery. Alright, and this day was a very good day because the market went directly in our favor. It did not trigger our zone recovery. So when the market triggered our sell stop of 0.2, we place a zone recovery, which is a buy stop of our hedge, which is a buy stop of 0.4, 2 times our rates. This is our hedge. Okay, hedge equals to buy stop of 0.4, 2 times our rates. All right, so this is how the market moved on this very day. So the market, after triggering after it triggered our sell stop, it moved and did not get to our hedge. You can see there's no candle that triggered our hedge. None of this candle triggered our hedge. So the market just went in our favor by 50 pips. Alright, some days are going to be like this. This is a very wonderful day. So 50 pips. Now let's calculate our profit / loss. The market only went in our direction. It didn't trigger our hedge. Alright, it didn't trigger our hedge. So what was our profit? Our profit is going to be 0.2 times 50. 0.2, because our profit target, remember, after placing your hedge over here and then this triggered, you measure 50 pips. Okay, 50 pips, and then you measure 50 pips also on this other side, just in case. Right, 50 pips on this other side. 50 pips on this other side. Right, just in case. So now the market did not trigger our hedge, rather it went in our direction. So on this very good day, we just say 0.2 times 50. That will be our profit for that day. 0.2 times 50. So 0.2 times 50, which is equals to, let me do the maths. Not very good in calculation, but I trade forex and make money. 0.2 times 50, that's 10, equals to $10 profit on this day. So doing this consistently, you have days like this where the market just goes directly in your favor. Right, it goes directly in your favor and trigger your take profit. Right, this is your take profit. So that is that. Let's look for a scenario of another day. Let's use this day. Right, this is the 7th of the 12th day of February. Alright, so what we just need to do is put this very candle in a box. I will put it in a box. That's what we're about to do. Yes, it's in a box. This is our 7 o'clock candle, and it's now in a box. So we measure 3 pips above, 3 pips below. This is what we use to measure our pips. Alright, it looks like a ruler to its our measurement tool. So we measure 3 pips above this box. 3 pips above this box, alt H. Alright, 3 pips above that box, alt H. And then we measure 3 pips below this box. This is my focal point. Alright, this box is my focal point. So I measure 3 pips below the box. 3 pips below this box. Alright, 3 pips below this box. So we have 2 zones. Alright, so we set our buy stop here. Our buy stop here. So our sell stop, thank you for that correction. Our sell stop, because when the market is going down, we sell. Our sell stop over here, that's a pending order to order the broker that whether we are there or not. If the market goes this much, we should sell. Alright, and then we place our sell stop, that A. Alright, so this is our buy stop. It's the same lot size, 0.2, because you don't know which is going to be triggered, or you don't know which is going to be triggered. So our buy stop and our sell stop, the same lot size, 0.2. And then you discover that it was our sell stop that was triggered on this day because the market got here first. So as the market has triggered our sell stop, we delete our buy stop. We take out our buy stop. Alright. After taking out our buy stop, we now measure. We want to see if this candle, okay, 12, so we round it up to 20. We round it up to 20. Round it up to 20. Alright, so that's 20. So now we're going to be placing our hedge here. So our hedge is equals to 0.4. That's double the lot size we use for our entry. Hedge 0.4. So the distance between your entry and your hedge is what is called zone recovery. It's what you call your zone recovery. Okay, so this is your zone recovery. Distance between your where the market triggered to here is your zone recovery. So now let's try to draw how the market moved. The market triggered down here, and then moved up. Okay, I think it went 50 pips. Let's measure because our target is 50 pips because we have a 20 pip zone recovery. Can you imagine what happened? The market did not do 50 pips. Let's see what happened. Let's see H. Okay, so this day, let's see where the market got to 50 pips first of all. Let's see if it's up or down. We don't know, and it's not really our business. But let's see. The market went up, almost got to 50 pips, but didn't. So remember, immediately our hedge is triggered. We open another hedge of how much? 0.5, which is 2.5 times this our initial. 2.5 times our initial. So nearly this, the market triggers this. We open a hedge on the other direction, and a hedge on the other direction, which is 2.5 times bigger. Alright, 2.5 times bigger. 2.5 times bigger will be 0.5. Okay, we open a hedge of 0.5, and then immediately we open this hedge of 0.5. What we are simply going to do is that as soon as the market triggers this hedge, so that the market triggered this hedge here on this point. As soon as it triggers this hedge, we open another hedge over here. Alright, as soon as it triggered this hedge over here, we open another hedge over here. And that hedge is going to be the last hedge because we only need 1, 2, 3, and 4. That's going to be our last hedge. Okay, so the last hedge is going to be 0. That's 1.5 times 0.3. 1.5 times our initial. 1.5 times our initial. That's 0.3. So we have that at 0.3. Right, so if the market moves up and triggers, and you see that the market didn't, okay, it did. Alright, so it did. So this is the last 1, 2, 3, 4. Alright, so it did. It triggered our hedge. So now we place our targets, our 2 targets. You remember from the first video, you know how we do our targets. For our hedge, it will be 50 pips. That will be our target for our hedge. And then for the zone, for the entry, that's the initial trade that was triggered. 50 pips too for our hedge. Sorry, for our sell, that's the initial trade that was triggered. We put a 50 pips target. For our hedge, we put a 50 pips target because we have a 20 pips zone recovery. Okay, so now where did the market hit? Okay, let's see, where did the market touch? Where did it get to 50 pips? Good. We got our 50 pips. We must always get a 50 pips. So the market got to this point because of we have been doing this. So the hedge we placed here was 0.3, right? 0.4 plus 0.3 is 0.7. 0.7 times this 35, and our loss was, this was our profit 35, and then our loss was 0.2 plus 0.5, which is 0.7. 0.7 times 70, because if you measure from here to here, it's
going to be 70 pips stop loss. So you're going to put, remember what we talked about in the first video, that whenever you place a sell order here, your stop loss will be the take profit for the buy, right? When you place a sell order, your stop loss will be take profit for the hedge. That's the hedge, the take profit for this hedge, which is 50 pips, is going to be the stop loss for your sell stop that was triggered. So we also have the stop loss for this is going to be the take profit for the initial that was triggered. So now the market got here first, so we see 35, which was our profit, minus 49, so we lost $15. So if we consistently do this every single day, all right, every single day, there's no month you're not going to come out with profit, because one day may be bad, the other day will be better. One day may be bad, the other day will be better, as you can see. So that is that. Let's just do one more example, and then we'll call it a day. All right, call it a day. So this is our 7 o'clock candle. This is our 7 o'clock candle for this day. So we just box it. All we just need to do is to click. This is 1, 2, 3, 4. The foot, the foot, it might be in brush. All right. So you just click here and then look for your rectangle. Okay. That's above the text field. So we just come with our 7 o'clock candle. With our 7 o'clock candle. Okay. Is it? Let's just look for that 7 o'clock candle. Looking down, okay, this is our 7 o'clock candle. Alright, this is our 7 o'clock candle. So we'll just put it in a box. I want to box this in a green box. Alright, top to bottom. Alright, so 3 pips above, 3 pips below. That's the normal thing. 3 pips above, alright, 3 pips below. 3 pips above, 3 pips below. Alright, roughly 3 pips. So the market triggered our buy. Alright, it triggered our buy. So after triggering our buy, we have a scenario that the market moved like this. The market triggered our buy, came down and triggered our sell, and went up, triggered our buy. Alright, and then it came down. So 1, 2, 3, came down and triggered here before going up to 50 pips. Alright, so but let's not look at that. Let's just do it. Let's follow the due process. Okay, let's follow the due process, which is after one is triggered, that after this is our buy stop and this is our sell stop. Okay, so our buy stop was triggered, we cancel our sell stop and measure our zone recovery. We cancel our sell stop and measure our zone recovery. Okay, our zone recovery is going to be contextual. Let's measure our zone recovery. Okay, it's going to be from where our buy stop was triggered to the bottom of this 13, so we get it to 20. Right, we get it to 20. So, but there are times where if this is 22, you get it to 30. If this is like 36, you get it to 40. Alright, so during those times your target is going to change according to our first video. So your target is going to change. Right, so our target is 50 pips above. 50 pips above. And then we have 50 pips below. 50 pips below. So obviously it touched our 50 pips above before getting to our 50 pips below. So this minus 15. So I'm going to do a full backtest of January for you. And your assignment is going to be do a full backtest of February, and then you send your results over to me. Alright. So I'm going to walk you through. We're going to do a full backtest with what you understand of January. Okay, full backtest of January. And I'm going to see how we came out profitable in January. Alright, we had losses, but we came out profitable at the end of the day. That is the aim of trading. It's not a perfect business, but you can consistently make money and know what exactly you're doing. So we're not doing a backtest video.
Okay, so this is a student like you trying to, try his hand on how he understands the zone recovery strategy. So let's watch out. Okay, so the code can do. That is the code can do. That one. That's it. Okay, I understand what you're doing. Yeah, that's the 7 o'clock candle. Okay, we are boxing it. He's a professional now. He doesn't want to use that box we usually do. So he's using a horizontal line to box them. Right, so you measure 3 pips above. You have to measure it well. 3 pips above that up horizontal line. 3 pips above. Look, click and drag. Click and drag. 3 pips, yes, around 3 pips, roughly 3 pips. Take it. It has to be like 3 pips here. Alt H to mark up that part. Then you do for the downside. And 2, that's a buy stop we have now. We want to see where we'll set our sell stop. From there, you click and drag. Click and drag. Yes, so 3 pips. 3 pips below. This is where our pending orders are going to be. 3 pips below. So we have the first one up there is the buy pending order. The second is the sell pending order. So let's see which triggered first. Alright, let's see the one that triggered first. So it's deleting its horizontal lines that enabled him to box the 7 o'clock chart. Right, it's deleting that. Alright, sell stop. Alright, so which one triggered first? Where's your 7 o'clock candle? 7 o'clock candle. So that was your 7 o'clock candle. So you see the market triggered the buy stop first of all. So what do you do when the market triggers the buy stop first of all?
Come back and put your hedge.
Come back and put your hedge. Are you sure? No, we cancel out the second trade. Yes, and measure your hedge. So the market has triggered your buy stop. You cancel your sell stop and then you measure your hedge. Cancel your sell stop and measure your hedge from your buy entry. Right? From your buy entry, measure your hedge from there. No, click and drag. Good. So to the tip of the 7 o'clock candle. Is that the tip?
Yeah.
Right, that's like 21 pips. So you round it up to 30. Round it up to 30. Good. So H. You see contextual zone recovery. So whenever it gets to 30 now, your target will be 75 pips up, 75 pips down. Alright, so you could do that. Let's do a little drawing on how the market moved. 75, this is your pip measurement. So your target will be 75 pip up, 75 pip down. Alright, obviously the market got to 75 pip up first, and we don't care about it didn't get to our 75 pip down target rather. So that's 75 pip up. So let's calculate what will have been a profit or loss. Let's draw how price moved. Okay, let me help you at this point. So we use this. Say price triggered here. Alright, it triggered here. It came down here and triggered our sell stop. So because immediately we had our entry from our buy stop, which was 0.2, for example. The market came down and triggered our 0.4 because immediately we have our entry. We placed our hedge here, which is 2 times bigger than our entry. So let's say we have 0.2 over here. 0.2. Okay, as our entry. So our hedge is going to be 0.4. So the market triggered our 0.4. Right, it triggered our 0.4. So having triggered our 0.4, the market still went up again. The market was volatile on that day. It went up again, and then this was what won. So as soon as it triggers our 0.4, what we do, we open another hedge over here. And that hedge is going to be 2.5 times our initial. So 2.5 times our initial, it happens to be 0.5. 0.5. And 0.5 is the lot size you used here. So then we now have two lot size, 0.2 and 0.5. So adding them together, we have 0.7 that hits 75 pips target. Then we have a loss of about this is 0.4 loss minus right? That's minus this, and minus the whole of this is like 105. Okay, so let's see if we actually came out profitable on this day. All right, let's see if we actually came out profitable on this day. We had 0.7 because the addition of 0.2 plus 0.5. We have 0.7. 0. That's 0. Let me just that's 0.2 plus 0.5 is equals to what we have 0.7. Okay, 0.7. So 0.7 times 0.7, which is our answer. 0.7 times 75 pips. That's your profit equals to what? 0.7 times 75 pips. What that's going to be your profit? 0.7 times 75. That's like $52. Alright, that's $52 made. Alright, so let's calculate your loss. What's the $52? So your loss, this was the one that lost because it didn't get to 50 pips first. Alright, this was the one that got to 50 pips first. This one did not get to 50. So when we measure from here to where we placed our stop loss, we placed our stop loss here. Right, from where we placed our stop loss, so the market took us out over here. Right, 105 pips. So let's say 0.4 times 105. Alright, 0.4 times 105. That will be our loss. 0.4, so only one trade that triggered there, times 105. What do we have? Don't have to do my masses. It's equals to 0.4 times 105. 105 equals to 42. Right, equals to 42. Equals to 42. So we have a 50 something dollar profit and then $42 loss. Right, so $42 loss is our loss, and then $52 profit. So what's our profit and loss? Right, profit and loss. Profit and loss is going to be 52 minus 42. That's going to be. You see, with zone recovery, you increase your edge over the market. The market did not go exactly your favor. Right, but you still came up with 52. Right, which is equals to $10 profit. So you still made $10 on that day. So your market did not just go directly in your favor. You had a little glitch where you still made $10 on that day. Right, so that is it. That is how you work with your zone recovery strategy. That's how your recovery strategy is beneficial. So this that happened here was a contextual zone recovery. Alright, normally we measure 20. We measure from where we entered. This is our 7 o'clock candle, right? This is our 7 o'clock. Okay, this is our 7 o'clock candle. This one is our 7 o'clock candle. From where we had entered, we measured to the tip of this, and it was like 22. So we put it in a round figure of 30. Right. So whenever we have a 30 pips target, we target 75. Whenever we have a 40 pips target, we target 100. So that is how we do our zone recovery on that.